복잡하게 들릴 수도 있지만 걱정하지 마세요. 지금은 깊이 생각할 필요가 없는 고급 개념이니까요. 이 부분은 두뇌기 안쪽에 짧은 시간 프레임에 있는 파동들을 다룰 때 나오는 내용입니다. 하지만 지금은 이 부분을 신경 쓸 필요가 없습니다. 여러분이 알아야 할 것은 1번 파동과 5번 파동 모두에서 이러한 대각선 구조가 나타날 수 있다는 것입니다. 그리고 ABC 구조에서도 이러한 구조가 나타날 수 있다는 점도 말씀드릴 수 있습니다. ABC 구조에 대해서는 나중에 이 강의에서 더 자세히 다루겠습니다. 자, 이제 모든 파동의 3가지 요소를 살펴보겠습니다. 여기서 요소란 무엇을 의미할까요? 자, 이 이미지를 보시면 모든 엘리엇 파동에는 고려해야 할 3가지 요소가 있습니다. 첫 번째이자 가장 중요한 것은 바로 형태입니다. 지금까지 강의에서 집중적으로 다뤄온 부분이 바로 형태입니다. 파동을 분석할 때 우리는 1, 2, 3, 4, 5번 파동으로 구성된 상승파동, 모티브 웨이브과 A, B, C 파동으로 이루어진 조정파동, 레코딩 페이즈를 살펴봅니다. 앞서 말씀드렸듯이 이 형태가 가장 중요하게 주의를 기울여야 할 부분입니다. 하지만 고려해야 할 다른 2가지 요소가 더 있습니다. 두 번째는 바로 비율, 레셔입니다. 이는 각 파동 간의 수직적 관계를 나타냅니다. 예를 들어 피보나치 수열과 같은 도구를 사용하여 예측을 시도할 수 있습니다. 예를 들어 첫 번째 파동이 있고 조정이 발생했다고 가정해 보겠습니다. 이때 피보나치 수열을 사용하여 다음 파동이 얼마나 진행될지 등을 예측할 수 있습니다. 피보나치 수열에 대해서는 나중에 더 자세히 살펴보겠습니다. 여기서 비율은 차트에서 수직 방향으로 측정할 때 사용하는 것입니다. 그리고 시간이라는 것도 있습니다. 이는 좌우 방향으로의 관계를 측정하는 데 사용됩니다. 보시다시피 좌우 방향에서도 피보나치 관계를 활용할 수 있습니다. 하지만 가장 중요한 것은 형태입니다. 그 다음이 비율, 그리고 가장 중요한 것이 시간입니다. 따라서 한 가지에만 집중해야 한다면 형태에 집중하는 것을 추천합니다. 다른 요소를 추가하고 싶다면 비율에 집중하세요. 피보나치 수열을 사용하면 됩니다. 더 심도 있게 파동 이론을 활용하고 싶다면 시간도 사용할 수 있습니다. 하지만 무엇보다 먼저 형태에 집중하는 것이 중요합니다. 여기서 핵심 요점을 보시면 형태가 가장 중요하다는 것을 알 수 있습니다. 먼저 파동 카운트를 정확하게 해야 하고 그 다음 비율을 확인하고 비율을 확인한 후에 시간을 확인해야 합니다. 좋습니다. 이제 엘리엇 파동 이론에 깨지지 않는 5가지 규칙에 대해 알아보겠습니다. 이것들은 규칙이라기보다는 반드시 성립해야 하는 법칙입니다. 그러니 집중해서 잘 듣고 노트를 준비하세요. 이 규칙들은 반드시 알아야 합니다. 첫 번째 규칙은 파동 2 규칙입니다. 이 규칙은 파동 2가 파동 1의 시작점을 절대 넘어설 수 없다는 것입니다. 예를 들어 설명해 보겠습니다. 여기가 파동 1이라고 할 때 이 규칙에 따르면 파동 2는 이 파동의 시작점 아래로 떨어질 수 없습니다. 만약 이런 움직임이 있다면 이것이 파동 2입니다. 이것이 파동 1이고 이것이 파동 2입니다. 만약 파동 2가 이 빨간색 선 아래로 떨어지면 이것은 유효한 파동 2가 아니면 규칙을 어긴 것입니다. 규칙을 어기지 않으려면 첫 번째 파동이 있고 두 번째 파동이 첫 번째 파동의 시작점 아래로 내려가지 않아야 합니다. 오른쪽 예시는 유효했고 규칙을 어기지 않았습니다. 다음으로 세 번째 파동에 대한 규칙이 있는데 세 번째 파동에는 2가지 규칙이 적용됩니다. 첫 번째는 세 번째 파동이 첫 번째, 세 번째, 5번째 파동 중 가장 짧을 수 없다는 것입니다. 그리고 항상 첫 번째 파동의 끝을 지나서 닫혀야 합니다. 이게 무슨 뜻일까요? 전체 파동을 그려보겠습니다. 첫 번째 파동, 두 번째 파동, 세 번째 파동, 네 번째 파동, 다섯 번째 파동이 있습니다. 이 규칙은 세 번째 파동에 관한 것입니다. 여기가 세 번째 파동입니다. 모든 파동의 개수를 그려볼 수 있습니다. 1, 2, 3, 4, 5입니다. 이 규칙의 첫 번째 조건은 세 번째 파동이 가장 짧을 수 없다는 것입니다. 이 경우 파란색 파동인 세 번째 파동이 첫 번째 파동과 다섯 번째 파동에 비해 짧다는 것을 보여드리기 위해 그림을 그려보았습니다. 따라서 이 경우 n은 규칙을 어긴 것입니다. 하지만 파동 1, 2, 3,
In
4,
this free
5와
video
같은
course,
카운트가
I'm going
있다고
to show
가정해
you
보겠습니다.
everything.
다시 한번 그려보면 1에서 2, 3, 5순으로 파동이 이어지는 것을 알 수 있습니다. 세 번째 파동이 가장 길다는 것을 명확히 알 수 있으며 이것이 바로 우리가 원하는 결과입니다. 세 번째 파동은 첫 번째, 세 번째, 다섯 번째 파동 중 가장 짧을 수는 없습니다. 두 번째 규칙을 기억하세요. 세 번째 파동은 항상 첫 번째 파동의 끝을 넘어 마감되어야 합니다. 이 규칙은 매우 간단하며 보통 이렇게 됩니다. 따라서 파란색 부분인 세 번째 파동이 첫 번째 파동의 고가 위에서 마감되기를 원합니다. 이 경우 세 번째 파동이 가장 길고 첫 번째 파동 위에서 마감되었으므로 규칙을 어긴 것이 없으며 유효한 카운트입니다. 자, 이제 4번 파동에 대한 규칙을 살펴보겠습니다. 이 규칙은 4번 파동이 1번 파동의 가격 영역과 절대 겹칠 수 없다는 것입니다. 이게 무슨 뜻일까요? 다시 한번 영역을 그려보겠습니다. 1, 2, 3, 4, 그리고 5가 있습니다. 이것이 유효한 동기파동인지 궁금하실 수 있습니다. 먼저 1, 2, 3, 4, 5를 그려보겠습니다. 4번 파동에 대한 규칙은 간단히 말해서 4번 파동이 1번 파동의 가격 영역과 절대 겹칠 수 없다는 것입니다. 이게 무슨 뜻일까요? 1번 파동의 가격 영역을 1번 파동의 고가에서 저가까지라고 가정해 보겠습니다. 여기서는 4번 파동이 영역 안으로 들어가는 것을 볼 수 없습니다. 이 경우 4번 파동이 1번 파동의 영역으로 하락한 것을 볼 수 있습니다. 따라서 규칙을 어긴 것이고 이는 유효한 카운트가 아닙니다. 규칙을 어기지 않으려면 다음과 같은 형태를 보여야 합니다. 1, 2, 3, 4, 5가 있습니다. 여기서 분명히 볼 수 있듯이 파동 1이 가격 영역 내에서 하락하지 않았습니다. 이 영역이 가격 영역이라는 것을 기억하세요. 그리고 여기 있는 파동 4는 파동 1이 가격 영역보다 훨씬 위에 있습니다. 따라서 이 경우 n은 규칙을 어기지 않았고 이것은 유효한 카운트입니다. 마지막 규칙은 보편적인 규칙인데 매우 간단합니다. 모든 추진파동은 5개의 서브웨이브, 하향을 포함해야 한다는 것입니다. 그렇지 않으면 조정파동일 가능성이 높습니다. 아주 간단합니다. 추진파동이 되려면 1, 2, 3, 4, 5의 카운트가 있어야 한다는 것입니다. 자, 이제 각 파동의 특징을 살펴보겠습니다. 지금까지 강의에서는 주로 각 파동의 카운트에 대해 이야기했지만 가격 움직임 이면에 있는 심리를 분석하는 것도 매우 유용할 수 있습니다. 시장의 심리를 제대로 이해한다면 언제 진입하고 언제 청산해야 할지 더 잘 알 수 있고 결과적으로 더 많은 수익을 올릴 수 있습니다. 그럼 파동의 심리에 대해 조금 이야기해 보겠습니다. 먼저 1파동에 대해 알아보겠습니다. 1파동은 여러 파동으로 이루어진 차트에서 첫 번째 파동입니다. 즉, 가격을 상승 또는 하락 방향으로 이끄는 첫 번째 파동입니다. 지금까지는 주로 상승 추세에 대해 이야기했지만, 물론 모든 원칙은 하락 추세에도 적용됩니다. 1파동의 중요한 점은 첫 번째 파동이기 때문에 보통 불확실성 속에서 시작된다는 것입니다. 많은 트레이더들이 이를 단순한 노이즈로 치부하거나 아무도 이 파동을 믿지 않는다는 등의 반응을 보입니다. 따라서 1파동은 일반적으로 다소 불확실한 모습을 보이며 이는 가격에서도 확인할 수 있습니다. 1파동은 5개의 파동 중 가장 약한 경우가 흔합니다. 일반적으로 첫 번째 파동은 약하거나 무시되는 경우가 많습니다. 하지만 5초 카운트에서 첫 번째 파동을 포착할 수 있다면 이론적으로는 매수하기에 가장 좋은 파동입니다. 전체적인 상승 모멘텀 구조를 활용할 수 있고 수익을 낼 수 있기 때문입니다. 세 번째 파동은 종종 가장 강력하고 긴 파동입니다. 이는 심리적으로도 확인할 수 있는데 바로 이 시점에서 인식이 시작되기 때문입니다. 많은 트레이더들이 단순히 가격을 따라가는 경우가 많습니다. 따라서 강한 상승 움직임을 보이면 더 많은 사람들이 그 주식이나 암호화폐에 대해 이야기하고 친구들에게 알리면서 긍정적인 상승 모멘텀이 형성됩니다. 세 번째 파동은 일반적으로 가장 강력하며 그 뒤에는 가장 강력한 심리적 힘이 있습니다. 그렇기 때문에 세 번째 파동을 포착할 수 있다면 매우 좋은 거래가 될 수 있습니다. 세 번째 파동의 돌파를 활용하는 등 다양한 전략을 사용할 수 있습니다. 네, 그래서 3번 파동을 포착하고 활용하는 것은 매우 중요한 기술입니다. 다음으로 5번 파동이 있는데 5번 파동은 종종 좀 더 낙관적인 흐름을 보입니다. 일반적으로 트레이더들은 시장이 강한 3번 파동 이후 상승세를 이어오다가 잠시 조정을 거친 후 이제 다시 상승세가 나타나고 있다고 생각하기 때문에 매우 기뻐합니다. 따라서 많은 트레이더들이 이러한 흐름에 매우 만족하는 경우가 많습니다. 하지만 5번 파동은 3번 파동보다 약한 경향이 있다는 점을 기억하는 것이 중요합니다. 그리고 이러한 현상은 RSI 나MACD 지표에서 다이버전스를 통해 확인할 수 있습니다. 제가 이 이미지에서 보여드린 것처럼 다이버전스는 가격이 한 방향으로 움직이는 반면 지표는 반대 방향으로 움직이는 현상입니다. 이는 가격이 소진되었거나 반전될 가능성을 시사하는 신호입니다. 이 슬라이드에서 보이는 것은 하락 다이버전스이며 잠재적인 하락 반전을 나타냅니다. 5파 이후에는 일반적으로 조정이 발생하기 때문에 다이버전스를 포착하는 것이 매우 중요합니다. 앞서 강의에서 MACD 지표를 이용해 다이버전스를 분석할 수 있다고 말씀드렸죠. 다이버전스를 포착하는 데 유용한 또 다른 지표는 RSI입니다. 다행히 저는 RSI 지표에 대한 전체 강의도 제공하고 있습니다. 영상 카드와 설명란에 해당 강의 링크를 추가해 두겠습니다. 여기서 중요한 점은 이 슬라이드를 통해 파동의 성격을 이해하면 진입 시점을 정확하게 잡고 추격 매매를 피하는 데 도움이 된다는 것입니다. 즉, 더 나은 거래를 할 수 있을 뿐만 아니라 원치 않는 거래를 피할 수도 있습니다. 예를 들어 5번 파동에서 다이버전스를 발견했다면 이는 상승 추세로 거래를 이어가지 않는 것이 좋다는 신호일 수 있으며 오히려 매도 포지션을 고려해 볼 수도 있습니다. 다시 말해 가격이 하락할 때 수익을 내는 전략입니다. 그렇죠. 이제 엘리엇 파동 이론에서 조정 파동의 형태를 살펴보겠습니다. 여기서 조정이란 상승 파동 1, 2, 3, 4, 5번 파동 이후에 나타나는 파동을 말합니다. 가장 흔한 조정 파동은 다음과 같습니다. 다른 색으로 그려보겠습니다. 빨간색으로요. A, B, C가 있습니다. 이것이 가장 일반적인 조정 구조입니다. 하지만 이론뿐 아니라 실제 시장에서도 항상 이렇게 단순하지는 않다는 것을 알게 될 것입니다. 실제로 여러 가지 유형의 조정 파동 형태가 있습니다. 이에 대해 조금 이야기해 보겠습니다. 첫 번째 조정 파동 형태는 시그니처 세그, 시그세그라고 하며 지금까지 우리가 이야기해온 바로 그 형태입니다. 이는 급격한 3파 조정이 나타나는 경우입니다. 그리고 지금까지 자세히 다루지는 않았지만 이 파동은 535로 세분화됩니다. 여기서 세분화라고 할 때는 단기적인 시간 프레임을 의미합니다. 우선 지그재그 패턴은 우리가 지금까지 이야기해온 일반적인 패턴입니다. 이것은 A, B, C 조정입니다. 이러한 조정은 다음 상승 동력 파동이 발생하기 전에 나타납니다. 여기서 세분화란 무엇을 의미할까요? 간단히 말해 파동 내부에서 세분화된다는 뜻입니다. 예를 들어 이 전체 구조를 살펴보면 여기 있는 A 파동은 단기적인 시간 프레임에서 실제로 5개의 파동으로 세분화됩니다. 즉 1, 2, 3, 4, 5로 나뉘는데 여기가 바로 다섯 번째 파동입니다. 그리고 숫자 3은 A에서 B로 가는 파동이 1, 2, 3으로 세분화된다는 것을 의미합니다. 여기가 바로 3입니다. 그리고 숫자 5는 B에서 C로 가는 파동이 1, 2, 3, 4, 5로 세분화된다는 것을 의미합니다. 이 그림이 그다지 보기 좋지는 않지만 여기서 세분화된다는 것이 무엇을 의미하는지 보여주기를 바랍니다. 이것은 더 짧은 시간 프레임으로 확대했을 때의 모습입니다. 3방향 조정은 기본적으로 이런 모양입니다. 이는 제가 강의 초반에도 언급했던 내용입니다. 시장은 프랙탈 구조를 가지고 있다는 것을 기억하세요. 하나의 시간 프레임을 보고 더 짧은 시간 프레임으로 확대하면 동일한 패턴을 찾을 수 있습니다. 이것은 시장의 매우 흥미로운 특징 중 하나입니다. 여기서는 지그재그 패턴을 보았고 파동 B는 파동 A의 시작점을 넘어서서는 안 된다는 점도 말씀드리겠습니다. 하지만 이것은 여러 가지 조정 파동 모양 중 하나일 뿐입니다. 두 번째 모양은 플랫이라고 부르는 것입니다. 이것은 횡보 움직임을 나타냅니다. 이것은 횡보 3파동 조정 패턴입니다. 일반적으로 335파동으로 세분화되며 일반형, 확장형, 러닝형 등 다양한 형태로 나타납니다. 여기서 볼 수 있는 패턴이 바로 일반적인 횡보 패턴입니다. 이 패턴은 이전에 상승 움직임이 있었을 때 형성되며 실제 패턴은 다음과 같습니다. 첫 번째 조정 파동 A, 두 번째 조정 파동 B, 그리고 세 번째 조정 파동 C가 나타납니다. 확장형과 러닝형이란 파동 B 가이 지점보다 약간 위로 올라갈 수 있다는 것을 의미합니다. 즉, 파동 A는 이 지점보다 약간 아래에 있을 수 있습니다. 다시 말해, 고가와 저점이 정확히 같은 수준일 필요는 없다는 뜻입니다. 하지만 엘리엇 파동 이론에 따르면 이 파동은 보통 3, 3, 5로 세분화됩니다. 즉, A 파동은 1, 2, 3으로, B 파동은 1, 2, 3으로, C 파동은 5로 세분화된다는 뜻입니다. 하지만 특히 엘리엇 파동 이론을 처음 접하는 분이라면 이러한 세분화에 너무 신경 쓰지 않으셔도 됩니다. 초보자에게는 다소 어려운 내용일 수 있습니다. 물론 배우는 것은 좋지만 여기에 집중할 필요는 없습니다. 저는 오히려 외부 카운트에 집중하는 것을 추천합니다. 외부 카운트란 1, 2, 3, 4, 5를 찾고 그 후 조정 패턴, 지그재그 패턴, 플랫 패턴, 삼각형 패턴을 찾는 것을 의미합니다. 단기적인 시간 프레임에 대해서는 너무 걱정하지 마세요. 너무 복잡해질 수 있고 여러 시간 프레임에 집착하면 오히려 역효과를 낼 수 있습니다. 우리가 엘리엇 파동 이론을 사용하는 가장 큰 이유는 차트를 더 쉽게 읽고 분석하기 위해서입니다. 엘리엇 파동 이론을 사용했는데 차트가 더 복잡해진다면 무슨 의미가 있겠습니까? 우리는 엘리엇 파동 이론을 통해 거래 실력을 향상시키고 싶은 거지, 차트를 더 복잡하게 만들고 싶은 게 아닙니다. 다음으로 살펴볼 조정 패턴은 삼각형입니다. 이 삼각형은 보통 5파동 횡보를 나타내기 때문에 조금 다릅니다. 우리는 이것을 A, B, C, D, E로 표시합니다. 여기 삼각형 모양을 보면 3개의 파동만 있는 것이 아니라 1, 2, 3, 4, 5번 파동, 즉 우리가 일반적으로 A, B, C, D, E라고 부르는 파동이 있는 것을 알 수 있습니다. 삼각형. 모양에는 여러 종류가 있습니다. 상승 삼각형, 하강 삼각형, 대칭 삼각형, 그리고 확장 삼각형이 있습니다. 제가 여러분께 보여드렸던 상승 삼각형은 다음과 같은 움직임을 보일 때 나타납니다. A, B, C, D, E 이런 식으로요. 이것은 저점이 높아지는 추세를 나타냅니다. 즉, 하나의 저점이 있고 그보다 더 높은 저점이 있는 것입니다. 여기 고점들을 보면 A, B, C, D, E가 저항선에 부딪히고 있는 것을 알 수 있습니다. 여기서 목표는 물론이 저항선을 돌파하고 다음 상승파동으로 이어지는 것입니다. 보시다시피, 그리고 아마도 익숙하실 수도 있겠지만 상승 삼각형, 하강 삼각형, 대칭 삼각형 등과 같은 차트 패턴들이 있습니다. 이것들은 모두 차트 패턴입니다. 고전적인 기술 분석 패턴이며 저는 이러한 패턴들을 배우는 것을 강력히 추천합니다. 엘리엇 파동 이론에만 있는 것이 아닙니다. 말씀드렸듯이 이것은 고전적인 기술 분석입니다. 다행히도 저는 가장 중요한 차트 패턴들을 모두 배울 수 있는 전체 강좌를 가지고 있습니다. 영상 카드와 설명란에 해당 강좌 링크를 꼭 넣어두겠습니다. 사실 조정파동의 형태나 이러한 패턴들의 프랙탈적 특성에 대해 배우는 것보다 이 강좌가 훨씬 더 적합하다고 생각합니다. 조정파동의 형태를 더 잘 파악하고 싶다면 차트 패턴 교육 강좌를 꼭 확인해 보시길 강력히 추천합니다. 자, 기술적 분석의 가장 멋진 점 중 하나는 엘리엇 파동 이론이나 차트 패턴 같은 다양한 이론들이 있지만 사실 이 모든 것들이 본질적으로는 같은 것을 다른 방식으로 가르친다는 점입니다. 이것이 바로 기술적 분석의 매우 흥미로운 점입니다. 마지막으로 이러한 다양한 유형들이 조합되어 나타난다는 점도 언급하고 싶습니다. 즉, 항상 명확한 지그재그, 명확한 플랫, 명확한 삼각형 패턴만 보이는 것은 아닙니다. 여러 유형이 복합적으로 나타나는 경우가 많습니다. 하지만 이 부분은 강의 초반이라 자세히 다루기에는 다소 고급 내용입니다. 자, 이제 엘리엇 파동 이론의 고급 개념인 확장, 절단, 교대, 그리고 등식을 살펴보겠습니다. 다시 한번 말씀드리지만 이 용어들에 겁먹지 않으셨으면 합니다. 자세히 살펴보면 사실 비교적 간단합니다. 하지만 먼저 확장, 익스텐션부터 살펴보겠습니다. 확장이란 무엇일까요? 확장은 충격파, 임펄스 웨이브즈 중 하나, 즉 1번, 3번, 5번 파동이 분리되어 독립적 인파동 구조를 형성하는 것을 말합니다. 이렇게 되면 파동의 규모가 비정상적으로 커지게 되는데 가장 흔하게 발생하는 파동은 3번 파동입니다. 전체 파동 구조는 1, 2, 3, 4, 5로 이루어져 있습니다. 아래 이미지는 확장된 파동의 예시인데 여기서 3번 파동이 독립적 인파동으로 분리되는 것을 볼 수 있습니다. 1번 파동과 2번 파동이 있었지만 이제 3번 파동이 생겨 1, 2, 3, 4, 5로 구성된 것을 확인할 수 있습니다. 이러한 확장된 파동은 실제 시장에서 포착하기가 상당히 까다로울 수 있습니다. 하지만 이론에 이러한 내용이 포함되는 것이 중요합니다. 왜냐하면 만약 여러분이 오랫동안 거래를 해왔다면 우리가 주목하는 것은 이론과 정확히 일치하는 교과서적인 예시들이지만 실제 시장에서는 그렇게 움직이지 않는 경우가 많다는 것을 아마도 알아차렸을 것이기 때문입니다. 물론 완벽한 예시도 있지만 시장은 예측 불가능성이 매우 높은 경우가 많습니다. 따라서 파동 확장과 같은 특수한 사례들을 배우는 것이 중요합니다. 앞서 말했듯이 파동 확장은 3파동에서 가장 흔하게 나타납니다. 여기 있는 것이 3파동입니다. 하지만 1파동과 5파동에서도 발생할 수 있습니다. 1파동, 3파동, 5파동, 즉 모든 충격파동에서 말입니다. 자, 다음으로 넘어가 보겠습니다. 이것은 절단이라고 부르는 현상입니다. 아주 간단하게 설명하자면 5파동이 3파동의 끝을 돌파하지 못하는 경우입니다. 이는 추세가 약해지고 있다는 명확한 신호입니다. 그리고 이것 또한 유효한 카운트가 아닌 이유가 됩니다. 다시 한번 1, 2, 3, 4, 5번 파동이 있다고 가정해 보겠습니다. 만약 5번 파동이 3번 파동의 고점을 넘지 못한다면 이는 유효한 카운트가 아니라는 명백한 경고 신호이며 하락 반전 가능성을 시사합니다. 이것이 바로 절단 원칙입니다. 다음으로 언급하고 싶은 것은 교대 패턴입니다. 예를 들어 2번 파동이 급등하면 4번 파동은 횡보할 가능성이 높고 2번 파동이 횡보하면 4번 파동은 급등할 가능성이 높다는 것입니다. 2번 파동과 4번 파동은 일반적으로 교대로 나타납니다. 예를 들어 다시 한번 카운트 1이 있다고 가정해 보겠습니다. 2번 파동이 삼각형 형태라고 해봅시다. 그러면 2번 파동은 다음과 같은 모양일 수 있습니다. 그 다음 3번 파동이 나타납니다. 이 경우 4번 파동은 급등할 가능성이 높습니다. 흔히 여기 있는 되돌림과 저기 있는 되돌림이 모양이 번갈아 나타나는 경우가 있습니다. 만약 이쪽 되돌림이 날카로웠다면 저쪽 되돌림은 지그재그 나플렛, 삼각형 모양일 가능성이 더 높습니다. 즉, 교대 법칙은 되돌림 패턴이 번갈아 나타난다는 것입니다. 그리고 또 다른 법칙, 즉 등가 법칙이 있습니다. 이 법칙은 기본적으로 세 번째 파동이 확장될 때, 즉이 경우 파동 확장의 예시에서 볼 수 있듯이 첫 번째 파동과 다섯 번째 파동의 크기가 거의 같다는 것을 의미합니다. 따라서 이 경우 첫 번째 파동과 다섯 번째 파동의 크기가 비슷한 것을 볼 수 있습니다. 앞서 말했듯이 이것은 강의 초반에 이야기했던 손실과는 다릅니다. 손실은 반드시 성립해야 하는 조건이지만 이것은 항상 성립하는 것은 아닌 기억해두면 유용한 일반적인 규칙입니다. 자, 이제 엘리엇 파동이론과 피보나치에 대해 알아보겠습니다. 이 두 가지는 엘리엇 파동 트레이딩을 더욱 강력하고 의미 있게 만들어 더 나은 거래를 하고 더 많은 수익을 올릴 수 있도록 도와주는 중요한 요소입니다. 몇 가지 중요한 규칙을 알아야 하는데 되돌림과 확장 모두에 대해 이야기해 보겠습니다. 먼저 되돌림부터 살펴보죠. 되돌림이란 파동에서 가격이 뒤로 밀리는 구간을 말합니다. 예를 들어 1, 2, 3, 4, 5라고 할 때 되돌림은 2번 파동과 4번 파동을 의미합니다. 2번 파동은 일반적으로 1번 파동의 0.5에서 0.618만큼 되돌림합니다. 이 두 값은 매우 흔한 피보나치 값입니다. 트레이딩 뷰에서의 방법을 자세히 설명해 드리겠습니다. 그리고 여기서 4번 파동은 3번 파동의 0.382 부근에서 0으로 되돌림하는 경향이 있습니다. 좋습니다. 이제 트레이딩 뷰로 바로 넘어가 보겠습니다. 저희 커뮤니티에 계시거나 채널을 오랫동안 구독해 오신 분들은 아시겠지만 트레이딩 뷰는 제가 모든 기술적 분석에 사용하는 플랫폼입니다. 제 생각에는 요즘 최고의 트레이딩 플랫폼이라고 생각합니다. 투자 관련 기능도 있고요. 기본적으로 트레이딩과 투자에 필요한 모든 것을 갖추고 있습니다. 혹시 아직 트레이딩 뷰가 없으시다면 운이 좋으시네요. 제가 트레이딩 뷰 프리미엄 버전을 30일 동안 무료로 이용할 수 있는 특별 링크를 준비했습니다. 나중에 업그레이드를 결정하시면 $15 보너스도 받으실 수 있습니다. 자, 이제 트레이딩 뷰에서 빈 페이지를 열고 피보나치 되돌림 비율을 보여드리겠습니다. 그러려면 여기 브러쉬 탭을 클릭하고 경로를 사용하겠습니다. 이것은 엘리엇 파동 이론, 즉 동기 파동을 그리는 간단한 방법입니다. 1, 2, 3, 4, 5파동이 있다는 것을 기억하세요. 여기가 동기파동의 예입니다. 이제 우리가 집중해야 할 것은 되돌림입니다. 여기가 첫 번째 되돌림이고 여기가 두 번째 되돌림입니다. 두 번째 파동의 규칙을 기억하세요. 이 파동은 보통 0.5에서 0.618 사이로 되돌림합니다. 따라서 이 파동은 조금 더 깊게 형성될 수 있습니다. 0.5에서 0.618이 무엇을 의미하는지 궁금할 수도 있습니다. 이것은 피보나치 수열입니다. GAN에서 피보나치 도구를 열고 피보나치 되돌림을 표시해 보겠습니다. 차트에 그려보면 여러 숫자가 나타나는 것을 볼 수 있습니다. 1이라는 숫자가 있습니다. 0.786이라는 숫자가 있습니다. 여기에는 0.618도 있고 이런 식으로 계속 이어집니다. 이 숫자들은 기본적으로 백분율을 나타냅니다. 예를 들어 0.618은 60%, 즉 61.8%를 의미합니다. 0.5는 50%, 0.382는 38.2%를 의미합니다. 이런 식으로 백분율을 사용하여 되돌림을 계산합니다. 앞서 말씀드렸듯이 이번 파동은 보통 0.5에서 0.618 사이에서 되돌림이 발생합니다. 따라서 1번 파동의 저점에서 고점까지 피보나치 되돌림을 설정해야 합니다. 피보나치 되돌림은 되돌림의 깊이를 측정합니다. 일반적으로 되돌림은 0.5에서 0.618 사이입니다. 따라서 이 되돌림은 보통 이 범위 어딘가에 위치합니다. 하지만 이제 4파동도 기억해 두세요. 좀 더 명확하게 설명하기 위해 피보나치 되돌림을 그려보겠습니다. 4파동은 보통 되돌림 폭이 얕습니다. 그래서 보통 0.382까지 되돌아갑니다. 이제 3파동을 측정해야 합니다. 다시 한번 3파동의 저점과 고점을 기준으로 삼습니다. 앞서 말했듯이 되돌림은 보통 0.382 부근에서 끝납니다. 물론 실제 시장에서는 이렇게 완벽하지 않은 경우가 많습니다. 때로는 되돌림 폭이 더 얕을 수도 있고 더 깊을 수도 있습니다. 3파동은 여기서 규칙을 기억하세요. 실제로 이 지점까지 쭉 내려가도 되돌림이 유효할 수 있습니다. 하지만 1파동의 고점을 돌파하면 규칙을 어기는 것입니다. 하지만 대부분의 경우 이 지점 근처에서 끝납니다. 따라서 이것들이 피보나치 되돌림에서 가장 중요한 두 가지 규칙입니다. 자, 이제 피보나치 확장에 대해서도 이야기해야 하므로 잠시 다른 주제로 넘어가겠습니다. 피보나치 확장을 살펴보면 일반적으로 3번 파동은 1번 파동의 1.618만 큼 확장되고 5번 파동은 1번 파동과 거의 같습니다. 즉, 1번 파동과 5번 파동은 보통 거의 같거나 1번 파동에서 3번 파동까지의 움직임에 0.618만 큼 확장됩니다. 트레이딩 뷰에서 이를 명확하게 보여드리겠습니다. 네. 트레이딩 뷰에 다시 돌아와서 바로 이 동일한 파동을 볼 수 있습니다. 하지만 확장을 사용하려면 다른 도구를 사용해야 합니다. 다시 GAN 위 피보나치 도구로 이동하되 이번에는 추세 기반 피보나치 확장을 사용합니다. 여기서 가장 중요한 확장 관계는 3번 파동이 1번 파동의 약 1.618 정도에 있어야 한다는 것입니다. 이것이 적어도 최적의 시나리오입니다. 자, 이제 확장선을 그리려면 먼저 첫 번째 파동의 최저점을 기준으로 고정합니다. 첫 번째 파동의 최고점까지 끌어올린 다음 두 번째 파동의 최저점까지 내려갑니다. 여기서 제가 말씀드렸듯이 이것이 세 번째 파동입니다. 지금 제가 끌어올리고 있는 것이 바로 세 번째 파동입니다. 이 파동은 보통 1.618 정도까지 올라갑니다. 즉, 보통 여기까지 올라갑니다. 확장선 그리는 규칙을 하나만 배워야 한다면 저는 바로 이 규칙을 배우라고 추천합니다. 또 다른 규칙은 확장선 그리기 규칙과 비슷하지만 제가 측정이동이라고 부르는 것에 더 가깝습니다. 이상적인 상황에서 첫 번째 파동과 세 번째 파동은 크기가 거의 같습니다. 여기서는 그리기 도구 모음에서 사각형을 사용합니다. 첫 번째 파동의 높이를 측정하고 그 높이를 세 번째 파동까지 이동시키면 세 번째 파동의 길이가 첫 번째 파동과 거의 같다는 것을 알 수 있습니다. 하지만 여기서 기억해야 할 것은 우리가 세로축으로 측정할 때 가로축으로도 측정할 수 있다는 점입니다. 자, 다시 슬라이드로 돌아가 보겠습니다. 여기서는 시간 비율에 대해 이야기합니다. 하지만 제가 강의 초반에 강조했듯이 시간 비율보다는 확장과 되돌림을 배우는 것이 훨씬 더 중요하다고 생각합니다. 시간 비율은 기본적으로 반대 방향, 즉 가로 방향으로 측정하는 것입니다. 여기에는 몇 가지 규칙이 있습니다. 예를 들어 3파동이나 5파동은 종종 피보나치 시간 확장인 1.618, 2.618, 심지어 4.618에서 완료됩니다. 하지만 다시 한번 말씀드리지만 되돌림과 확장을 배우고 숙달하기 전까지는 시간 비율에 집중하지 않는 것이 좋습니다. 되돌림과 확장에 깊이 들어가기 전에 먼저 카운트를 익히고 숙달해야 합니다. 카운트가 가장 중요합니다. 하지만 여기서 중요한 팁은 수직 및 수평 피보나치 수열이 같은 지점에서 만날 때 신호가 더욱 강력해진다는 것입니다. 즉, 이러한 모든 신호를 일치시킬 수 있다면 분석이 더욱 견고해집니다. 좋습니다. 이제 초보자가 엘리엇 파동을 사용하여 실제로 어떻게 거래하는지 매우 중요한 부분을 살펴보겠습니다. 여기서 핵심 원칙은 엘리엇 파동을 사용하여 이미 가지고 있는 아이디어를 확인하는 것입니다. 특히 초보자에게 권장하는 것은 파동을 맹목적으로 따라가지 않는 것입니다. 예를 들어 여기에 파동을 그렸고 유효한 카운트를 찾았다고 가정해 보겠습니다. 1, 2, 3, 4, 5가 나왔습니다. 이제 조정, 즉 A, B, C 조정을 예상한다고 가정해 보겠습니다. 제가 강력히 권장하는 것은 엘리엇 파동에만 의존하지 않는 것입니다. 예를 들어 여기 고점들 사이에 다이버전스가 발견되었다고 가정해 보겠습니다. 예를 들어 MACD 지표가 반대 방향으로 움직인다고 가정해 보겠습니다. 즉, 약세 다이버전스가 발생했다는 뜻입니다. 만약 이러한 현상이 상승 파동의 고점에서 발생한다면 이는 유효한 매도 신호일 가능성이 훨씬 높아지고 숏 포지션 진입의 가능성을 시사합니다. 물론 예를 들어 슈팅 스타와 같은 약세 차트 패턴이 나타난다면 그 의미는 더욱 커집니다. 따라서 특히 초보자라면 엘리엇 파동 이론을 사용하는 것은 좋지만 가격 움직임, 일반적인 시장 구조 원칙, MACD나 RSI와 같은 지표 등 다른 신호들과 함께 활용하는 것을 강력히 추천합니다. 몇 가지 일반적인 사항을 말씀드리자면 5가지 규칙을 모두 준수하는 유효한 파동 카운트를 만들어야 합니다. 규칙이 기억나지 않는다면 해당 부분을 다시 시청하세요. 이 과정에서 가장 중요한 부분 중 하나입니다. 규칙은 법과 같으며 존중되어야 한다는 것을 기억하세요. 좀 더 고급 기술이지만 수직 및 수평 피보나치 되돌림을 모두 사용할 수도 있습니다. 여기서 수직 피보나치가 더 중요하다는 것을 명심하세요. 그리고 방금 언급했듯이 캔들스틱 확인이나 다른 가격 움직임 신호를 기다린 후 거래를 진행해야 합니다. 자, 이제 차트를 살펴보고 실제 거래 사례를 찾아보겠습니다. 현재 구글 차트의 일봉 차트입니다. 보시다시피 이 차트의 각 캔들스틱은 하루를 나타냅니다. 유효한 카운트를 찾을 수 있는지 살펴보겠습니다. 우선 이 차트는 매우 흥미롭습니다. 가장 먼저 눈에 띄는 것은 이전 사상 최고가를 돌파한 후 거대한 추세가 시작되었다는 점입니다. 보시다시피 구글은 사상 최고가를 경신했고 이 최고가를 돌파하면서 아름다운 상승 추세가 시작되었습니다. 그리고 정말 흥미로운 점은 이것이 엘리엇 파동 이론과 매우 흡사하다는 것입니다. 다시 한번 파동 경로를 살펴보면 여기에서 파동이 나타나고 되돌림이 이어집니다. 여기에서도 되돌림이 이어지고 또 다른 파동이 나타난 후 조정이 있었던 것처럼 보입니다. 이 모든 것은 엘리엇 파동 이론에 따른 것입니다. 보시다시피 1, 2, 3, 4. 다섯 번째 파동과 A, B, C 파동이 있습니다. 그렇죠. 이제 여러분은 이 차트를 어떻게 거래할 수 있을지 궁금하실 겁니다. 여러 가지 방법이 있습니다. 한 가지 방법은 바로 이 대규모 돌파 이후에 나타나는 강력한 상승 추세를 활용하는 것입니다. 이런 상황에서 거래하는 한 가지 방법은 바로 여기에서, 즉 사상 최고가를 돌파했기 때문에 새로운 추세의 시작을 예상하는 것입니다. 따라서 새로운 추세가 시작될 가능성이 높다고 볼 수 있습니다. 만약 당신이 뛰어난 트레이더라면 이러한 점을 미리 파악하고 예를 들어 이 되돌림 구간에서 거래를 시도했을 것입니다. 되돌림을 이용한 거래 방법은 여러 가지가 있습니다. 보시는 이 되돌림은 아주 좋은 패턴입니다. 차트 패턴 용어로 말하자면 이것은 흔히 말하는 불플래그 패턴입니다. 이 패턴에서는 가격이 급등한 후 이렇게 되돌림합니다. 우리가 하려는 것은 돌파를 이용한 거래입니다. 예를 들어 이 지점에서 돌파 진입을 시도할 수도 있고 좀 더 보수적인 접근 방식을 취한다면 가격이 고점을 돌파할 때까지 기다릴 수도 있습니다. 예를 들어 가능한 진입점은 바로 여기가 될 수 있습니다. 이것이 가능한 거래 전략입니다. 하지만 차트 예시를 통해 분석하는 것은 실제 시장 상황보다 훨씬 더 쉬운 이론적인 접근 방식입니다. 하지만 여기서 훨씬 더 명확하게 파악할 수 있는 또 다른 예시가 있습니다. 이 모든 카운트 후에 아시다시피 1, 2, 3, 4, 5까지 카운트가 진행됩니다. 5에 도달했을 때 가격이 조정을 일으킬 가능성을 살펴볼 수 있습니다. 전체 상승 파동이 완료되었기 때문입니다. 따라서 이 시점에서 가격 조정을 확실히 주시할 수 있습니다. 그리고 제가 이 강의에서 여러 번 언급했던 확인 신호 중 하나는 다이버전스입니다. 가장 간단한 다이버전스 신호인 RSI를 사용해 보겠습니다. 아주 간단합니다. 일반 RSI 지표를 열어보겠습니다. 설정을 변경할 필요는 없지만 분석을 개선하기 위해 설정을 변경할 수도 있습니다. 참고로 이 부분은 제 RSI 강의에서 다루고 있습니다. 여기서 가격은 더 높은 고점을 기록하지만 RSI는 더 낮은 고점을 기록하고 있다는 것을 알 수 있습니다. 그렇죠. 이것이 바로 하락 반전을 나타내는 약세 다이버전스입니다. IoT 파동 카운트의 정점에서 다이버전스가 발생했으니 두 가지 명확한 신호가 동시에 나타나고 있는 것입니다. 또 하나 주목할 점은 세 번째 파동의 끝부분에서 쇠기형 패턴이 보인다는 것입니다. 이것 역시 추세 반전을 암시하는 또 다른 신호입니다. 마지막으로 가격 움직임 신호를 살펴보면 여기서는 다크 클라우드 커버 캔들 스틱 패턴을 볼 수 있습니다. 이는 하락 반전을 나타내는 일본식 약세 캔들 스틱 패턴입니다. 이러한 모든 신호를 종합해 볼 때 가격이 하락할 때 수익을 내는 숏 포지션을 취했다고 가정해 보겠습니다. 손절매는 고점 바로 위에 설정하는 것이 일반적입니다. 참고로 캔들 스틱 패턴에 대해 더 자세히 알고 싶으시다면 제가 2시간짜리 캔들 스틱 패턴 마스터 클래스를 준비했습니다. 강력 추천합니다. 예를 들어 위험 대비 수익률을 3으로 가정했을 때 저희 거래는 이런 식으로 진행되어 상당한 수익을 확보했을 겁니다. 이건 단지 하나의 거래 예시일 뿐이지만 같은 원리를 계속 적용할 수 있습니다. A, B, C 조정 이후에는 물론 장기 포지션 등을 살펴볼 수 있겠죠. 그리고 여기서 이 움직임이 다음 파동의 첫 번째 파동일 가능성이 매우 높습니다. 하지만 엘리엇 파동 이론의 몇 가지 솔직한 단점과 진실에 대해서도 이야기해봐야 할 것 같습니다. 엘리엇 파동 이론은 분석에 매우 유용하고 도움이 될 수 있지만 단점도 분명히 존재합니다. 최근 트레이딩 뷰에서 살펴본 것처럼 파동 카운트에서 현재 위치를 아는 것은 거래 성공 가능성을 높이고 결과적으로 수익을 창출할 수 있습니다. 하지만 이 이론에도 여전히 많은 문제점이 있습니다. 장점뿐만 아니라 단점도 함께 이야기하는 것이 매우 중요하다고 생각합니다. 한 가지 단점은 두 명의 분석가, 즉 두 명의 트레이더가 동일한 차트에서 서로 다른 유효한 카운트를 도출할 수 있다는 것입니다. 엘리엇 파동 이론은 본질적으로 주관적입니다. 두 명의 트레이더가 동일한 차트를 보고도 다른 카운트를 얻을 수 있습니다. 물론 한 트레이더가 여러 규칙을 어길 수도 있지만 두 트레이더가 동일한 차트를 보고도 규칙을 어기지 않았음에도 불구하고 서로 다른 카운트를 도출할 수 있습니다. 이는 기술적 분석 전반의 문제점이기도 합니다. 두 명의 트레이더가 완전히 동일한 차트를 보고도 서로 다른 지지선과 저항선 등을 찾아낼 수 있습니다. 따라서 이는 기술적 분석의 일반적인 문제점입니다. 여기서 솔직하게 말씀드려야 할 또 한 가지는 실시간으로 파동을 세는 것이 사후의 파동을 세는 것보다 훨씬 어렵다는 것입니다. 예를 들어 제가 최근에 구글에서 보여드린 예시는 강의에서 제가 이야기해온 원리를 명확하게 보여주는 예시이기 때문에 제가 나중에 선택한 것입니다. 하지만 실제 시장에서는 훨씬 더 어려워집니다. 물론 이 강의를 시청하신 것만으로도 제 생각에는 여러분은 다른 트레이더들의 99%보다 엘리엇 파동 이론에 대해 더 많이 알고 계실 테지만 실제 시장에서 연습하는 것이 여전히 매우 중요합니다. 또한 이 이론은 동료 평가를 거친 과학적 근거가 없다는 점도 말씀드리고 싶습니다. 엘리엇 자신의 관찰에 기반한 이론입니다. 즉, 연구를 통해 검증된 것이 아닙니다. 연구하기 어려운 이유는 매우 주관적이고 재량적이기 때문입니다. 두 트레이더가 같은 차트를 보고도 서로 다른 파동 카운트를 내놓을 수 있습니다. 제가 이 강의 내내 말씀드렸듯이 제 결론과 추천은 엘리엇 파동 이론을 로드맵으로 활용하고 피보나치, 캔들스틱 패턴, RSI, MACD 같은 모멘텀 도구와 함께 사용하는 것이 가장 좋다는 것입니다. 엘리엇 파동 이론은 물론 유용하지만 가격 움직임, 시장 구조, 기타 도구와 함께 사용하는 것이 좋습니다. 자, 이제 강의가 거의 끝나가네요. 시청해주셔서 정말 감사합니다. 이 강의가 엘리엇 파동 이론을 더 잘 이해하는 데 도움이 되었거나 처음 접하셨다면 영상에 좋아요를 눌러주시면 정말 감사하겠습니다. 채널을 지원하는 가장 쉽고 빠른 방법입니다. 또한 끝까지 시청해주신 분들은 댓글에 전체 강의라고 남겨주시면 더욱 감사하겠습니다. 그건 여러분이 끝까지 시청해주셨다는 걸 알 수 있는 방법이기도 하고 또 끝까지 보지 않는 사람들을 헷갈리게 하는 방법이기도 해요. 좀 재밌잖아요. 그리고 물론 아래 댓글에 이 영상에서 어려웠던 부분이 있었는지 남겨주세요. 제가 전력 달려지고 싶은 팝은
Everything you need to know about support and resistance for trading stocks, cryptocurrencies, forex, or any other financial market. By the end of this course, you will not only be able to use support and resistance like a pro, you will also learn about multiple advanced indicators that most traders don't know about. So, hello everyone and welcome to this support and resistance trading course. Let's begin here by super quickly taking a look at what you can expect to learn from this video. So, first and foremost, we are of course going to take a look at what is support and resistance. In order to become a profitable trader, it's very important to have a good definition of support and resistance. Next, we're going to take a look at something very important, and that is how do we draw support and resistance like a pro? And your ability to draw support and resistance correctly can be the difference between being profitable on a consistent basis and really struggling. So make sure, guys, that you really pay attention to this chapter. And I will actually separate this section into two different parts because we need to know how to draw support and resistance in ranging markets, But we also, of course, need to know how to draw support and resistance in trending markets as well. You know, sometimes the market is in a trading range, or in other words, going sideways, and sometimes the market is either in an uptrend or a downtrend. And it's very important for us as traders to be able to draw out our support and resistance levels in both of these situations. After we have a solid understanding of how to draw support and resistance, we are ready to take a look at how to tell when support and resistance will break. The SNR right here is simply short for support and resistance, and I will use this throughout the course. But yeah, understanding the signs that indicates when a support or resistance level will break is of course very important, because it can be used either as a sign to exit your trade, but you can also use these signs to trade breakouts. So for example, if you have some signs that indicates that a resistance level is about to break, you can trade the break of the resistance, and this is one of the most common and effective trading strategies when it comes to support and resistance. And after we have learned about some signs that tells us, you know, when support and resistance will break, we of course also have to learn about some signs how to tell when support and resistance will instead hold. And another common trading strategy is of course to, for example, buy at a support level, expecting the level to bounce. So it's super important to know about these signs. Last but definitely not least, we're also going to take a look at some of the best support and resistance indicators, and we will do this in TradingView. So if you are a more advanced trader, I think that this chapter will be super interesting for you guys. But also if you are more of a support and resistance beginner, if you watch all of the previous chapters, you will definitely understand the last chapter as well. But alright guys, we are ready to get started. Let's start with chapter 1. What is support and resistance? Alright, so what is support and resistance? Well, a support level is an area on the chart, and this is very important. It's often an area, and we will talk more about this soon, but it is an area on the chart where a stock or cryptocurrency or forex pair typically stops falling due to increased buying pressure. So if you guys take a look at this chart right here, the first thing you can notice is that I have marked up our support level as a sort of zone. And this is because in real markets, support and resistance levels will not be perfect lines. They will pretty much all the time act more of as sort of zones or areas on the chart where the price is likely to bounce. So for example, on this chart right here, you can see that we have a support level, which is this gray area right here. And as you can see, every time the price approached this sort of support level, we actually saw a bounce. So for example, right here, we had a very, very strong bounce. We saw another strong bounce right here. And also the first sort of bounce, you can see that we had a small test here as well. But if you take a look at the sort of last test here, you can actually see that this right here was where the support level broke. And when a support level breaks, this can actually many times lead to a strong movement towards the downside. And we will talk more about this later on in this course. But for now, you only need to know that a support level is a level where the price typically, you know, stops falling. But of course, support levels will eventually break. But what about resistance? A resistance level is an area on the chart where a stock, crypto, forex, or, you know, gold or whatever you're trading typically stops rising due to increased selling pressure. So this right here is pretty much the opposite of a support level. You can see in this case, we once again have an area instead of a level. And you can see that every time the price sort of reached this area, we actually got a strong reaction to the downside. So this right here is an example of a very good resistance level. You can see we had 1, 2, and 3 strong pushes here towards the downside. And we can actually see that the third push here was actually so strong that it broke the support level. And another thing you can notice here is that when the price broke the support, right, you can see that we actually went up really quick here and tested the previous support as resistance. And this right here is a very common principle, and that is what we are going to talk about in the next chapter. So now we're ready to talk about a super common principle in trading, and that is that support can become resistance. And of course, the opposite is also true. So resistance can become support. But what do I mean by this? Well, when the price falls below a support level, the same level can later on flip and act as resistance in the future. So if you, for example, look at this chart right here, you can once again see that we have a very sort of clear support level. You can see that we had sort of one clear touch right here. We had two clear touches, three clear touches. But then right here, we saw a massive, massive breakout. And as you can see right here, when we break support and see a very strong candle, this right here, by the way, is what we call a momentum candle. When we see lots of momentum, like right here, when a support level breaks, this often indicates and sort of confirms that the support level was actually significant. Because when a significant support level breaks, it's common that the volatility will increase and that the breakout will be violent. So in this case, you can see that after the breakout, the price continued to fall down here, but eventually the bulls got control once again. And the bulls actually managed to push the price all the way up to the previous support level. But when we reached this area, the support flipped to become resistance, and after this, the price completely collapsed to the downside. And now you might, of course, wonder, why does this even happen? Well, this principle can happen because traders and investors sort of remembers the level. And another important reason is that they potentially have trading orders around this level. So remember, when we have an important support or resistance level, it's very common that traders place a lot of orders around this level. So for example, let's imagine that you are a buyer and you bought right here. Why did you buy? Well, you bought because we approach a support level. So you expected a bounce, you expected the price to go up from this point. But unfortunately, the price went completely in the other direction. The price broke the support. And later on in this course, we will talk about some signs. We actually saw lots of signs here that a potential breakout was imminent. But let's imagine that you bought right there. After this strong red candle, you are now in a losing trade. And the price continues to go down and you are just losing more and more. But eventually the price finally starts to go in your favor. But remember, you are still in a loss, and all you can think about right now is that, if I can only make back my money, I would be happy. And at what point do you actually make back your money? Well, once the price reaches this point right here, once the price reaches the level, remember, this was the level you entered, you are finally not in a loss anymore. So many traders will take this as an opportunity to, get out of the trade and sell at a plus minus zero. And when traders take profits, this leads to selling pressure. And yet another reason for selling pressure is because many traders, remember, this is a very clear level, it was a clear support. Many traders knows about the principle that supports flips to become resistance. So it's not uncommon that many traders goes short, or in other words, bet against the market at this point. And when you go short, you're actually doing something called short selling. And this right here leads to even more selling pressure. So this right here is two reasons why we can see selling pressure coming in. What you need to do in order to understand the principles of support and resistance is to try to think about it from the traders or investors' perspective. All right, so now when we have a basic understanding of what support and resistance is, we also have a basic understanding of the principle that support can flip to become resistance, and so on and so on. Now we are finally ready to take a look at how to draw support and resistance. Before we take a look at how to draw support and resistance correctly, I actually want to show you guys an example of how to not draw support and resistance. And I want you guys to take a look at this chart right here. Later on in the course, I will show you guys this exact chart, but with a sort of proper support and resistance drawings. But for now, this right here is an example of how to not draw support and resistance. If you want to, you can feel free to comment down below what is the big mistake that is happening on the chart right here. Feel free to pause the video and drop a comment. Well, the big mistake here, and this is a, very common mistake, especially for beginners, is that we are having way too many support and resistance levels. You can see we have so many levels on the chart that, when we have these many levels, we can't really do anything because we have support and resistance levels everywhere, and this can give us something called paralysis by analysis, meaning that we're having way too much information on the chart and it makes the chart harder to read. It's important to remember that our goal with technical analysis is to make the chart easier to understand and easier to read. So when the chart becomes harder to understand or harder to read, we know that we are probably making a mistake here. So for example, let's imagine that you are a trader and you are at this point right here. At first glance, this actually looks like a pretty good trading opportunity. Why? Well, we see lots of selling pressure here coming in at a resistance. You can actually see that these two candles, you can see this green candle and the red candle, also prints something called a bearish engulfing pattern. And a bearish engulfing pattern is a Japanese candlestick pattern that indicates a reversal to the downside. So here we have two bearish signals. We have a bearish engulfing pattern and we have a resistance level. So we basically have two reasons for a potential short sell. But because we have so many lines here on the chart, you might actually hesitate to take this trade. Because you can see after this engulfing pattern up here, you can see that we only have a little bit of room here before our next support level. So at this point, you might think, let's not take this trade because we have a support level right here. So because you had too many levels on the chart, you did not take this trade. But if you actually look at how this trade played out, you can actually see that this was the beginning of a very large move towards the downside, and you would have made a lot of money. But now, let's actually switch the attention and take a look at how to actually draw support and resistance levels. And what you can notice right here is that the chart I have on the bottom is actually the exact same chart as we recently looked like. But as you can see, in this case, the chart is much cleaner and much easier to read. So in order to draw support and resistance levels correctly, I actually have a support and resistance formula that I use to find my support and resistance levels. And we're going to talk about this formula step by step very soon. But before we dive into this formula, I think it's important to just mention that when it comes to support and resistance, pretty much all traders have slightly different methods. So there are not only one correct way to draw support and resistance. You can have slight variations on how you draw your support and resistance levels, but there are some principles that pretty much all traders agree with. The first principle is what we talked about earlier, that if you draw way too many support and resistance levels, this will only make the chart harder to read and it will be harder to make your analysis. So that is one principle. But now let's take a look at some other important principles when it comes to draw your support and resistance levels. And the first principle I'm doing is that you want to zoom out. So when you are trading and you're getting, too close to the chart, it can be super easy to, try to overanalyze everything. If you really try to, you can find levels that looks like potential support and resistance pretty much everywhere. So that is why the first step in my formula to draw support and resistance is to zoom out, take one step back from the chart and try to identify the levels that are super clear on the chart and that pretty much all traders can see. The next step here is, pretty much what I just recently said. What we want to do here is that we want to only draw the most obvious levels. So for example, if we take a look at the chart we have right here, we can see that the upper resistance zone is very obvious. If you zoom back, you can clearly see this resistance. We had one touch right here, and during this part, we got multiple tests of the resistance, and the sort of final nail in the coffin was this very strong reaction on the resistance area. To get a strong reaction like we saw right here, we need to have either lots of sellers or smart money stepping in and selling. So this is a great indication that we're talking about a strong resistance level. And the same thing is true with the support. We can see that we have a pretty obvious support here. Right here, we can see that the level got tested multiple times. And we can also see that the last reaction here was a very strong reaction towards the upside. So that is a good indication that we're talking about strong support. And we can also see here that after we had pretty much a crash right here, we can actually see, where did the buyers step in? Well, buyers came in multiple times at the support level. So this is yet another obvious level here on the chart. And we're actually very soon going to take a look at how this chart actually played out in the future. So stay tuned for that. But before we do that, we have some other rules you need to pay attention to. The third rule here we have already talked about actually. And that is that we want to draw zones. At least in my opinion, it's preferable to draw zones and not lines. And the reason for this is that if you draw lines on your chart, it's easy to sort of think that these levels have to be perfect. And if you draw lines on the chart, you will realize that many times the price will go either a bit higher or a bit lower. Support and resistance levels will pretty much never be perfect levels, perfect lines on the chart. Most of the times they will be zones. So why not draw zones instead of drawing lines? And we will talk about later on in this video how we can draw our zones here correctly. And last but not least, and this is super important, and this is also a principle that I think that many traders, especially educators on YouTube and so on, actually have wrong. And that is that strong bounces or reactions are more important than many bounces and reactions. So, for example, if you have watched other videos on YouTube, you will hear that many people say something like this. They will say that, the more touches we have on a support level, the stronger the support level becomes. And from my experience, this is not really true. Actually, we will talk about this later on in this video. Sometimes multiple reactions of a support can actually be a sign of weakness, and we will talk about why. But in my opinion, what we want to look out for here, rather than many bounces, is that we want to look out for very clear and strong bounces on the support or resistance. So I really prefer to see strong and clear bounces compared to sort of weak and many bounces. And why is that? Well, a strong bounce, let's say a strong bounce from a support level, that indicates that we are really seeing buying pressure at that level. But if the price comes down to a support and you only see a tiny bounce, that movement is more likely to be random, because in order to see a tiny bounce, it could actually just be normal market noise. Okay, so we have been talking about this resistance right here as a very clear resistance. We have been talking about this support right here as a very clear support. But what about this level in the middle? And this one is not as clear in my opinion, but this is still a valid level that I decided to have on the chart here. And the reason for this level is because this was a level where we saw really clear touches. So for example, first of all, we saw a touch right here. This touch was pretty clear. We saw a strong movement up and a strong reaction. But at this point in time, it's not really enough to draw a resistance or support. Then we can see that the price came down here. You can see we sort of tested this one. The resistance flipped to become support. But this was once again not really two strong touches. So still at this point, I would not really draw the level. But when we saw this final very strong reaction of this level as a resistance, now we have at least two very strong reactions as resistance right here. and we also have two smaller ones as support. So at this point, I think that we have enough information to actually include this level on the chart. All right, so now let's open up this chart in TradingView and see how these sort of support and resistance levels played out. But real quick, before we do this, I just want to give a quick shout out here to TradingView. TradingView is the charting program I use for all my technical analysis. And in my opinion, it is the best tool for both beginner traders and more advanced traders. And if you guys for some reason don't use TradingView yet, I actually have a special link that will be available both down in the description and the top comment of this video. And you can use that link to try out TradingView Premium for free for 30 days. And after the free trial, you can either decide to go for the TradingView free version. TradingView has a very good, in my opinion, free version, costs nothing at all. But if you decide to upgrade to a premium plan after your free trial, when using the link, you will also get a $15 bonus. And at the same time, you will help out the channel. But all right, guys, so now let's take a look at how this trade played out. And let's begin here by focusing on the middle line right here. Remember that we included this level because we saw a strong reaction right here. We saw two small touches right here. And then we saw yet another strong reaction. After all of these points, we had enough information to sort of include this in our chart. And what we can see is that once again, the price came down, right? Tested the support. The price came up. And once again, we saw selling pressure coming in at this level. And you can even see that the price tested it one more time. It tried to break above. We even saw this sort of massive wick all the way down here. But the sellers managed to push the price once again, holding the resistance. But eventually, we saw this massive, massive breakout, right? And you can see that this breakout even pushed above. It even pushed above this key resistance level. And as you know from before, when we see a break of an important level, this can lead to even more buying pressure because we have lots of orders around that level. So you can see that after we broke this important resistance, the price just continued to, push higher and higher and higher. And we can actually see here that this was actually the beginning of a sort of, this was actually the beginning of the Bitcoin bull run. You can see this breakout all the way down here, a break of a key resistance was the beginning of this massive, massive run. But all right, so now when you know the formula for drawing support and resistance, we are ready to take a look at more specifically how to draw support and resistance in ranging markets. Later on, we will also take a look at how to draw support and resistance in trending markets as well. And that is, of course, also very important. But let's begin here by ranging markets. And ranging markets is, as you can see here, it's pretty much when we have the price going sideways. It's not in an uptrend, it's not in a downtrend, it is in a range. And the very first principle here is that we want to identify the extreme highs and lows of the range. So once again, we want to focus on the sort of edges of the range. We don't really want to focus on the middle of the range. It's possible, as we talked about before, to find some kind of support and resistance in the middle, but it's more important. The first step is that you want to identify the high and lowest point of the range. The next step here is that we want to adjust our support and resistance zones to include as many significant touches as possible. And once again, remember from earlier in the video that it's more important to have significant touches than to have many touches. But we still, when we draw out our support and resistance zones, we first want to draw out the zones, and then we want to adjust the zones so that we include all the significant touches. And I will show you guys a real example very, very soon. And the third rule here is that support and resistance levels also exist within ranging markets. I have already mentioned this. They can exist within the markets, but they are often less significant. So when we are trading ranges, we are often focusing on either trading breakouts. So we focus on trading when the price either breaks above or breaks below the range, or we focus on trading support and resistance holding. So we are trying to trade a bounce of a support or a reaction of a resistance. It's much more rare to try to trade inside the trading range because the price action inside of trading ranges tend to be pretty random. However, there are exceptions, like the example we looked at just recently, where we can find significant levels inside the trading range and we can actually also trade these levels. All right, so now we are once again back in TradingView. And here on the chart, you can see that we have a sort of trading range, right? We can see that we are neither in an uptrend or a downtrend. The price is simply going sideways here. So how do we mark up this trading range and draw our support and resistance levels? Well, the first thing you want to do here, in order to draw a support and resistance zone, you want to head here to TradingView, you want to go to the upper left corner, and you want to press on geometric shapes right here. Then you want to go down here and you want to use this tool called rectangle. And remember from the rules here, what we want to do here, the very first step we want to do is that we want to identify the extreme highs and lows of the range. And in this case, I think the highs are very clearly visible. You can see that we, for example, have a clear high right here, and we have another clear high right here. So it's pretty clear that this is the extreme high point of the trading range. And now when we draw out our, let me choose the rectangle here. When we draw out our zones, what we want to do here is that we want to first of all include, the very highest point of both of these touches. So we draw the line, we draw the zone something like this. But what we also want to do, remember that I said that we want to adjust the level to include as many significant touches as possible. So what I'm going to do here is that I'm going to drag down the zone to this point right here. And why do I do this? Well, if I drag this zone down, you can see that I include all of these three touches right here. And I also include this touch and also this reaction right here. If you want to, in this case, we can actually make it a little bit more broader here to also include, you can see this strong red candle right here. This is actually what I would do. I would include that strong reaction as well. So now we have our resistance. Then we can drag out our resistance here on the side, something like this. So we have a trading range right here. As for the support level, it's a bit more tricky. We can look a bit to the right here, and we can see that we had this right here is, in my opinion, the most obvious touch. But we also had a touch right here, a pretty strong and significant reaction. And you can also see that the price tried to hold on this point right here. So when we draw our zone, we once again choose our rectangle tool. We are sure that we want to include this low right here. So we include that low. We also want to include the lowest point of this move. We could also include the green candle. You can see the candle that bounced right there. And then we draw our zone to the right. So this is how I would draw this trading range right here. And you can also see that when the price is here in the middle of the range, it moves up and down a lot and it's very hard to trade. So in this case, we can't really find any clear level here in the middle. A beginner trader might have tried to draw a sort of level right here because they might argue that we had some resistance, we had some, resistance right here and so on and so on. They might also try to draw another line right here and perhaps another line right here and so on and so on. But as you guys know from earlier in this video, this often just makes the chart harder to read and it will confuse you and make you take, probably make you take worse trades. And what we can notice about this trading range is that remember from earlier in the video, we talked about when we break a significant range, like we for example saw right here, we usually see a strong breakout, or at least when we see a strong breakout, that is actually a sign that this was a valid range. So you can actually see this was actually a beautiful example because you can see after we broke the range, we saw this, strong move. We also saw this strong continuation to the downside. But remember here from earlier in the video that when we break resistance, or I mean when we break support, many times this level can flip to act as resistance in the future. And this was actually exactly what happened in this case. You can see that the price came up once again to the previous support, but the support flipped to become resistance, right? And we saw a strong reaction here to the downside. All right, so now when we have a better understanding of support and resistance in ranging markets, now it's time to take a look at support and resistance in trending markets. And this right here is super, super important. And the rules for drawing support and resistance in trends is actually very different. So make sure to really pay attention. The very first rule we need to follow here in trending markets is that we want to focus on the most recent swing points. And I will talk more about what a swing point is very soon when we draw our horizontal support and resistance lines. So basically, when we have an uptrend, if this right here is an uptrend, what we want to focus here is that we want to focus on the recent swing high. So for example, this right here is a swing high, this right here is another swing high, this right here is a swing low, and this right here is a swing low. And when we draw support and resistance in trends, what we want to focus on is that we usually want to focus in uptrends, we want to focus on the recent swing high. So we usually draw out our support from the recent swing high, and then we're looking out for the potential bounce here. Remember, resistance can flip to become support here in the future. And this most recent swing high is much more significant than swing highs further back in the trend. And by the way, guys, if you want to learn more about how to identify swing highs and swing lows correctly, I actually have a full, more than 1 hour long video about market structure. In that course, you will learn everything you need to know about identifying trends and so much more. So if you have the time, I highly recommend to watch that video after you have watched this one. The next rule here is that we need to remember to adjust our support and resistance zones to improve the accuracy of these zones. And this rule right here is pretty similar to what we talked about in the ranging markets. And last but definitely not least, when it comes to trends, we can also draw sloping support and resistance, right? So we can draw sloping support and resistance line, and by doing that, we can create trend channels. So we are also gonna take a look at exactly how to draw your trend channels. But now let's jump back into TradingView and take a look at a real life example. All right, so now we're back here in TradingView. We are currently looking at a gold chart on the daily time frame. And what you hopefully can identify right away is that right here we have a very clear looking downtrend. And why is this a downtrend? Well, as we can see, we are printing consecutive lower highs. So we have lower high, lower high, lower high. And at the same time, we're printing lower lows as well. And when we are printing both lower highs and lower lows, we are in a downtrend. And in order to understand how to draw our horizontal levels, let's actually use our replay tool here and take a look at how the market would have looked like at, for example, this point right here. So if we are at this point in the market, we can actually notice that we are in the very early stage of a downtrend. Why is this? Well, we had one high right here, and then we had a lower high. So we had two lower highs. Then we had this low right here, which is pretty much some sort of double bottom right here. But then when the price broke below the recent lows, we actually know that we are in a downtrend, because when the price reverses, we will create a new low, and this will be a lower low. So we will have both lower highs and lower lows. And now, in order to draw our horizontal support and resistance levels, remember from the rules here. If we have an uptrend, we want to focus on the highs. But if we have a downtrend, we want to focus on the lows. So you can see that we have a low right here, low right here. And one could actually also use this low right here. So we use these lows to create our support and resistance zone. And once again, we want to use the rectangle tool right here. So the most important lows is this low and this low. So we want to make sure that we include these lows in the zone here. And because we have another low right here, we can actually adjust our support or resistance zone to include the most significant touches. Remember that this was another rule right here. And what we then do is that we draw our level here to the right. And the goal here is to wait for the price. Remember, to wait for the price to potentially test this level. This will not always happen, but when this happens, these can actually be good trading opportunities when the price tests this previous support to become resistance, and then many times it will continue to push down. So let's actually see how this trade played out. You can see that the price indeed went up to the level. You can see we got a strong reaction right here. By the way, this pattern you can see with this green candle right here and the red candle right here, this is what we call a bearish engulfing pattern. So here we had a candlestick pattern, an important candlestick pattern happening at a resistance level. So in this case, we had two bearish signals happening at the same time, and that can be enough to actually justify a trade. So now let's play out the price a little bit more here. You can actually see that the price once again, you can see we got a strong break here of the support. So at this point, we are definitely ready to draw out our new support and resistance level. And once again, we want to include the most significant touches. You can see in this case, we have two touches we definitely want to include right here. You can see we have one touch right here. This is the low that was created, the next low in the trend. And we actually had another touch right here. But once again, we can, in this case, actually adjust our zone to include even one more touch. Because you can see we have yet another, pretty significant touch right here. And now we once again repeat the process. So we draw our support/resistance here to the right. And now we can let the trend play out once again. You can see the price once again, we went up all the way up here to the resistance level. And once again, we can actually see this pattern happening again. You can see right here, we had another bearish engulfing pattern. You can see the sort of red candle right here engulfs the previous green one and creates a bearish engulfing pattern. By the way, guys, if you want to learn more about Japanese candlestick patterns, I have a full course on candlestick patterns. So if you have the time, I highly recommend to watch that video after you are done with this one. And actually, when we are at this point, when the trend have been starting to, really develop here, we can actually start drawing out our sloping support and resistance lines. And to do this, what we want to do here is that we want to focus on the highs. So we have a high right here, we have a high, high, and high. And then we want to use the tool right here. You can see you press trendline tools, and you want to use the tool called trendline. And then what we want to do here is that we want to connect. Oh, I don't know why it's a dotted line right here. Let me actually change this to a line. And what we want to do here is that we want to connect as many highs as possible. So you can see we can connect these two, we can connect this one as well, and we can sort of try to adjust this level to include as many significant touches as possible. But we can draw it something like this, because now we include at least 3 touches. You can see that one touch, the touch right here, is a little bit off, but this will very often be the case. You will pretty much never find trend lines where every single touch is exactly at the sloping support or resistance. And that is why it's important to look at the sloping lines not as perfect lines, but you should actually look at them more as zones. So if you want to, what you can do here actually is that you can press on the sloping line and you can copy this line and sort of draw, instead of having a line, you can try to draw a zone right here. So in this case, this right here will be your resistance zone, and this is the area we expect the price to sort of reverse the next time. And to draw the trend channel, we can actually copy this line once again. And in this case, we want to connect the lows of the trend. And once again, if you want to, you can create sort of a zone right here. So now we have a resistance zone defining the trend, and we also have a support zone right here defining the trend. When we have both a sloping resistance and a sloping support, we call this a trend channel. And now let's actually continue to play this trend out. We can see here that we once again broke below, right? We once again broke below key support right here. So we draw out our support right here. We drag the zone to the right. And here you can actually see that something very interesting happened. Here we actually, for the first time in this downtrend, we actually broke above this previous support, flipping to become resistance. So this right here is actually a sort of early warning sign that this trend might be coming to an end. But you can still see that the price is respecting the trend channel we drew right here. We still got reacted here at the top of the trend channel, but this break right here is a sort of early warning sign that this trend might be ending soon. Let's see how this played out. You can see that once again we got down here, and then the price finally broke above. We finally broke above this downward sloping resistance, and we can also see that now we actually broke the high right here. You can see we had a high and a high. We broke that point, so now the sort of downtrend is over. And when the downtrend is over, it's important here, it doesn't have to mean that the price will immediately reverse to the downside. Sometimes we will have a downtrend, and when the downtrend is over, the price can shift to, for example, go sideways after the downtrend. It doesn't have to go up right after. Sometimes it goes down, it shifts to sideways, and then we can, for example, see another downtrend coming in after this shift. But by now, you hopefully have a pretty solid understanding of how to handle support and resistance in trending markets. All right, so now when we have a good understanding of, how to draw support and resistance in trading ranges and in trending markets, now we are ready to learn about how can we tell when a support and resistance level will break. So for example, right here, you can see that we had a strong break above a resistance level. And now let's talk about what are the signs and what are the rules that indicates a breakout. These rules are very important to understand because trading breakouts, so for example, buying when the price breaks above resistance can actually be a very good trading strategy. But all right, so what are the signs and what are the rules to look out for here? Well, the first rule I'm looking out for is higher lows into resistance. So if you take a look at this chart right here, you can see that before the breakout occurred, the price printed one low and then a higher low, and then we printed yet another higher low. And when the price starts to print higher and higher lows before approaching a resistance, this actually indicates a potential breakout. And you may of course wonder, why is this the case? Well, let's think about this from a buyer's perspective. If you as a buyer are ready to buy closer and closer to the resistance level, the only reason you would actually buy here is if you expect the resistance to actually break. And you can also look at this from the seller's perspective. Remember here, in order to have a strong support or resistance, what we're looking out for here is that we want to see strong reactions away from the resistance, like for example, right here. But when we start to see sort of very shallow and weaker reactions, like right here, this basically indicates that the sellers failed to push the price down and that we are seeing lots of underlying buying pressure close to the resistance. So definitely look out for these higher lows into resistance, and the opposite is of course also true. You want to look out for lower highs into support. So let's say that, this right here is our support level, and if the price starts to move something like this, the first bounce was maybe very strong, but as the price continued here, we got weaker and weaker bounces. You can see in this market, the sellers are willing to sell closer and closer to the support, and the only reason they would sell at this level is if they expect the support to actually break. And also from a buyer's perspective in this market, it actually gets trickier and trickier to actually find a good buying opportunity here. And why is this the case? Well, You can see in order to buy here, when we have so many lower highs, you can actually see that we have many potential sort of resistance level the buyer needs to push above in order to make a strong profit. So this is yet another reason why lower highs can make it tricky for the other side of the market, and therefore this can often lead to pressure of a breakout. The last sign of a breakout here is when the price really starts getting close to the support and resistance. I usually call this that the price is hugging the support or resistance. And this is basically when the price starts to trade very near or even at the support and resistance level. So for example, right here, you can see that the price starts to get really, really close to the resistance. And this basically indicates that we don't really see a lot of selling pressure coming in. And that is yet another reason why we could see a strong breakout very soon. So now let's take a look at the exact same example, but now we are in trading view here. I'm currently looking at Ethereum on a 4-hour time frame. And let's start here by identifying our resistance level. So first of all, we can notice that we have a few pretty clear resistance touches right here. You can see we had a strong reaction right here, yet another strong reaction. We can also definitely see this as a strong reaction. Here we have the other reaction. This was the example we just recently looked at. And right here was the reaction before the breakout. So the very first thing we do here is that we use our rectangle tool to draw our resistance level. And remember from the rules earlier here, what we want to do here is that we want to include all the significant touches. Then we want to sort of adjust the level. In this case, we can adjust the level all the way down to include this touch right here. And then we drag the resistance to the right. And this right here is actually a very clear example of the principle. You can see that in the beginning, we had these strong reactions of the resistance. But after a while, the price started to print one low, higher low, higher low, higher low, higher low. And then eventually we saw this massive breakout. And here, and this is actually super interesting, if we instead analyze this chart from a sort of chart patterns perspective, we can actually see that this sort of pattern we have right here, let me actually draw out a line, try to include the touches right here. If we look at this whole chart as a sort of chart pattern, we can actually see that this right here is what we call an ascending triangle. And an ascending triangle is a bullish continuation pattern, meaning that it happens after a move towards the upside, and it indicates a continuation here towards the upside. So even the chart pattern indicates a breakout to the upside. So if you really understand the principles of support and resistance, you will sort of automatically understand chart patterns much better as well. And by the way, guys, I have a full trading course about chart patterns. So if you have the time, I highly recommend to, check that course out when you got the time. But okay, so it's very important to understand what makes a support and resistance likely to break. But it is, of course, at least as important to understand how to tell when support and resistance will hold. So how can we tell when we are, going to see a bounce of support or strong reaction of resistance? And once again, to understand this, there are a few rules and signs we need to understand. The very first thing I'm looking out for when it comes to support and resistance holding is that I want to see strong momentum to and quick rebound from the support. So if you guys take a look at the chart here to the right, you can see that we had a support touch right here. We had another support touch right here. And both of these touches showed, strong momentum. So the price went down very quick and it also went up really quick. And in order to have a high likelihood of the support actually holding, what I want to see is, for example, this right here is a perfect example because we see a very strong momentum into the support, but also very importantly, we see a strong momentum away from the support. This is a very good sign. And the opposite is, of course, also true for the resistance. We want to see strong momentum to the resistance and a quick retreat away from the resistance. So here and here are two good examples of this. And the last thing here I'm looking out for is that I want to see little time spent at the support and resistance area. So remember from the earlier signs we talked about, a sign of breakout was when the price was sort of hugging the support or resistance and sort of hovering around that level. So this is basically the opposite. We want the price to just quickly come up to the support or resistance and then shoot away. And now you might of course wonder, why does these signs indicate that it's likely that the support and resistance will hold? Well, let's take a look at this bounce right here. We can start by looking at this from a buyer's perspective. One reason it's attractive to buy at this bounce is because the move before this bounce was so strong to the downside. So on the way up here, we don't really have any clear resistance. You can see because the move was so steep, you can see that the next clear resistance is not until all the way up here. This makes it so the price can move freely and pretty quickly in this area. And also, if we look at this from the seller's perspective, because we saw such a strong bearish move right here, this means that the traders that went short from this reaction is now in a big profit. Because when you go short, you basically bet that the market will go down. So when the price starts to bounce right here, the profit of the short sellers start to decrease. And because, most traders want to, of course, protect their profits and actually win, the move towards the upside can lead to the short sellers start to lock in profit. And what happens when a short seller locks in profit? Well, this actually leads to even more buying pressure. Because when you exit a short position, you basically have to buy back your stock. So this leads to even more buying pressure. Yet another reason why moves like this often leads to support and resistance holding is because these kind of moves creates very clearly visible resistance and support level on the chart. And when you have super clear support and resistance levels, this means that many traders will look at their chart and also find these levels. So many traders will buy simply because we are at a clear support. And this can kind of become like a self-fulfilling prophecy. People are buying just because other people are buying. And this leads to, even more buying pressure. All right, so now we are back here in TradingView, and here we can see a pretty clear example of strong support and resistance levels. Remember, what we're looking out for here are these strong moves like right here, where we see a strong move to and away from the support. So right here, we have had a very nice bounce. Here we had yet another solid bounce, and right here, yet another solid bounce. So we can use these bounces to, of course, draw out our support and resistance. And we want to make sure when we draw out our support that we include all of these touches. And on the other side, we also have some very nice resistance touches. For example, right here, you can see strong move to and strong move away from the resistance. Right here, we also have a very strong move, especially away from the resistance here. So once again, we use our rectangle tool. We want to try to include all of the touches here, so this becomes a pretty, wide resistance area right here. But yeah, as you can notice here, because we had such strong moves when the price went down, this also makes it easier for the price to climb up after the move. You can see that the price doesn't really have any clear resistance until it reaches this point. And one interesting thing about when we find these sort of clear support and resistance levels is that many times we will actually notice that these levels have been significant even in the past. So if we extend this level, you can see we extend this level to the right, you can actually see that this level was pretty significant even in the past. You can see we had a strong reaction right here, strong reaction right here. You can even see that it acted as resistance all the way back here. And as for our massive resistance zone, we can actually also see that this level, it's not precise, but you can see that this was an area where the price struggled for a while right here. We also got reacted here before. So many times it can actually be a good idea to look back even further and pay attention to the sort of historic significance of the levels. All right, so now the time has come for a chapter that I really think pretty much all of you will enjoy. It doesn't matter if you are a beginner or a more advanced trader, because now we are ready to take a look at some of the best support and resistance indicators. With that said, before you watch this chapter, especially if you are a beginner, I highly recommend that you watch all of the previous chapters in this course, because in order to be able to use these support and resistance indicators effectively, it's very important to have this sort of background knowledge of support and resistance. But now, what are the indicators we're going to cover in this chapter? Well, the first indicator we're going to take a look at is something called pivot points, highs and lows. And this indicator right here can be pretty hard to use in the beginning, but don't worry, I will walk through step by step how to set this indicator up. And we will also take a look at how you can change the settings of this indicator to potentially make it even more effective. The next indicator we're going to cover here is an indicator that finds trend lines automatically. And this indicator will use the pivot points we talked about recently. It will use the pivot points to make its calculations. So before you watch that indicator, you definitely want to learn about the pivot point indicator first. And last, but definitely not least, we will take a look at an auto support and resistance indicator. And once again, this indicator will also use pivot point in its calculations. So it's important to understand the pivot point indicator, but this one can be a bit more tricky and there are a few settings we need to take a look at. So make sure to really follow that chapter step by step. All right, so let's begin here by taking a look at our first indicator. And at least in my opinion, this is definitely one of the best support and resistance indicators out there. But the indicator can be a little bit complicated in the beginning, and we will also need to change a few settings, so make sure to really pay attention. But all right, so the very first thing we want to do is to open up a clean chart in TradingView. Right now, as I'm speaking, I'm looking at Bitcoin on the daily time frame, but you can use this indicator on, pretty much all time frames. And now to open up the indicator, we want to head up here to the indicators tab in TradingView. And what we want to search for here is pivot points, and then we want to type high and low, just like this. And as you guys can see, we have multiple different pivot points, high and low indicators to use between. But the one I prefer, and this one is, often the most straightforward one, is this one at the top, simply called pivot points, high and low. So let's open this one up. And now, as you can see, multiple different high and low points has appeared here on the chart. And the very, very first thing I want to do here is that I want to go up to the settings tab for the indicator, which you can find right here. We want to make sure that we navigate to the inputs tab. And for the pivot highs and pivot lows, I actually want to change the color just like this. And I want to make the text white here. So just do a quick change like this so that we can see our pivot points more clearly. And these points right here, which you can see on the top, is what we call pivot highs. And the opposite is also true. So all of the points that are lows here are simply called pivot lows. And now, before we change the settings of this indicator to make the pivot points more significant, we of course first have to understand what is a pivot point in the first place. So what is a pivot point? Well, in very simple term, a pivot high or low is basically a candlestick that has lower highs to the left. So before the candle appeared, we want to see a lower candle, but we also need to see lower candles to the right. So if we have a candle formation that looks something like this, you can see we have a high, we have a higher high, and then we have a lower high. Then this candle right here would be a pivot point with order 1. But if we have another candle with a lower high to the right and yet another candle with a lower high to the left, then this right here is still a pivot point, but now we are talking about order 2 and so on and so on. So in simple terms, pivot points are basically significant highs and lows in the market. And now when you understand this, you will understand how we are gonna change the settings here. So first of all, if we take a look at the chart right now, you can see that we have tons tons of pivot points. You can see we have one here, here, here. You can see multiple pivot points on the chart. So to make the pivot points more significant, what we need to do here is that we need to go up once again to the settings tab for this indicator. And you once again want to make sure that you are on the inputs tab. And now I want you guys to pay attention to this pivot high and pivot low, because these right here are the settings we can change to make the pivot points more significant. But first of all, if you, for example, change all of these settings to 5, this basically means that in order to have a pivot point, we need to have 5 candles to the right and 5 candles to the left. So if you, for example, change to 5 here, you can see that we have tons of pivot points on the chart. And when we have this many pivot points, the actual points are not significant. So this is not very useful. What I like to do here, let's actually go up to the settings tab once again. What I like to do is instead increase the length of the pivot points. When we do this, you will realize that the pivot points will be so much more significant. So if we change all of these settings here to 20, you can see that now on the chart, only the most significant high and low points will appear. And now you may of course wonder, how are pivot points related to support and resistance? Well, as you guys now know from earlier in the course, the significant support and resistance levels are usually created by either strong bounces or strong reactions. So we can actually use these significant pivot highs and pivot lows to find significant support and resistance. So what I like to do here is that I like to look back historically on the chart and try to identify areas where we have lots of pivot points. So for example, if you take a look at this area right here, you can see that we have an area where we have both multiple pivot lows and multiple pivot highs. When we have so many significant pivot highs and pivot lows at the same area, that means that it's likely that this is a very significant level. So these levels I really like to mark up on my chart, and as you guys know, we like to use the rectangle tool here, and then we draw out the support and resistance. I try to draw out the support and resistance to include all of the pivot points. So as you can see, the support/resistance would have looked something like this. And as you guys can see, this right here was an amazing support and resistance area. We saw multiple bounces, both as support, and we saw multiple reactions as resistance as well. And we can actually use our replay tool here. So let's just imagine that the chart was right here. You can once again see that even before the sort of upcoming bounces came, we already knew that this was likely to be a significant level. Why? Well, because we had not only one touch, 2 touches, but 3 significant touches at this area. And let's see here if this indicator finds any other significant levels. Well, we look up a bit here, and once again, we can see that we have multiple significant pivot lows around this area. And we had, a pivot high right here, and once again, some pivot highs right here. So this makes it likely that this right here is yet another significant level. So what we do here, we try to draw some sort of resistance level to include all of these points. It will be a pretty broad one, but we want to include as many as possible. So something like this. So this area right here is actually, it's likely that we're talking about a significant area. And if we look a bit more to the right here, we can actually see that it was when Bitcoin finally managed to push above this area. This right here was actually the beginning of a massive uptrend. All right, guys, so now it's time to take a look at our second indicator. And what I recommend here is to actually combine this indicator I'm going to show you guys with the pivot point indicator we already have on the chart. So if you didn't watch the chapter about the previous indicator, I highly recommend that you watch this one before you watch this one. But the indicator we're now going to use is a trend line indicator. And the important thing about this indicator is that it uses pivot points to sort of calculate and to find the trend lines. But now guys, let's take a look at how to open up this indicator. So once again, we head up here to the indicators tab in TradingView, and now we want to search for quant like this. and then you want to search view. So quant view here is the creator, and as you guys can see, quant view has created multiple indicators. Many of these indicators are pretty solid, but one of the more popular ones is this one right here called trendline pivots. So let's open this indicator up. And in the beginning, when you first open up this indicator, you might notice that not a lot is happening. And that is because we need to change a few settings in order to make this indicator work together with our current pivot points. And remember that our pivot points is 20 to the left and 20 to the right. We changed the settings in the previous chapter. So what we now want to do is that we want to go up to the settings tab for this new indicator, and here we have multiple different settings that we can use to change up the indicator a bit here. However, to not make this video too long, this video is already getting very long here, we're only going to focus on the most important setting for now, and that is the pivot length. You can see the number right here. So currently the quant view indicator is using 9 as their calculation period. So they use pivot points based on a length of 9 to make its calculations. But remember that we use pivot points based on 20. So we want to change the pivot length here to 20. Another thing you want to make sure that you cross this show crosses right here, because this one will show you guys when we see a breakout above a trend line. We can also actually change the color of the crossed line here so you guys can see more clearly, just like this. So let's just do some basic change of settings like right here, and now we are ready to press OK. And now, as you can see, this indicator actually automatically found a trend line based on this point and this point. And you can also see that the indicator identified when the trend line broke. So you can see this green cross right here basically means that we successfully broke a trend line. And if you look back a little bit more here, we can see yet another example. For example, if we take a look at this point right here, you will notice that we identified a downward sloping trend line based on these two pivot points. And you can see that we broke out right here. You can see the green cross. And this was the beginning of a larger move here up towards our key resistance level. What you can also see if we look a bit more to the right here is that we have some trend lines that are still in play. We have one upward sloping support created by this point and this point, but you can see that so far Bitcoin is quite far away from this line, so it's still yet to be determined if Bitcoin will go down and test this level once again. Perhaps we will get a strong bounce coming in at that area, but we have yet another. We have a resistance area, right? As you can see, if we zoom in a bit here, you can see that we indeed have a resistance area created by this point and this point, right? And this resistance line is also still in play. And remember guys, because we have two significant pivot points at around this level for Bitcoin, around here, this is definitely a level I'm paying attention to right now for Bitcoin. A strong break above this level is definitely something to pay attention to. All right, so last but definitely not least, we are ready to take a look at our third indicator. And also for this indicator, I actually recommend to use it in combination with the pivot points high and low. And you can also, if you want to, use this indicator together with the trend line indicator as well. But now to open up the indicator, we once again go up here to the indicators tab in TradingView. And now what we want to search for here is support and resistance. And then I think it's called levels. So support and resistance levels with breaks. And the indicator we want to use here is the one at the top. It's the one created by LuxAlgo. LuxAlgo is, pretty famous, a famous creator of TradingView indicators. You can see that this one is very popular by this number right here. But we want to open this one up. And now, as you guys can see, multiple different blue and red lines have appeared here on the chart. The red lines here are resistance, potential resistance levels, and the blue lines here are potential support levels. But once again, with this indicator, we do want to change a few settings. So we want to head up here and press on the cogwheel, the settings tab, And here on the inputs, you can see that we now have something called left bars and right bars. And this is basically, it's a bit complicated. I don't know why they don't call it pivot points, but this is basically pivot points. So remember, for our two earlier indicators, we use 20 as our length for our pivot points. So once again, we want to change the settings here and make sure that we have 20 for left and 20 for right. You also have tons of different customization settings here in the style tab, but I don't want to dive too deep into the settings here. So all you have to do for now is to change 2020 here so that all our indicator lines up well together. So now the sort of first thing you can notice here is that now this indicator will actually find the support and resistance levels based on our pivot points. You can see that every single pivot point on the chart, both pivot highs and pivot lows, creates support and resistance. So now when you have changed the settings here for this indicator, you can actually, if you want to, we can take away our pivot point indicator here, because we will still have the same information here on the chart. So once again, now we can actually delete our zones here. So let's imagine that we just have this chart right here. In order to find significant support and resistance levels, we can use the exact same method. So now what we want to do is that we want to include as many lines as possible, right? So as many lines as possible, we want to include in our support and resistance zones. So for example, in this example, we have not only 1, 2, 3, 4, 5, 6, 7. You can see we have included multiple pivot points. So this level have definitely been, significant historically. But another pretty cool thing about this indicator, let's actually zoom in right here, is that this indicator will also give you signals when pivot points breaks. So what do I mean by this? Well, if we take a look right here, you can see that we have a significant pivot high. And what you also can notice is that this indicator generated a buy signal when the price broke below that significant high. And you can actually see that this buy signal happened, for example, much earlier compared to the buy signal that came from this pivot high and this pivot high. Remember, this buy signal is from the break of these two earlier pivot points, and many times this Lux Algo indicator will actually give earlier signals compared to the Quant View indicator. But sometimes the signals will actually be later. For example, if you take a look at this trend line, which created from these two highs, you can see that we got the break signal right here, while the signal from Lux Algo didn't come until we broke that high right there. So the signal can also be delayed. Alright, okay, so this course is actually coming to an end very soon. But before we wrap up here, I just want to thank you all so much for watching. If you guys did enjoy this course or found any kind of value, the best way to show that and at the same time helping out the channel is by simply dropping a like on the video. It just takes a few seconds and it helps out more than you think. And also, of course, if you have any kind of questions or feedback, please don't hesitate to leave a comment down below. I'm trying my very best to answer every single comment. And last but definitely not least, when you are ready to continue your trading journey, I highly recommend to check out this playlist right here. In this playlist, you will find all the educational trading courses I have made so far, and I plan to make many more in the future. So yeah, I hope to see you guys in another video very soon, but for now, take care. Ciao.
most important though is that I was patient and waited for the market to get to a major level of structure before deciding to place a trade. Now, there is a very particular way of finding major levels of support and resistance and a particular way to trade around them that actually creates money-making opportunities in any financial market. But if you get this wrong, then it's going to lead to a ton of losing trades. On the flip side of that coin, if you get this right, it could be that push you need to becoming a money-making trader. And that's why in this video, what I want to do is show you everything you need to know about trading around major levels of support and resistance. That way you can start making trades like this, have a consistent edge over the market and a consistent way to place trades based on major structure moving forward in your own trading. And that, I hope, will get you one step closer to that goal you have of becoming a professional trader. So if that sounds good, go ahead and click that like button for me. It helps out with the YouTube algorithm. Go ahead and subscribe. If you are new, click the notification bell because we come out with content like this each and every week. If you're already subscribed, then welcome back. You know what's coming. Let the intro roll. Welcome back, and the first thing we're going to talk about is what support and resistance are for those of you who are brand new. After that, we're going to dive into how to find them and properly draw them on a chart so you can actually trade around them once the market gets there. After that, I'm going to teach you what I call OTZ, or optimal trading zones. Now, these are similar to support and resistance, but they provide much more accurate trading opportunities. After that lesson, we're going to talk about how to use support and resistance on multiple time frames in order to increase the accuracy of your trading opportunities as well. And after that, we're going to dive into the entry reasons that I like to use in these zones so that by the end of the video, you have a complete grasp not only on what support and resistance are, but how you can take support and resistance into any financial market and create a consistent money-making strategy out of them. So with that said, let's start off with what is support and resistance. Support and resistance is a really simple concept. Support is an area in the market that has previously been used as support. When the market gets back down to that area, it's a likely place that the market will push that price even higher from that support level. Resistance is also a pretty simple concept. It is an area in price that once the market fell from, that once was resistance, and when the market gets back up to that area, there's a likely scenario that that level is going to act as resistance and push the market lower. Now, there are two very specific types of support and resistance we're going to talk about. What we just looked at on the chart is what is considered counter trend support and resistance. These are levels that are causing reversals in the market. As you can see, market was pushing down, reversed up. Market was pushing up, reversed down. The next type of support and resistance we're going to talk about is what's called trend continuation support and resistance. So let's dive into trend continuation support and resistance right now. Trend continuation support and resistance is when the market is trending. And what trending means is the market is making a high, a higher low, a higher high, a higher low, a higher high, and a higher low. As long as this continues, we're considered to be in an uptrend. When in an uptrend, the way we use trend continuation support and resistance levels, or one of my favorite ways to use them, is to wait for the market to break a previous high, like we have right here. Let's use a trend line for this. When that break happens, I'm going to be looking back at the previous level of resistance for possible trades. If that break happens again to this resistance level, then I'm going to be looking in that level for possible trades to the upside. So as the market trends, you will see this happen over and over. We'll get a break of resistance, a pullback to that previous resistance, and the market heading higher. A break of resistance, a pullback to that previous resistance, and the market heading higher. And this is one of the ways we use trend continuation support. We're looking at the previous resistance level to turn to support. What I want to do now is go to a bearish example of this where we're waiting for support to turn into resistance. So let's take a look at a bearish example of this before we move on. Here on the New Zealand yen, we also have a good example of bearish trend continuation support and resistance levels. Let's talk about it. So for a bearish level, we're looking for the market to head lower, pushing down to a level of support, right? The market gets supported by that level. Once that level breaks, we're looking at it as resistance to push the market lower. So in this example, we have a market pushing lower, creating that support, pushing up, breaking through that support. That's when we know, okay, this level is a level I want to look at for possible resistance if I get a pullback into it. This is how we use support and resistance for trend continuation trading. Then the market pulls back into that level, and all of a sudden we get that next push down. Now, let's continue and see what happens right here, okay? So we have, this is our previous level of support. The market just pulled back into it. Take a wild guess. Do you think the market's going up or down from this level? Let's check and see if you were right. Oh no, the market went up. Now what? Well, guess what, guys? This happens. Nothing in trading is going to be 100%, including support and resistance. What we're using this to do is help create a money-making edge over the market. I'm not talking about winning 100% of the time. I'm talking about a money-making advantage where we can actually win over 50% of the time with more than a 1-to-1 reward to risk ratio, and over a large sample size, we can make money, which is the entire point of real trading. So with that said, let's go ahead and move on now to how we draw support and resistance levels on a chart so we can trade around them. Before we even get started, I need you to make your chart look exactly like this. Just kidding. Unfortunately, though, this is what people think of whenever they think of trading around support and resistance levels. But in reality, there is no point in time when you should have more than 2 to 4 levels maximum on your chart. So what I want to do is show you how to draw these levels in to the point that you don't have a million lines just cluttering your chart. Instead, you have 2 to 4 levels that you're paying attention to at any one given time. Let's dive into that right now. Okay, so the first type of support and resistance we're going to talk about is trend continuation levels. And unfortunately, drawing in support and resistance is something that inherently is subjective. It's very difficult to have set in stone rules for support and resistance, and it's something that will come with time and experience. But for me, what I like to do is just place support and resistance levels a little bit above the bodies of the candles of that level and a little bit below the bodies of that level. So doing that gives me an area, because support and resistance are not lines on a chart. They are areas of value where the market may react from. In terms of support, the market may go up from that area. So we have to remember that we're drawing areas and not lines. The way I do that is a little bit above the bodies of those candles and a little bit below. I don't really have an objective rule. I wish I did. I wish there was a way to draw this without being confused, but that's just how it goes until you have a little more experience and practice. But the way we look for these trend continuation support and resistance levels is exactly what I'm going to teach you right now. So while we're looking for trend continuation levels, as we talked about a little bit earlier in the video, what we're waiting on is the market to be in a trend, right? We're making higher lows. We're making higher highs than previous highs. While we're doing that, and I'm going to give you a really easy way, actually right now, let me go ahead and do that. Plot a 50-period moving average on the chart. Just as a really easy, objective way to plot these levels, what you're going to do is wait for the market to make a new highest high, literally the highest high the market has made since the last time it broke above the 50-period moving average. What I mean by that, if we scroll the chart back, the last time we broke above the 50-period moving average was right in this area. We started breaking above, we pulled back, we broke above, we pulled back. The levels you're going to pay attention to are only when the market yet again breaks and closes above the highest high since the last break above the 50-period moving average. So what we're going to do is every new highest high above the 50-period moving average, we're going to plot our area of support or resistance. In this case, the way it would look is the last break, yet again, that we had above the 50-period moving average is right here. So what we would start doing after that break is we would have a zone in this area, a little bit above the bodies, a little bit below the bodies. And as you can see, the market came down, didn't quite hit that area. What's the next level we have? So as we push up higher, making new higher highs, pushing down, getting some support off the 50-period moving average, almost getting into that zone of support, breaking into what? New higher highs. As we break into those new higher highs, we look back at the previous level of resistance right here as our support level. And why do we do that? Because it is the highest high since the break of the 50-period moving average. So at this point, the way we would draw this in is we would go, okay, let me go a little bit above the bodies, Let me go a little bit below the bodies of the previous level of resistance that should turn into support. And as you can see, the market comes down to that level and pushes it higher. Again, it's not 100%, but it's a way we can get an advantage and a money-making edge over the market. We'll continue this process. As we keep pushing higher, what happens? We push up to this new high right here. We push down to the support level. We break into what? New highs. As we break into new highs, what we're going to do is plot a little bit above the bodies of the candles, a little bit below, as our next level of trend continuation support to the upside in a bullish trend like we have on the chart right now. So as you can see, yet again, the market pushes into new highs, pulls back to that previous level of resistance. That level turns into support and pushes the market higher. What happens here? Here we break through. As I said, there's nothing in trading that's going to be 100%. This is just a way to have a money-making edge. This may have been a losing trade. That's something that in trading, you will have to learn how to deal with. You'll have to manage risk correctly, and you'll have to lose trades. That's just part of it. Your job is not to win every trade, is to have some kind of advantage over the market that you're trading. And this is one of the ways we do that, is by these trend continuation, support, and resistance levels. One final example of bullish trend continuation is something we're seeing right now on the euro yen that has not happened yet. And it is the fact that we just did what? If this is our previous high and we just broke and closed above it, what are we waiting on? We're going to be waiting on the market to retest the previous high. As long as we keep trading above the 50-period moving average, we're waiting on that retest of that previous high, and then we're waiting on that level to become support, because it used to be resistance. Now, in terms of a trending market, it should become support if we're in a strong trend. So that's what we'd be looking for here on the euro yen in terms of a trend continuation level of support. This is the bullish example of trend continuation, support, and resistance. Let's dive into a bearish example right now. Okay, so take a wild guess on the chart right now. What level would you be paying attention to for possible short trades, sell trades? Because right now we're looking at a bearish trend and we're looking for levels of support to become resistance in trend continuation, support, and resistance trading. So as we look at this chart, what level do you see? What level sticks out to you as a level of support that should turn to resistance? As we push down here, what we have is a high to a low to a lower high, and then a lower low immediately afterwards. At the point that we get a lower low, similar to how we had a higher high in the bullish example, at the point that we get a lower low, what we're looking at is this previous low to become possible resistance. That previous level of support that pushed the market higher in this pullback, that previous swing low at this point, if we're in a strong trend, should become the next swing high before the market continues in that trend to the downside. So the way we would manage this in terms of drawing our trend continuation levels is we put a box slightly above the bodies of those candles, slightly below the bodies of those candles, and we would drag that box over. Let's do it like this. Let's put on market replay mode. If the market was right here, just to give you a good example of this, this is what I would have drawn in. Then I would be waiting for, in this case, the dollar Canada, which is the chart we're on, to pull back to this level. And then I'd be looking for possible short opportunities for a trend continuation trade from this trend continuation resistance, in this case, area. So now that we've talked about trend continuation areas, let's dive into counter trend areas of support and resistance. All right, so with trend continuation levels, what we're looking to do is capture the next big move out of the trend by finding the level of resistance that was just broken in a bullish trend or support that was just broken in a bearish trend. And we're trying to hop on that trend. With counter trend levels, what we're looking for is reversals. We're looking for a market that's been trending up, but it's going to find a level eventually that it goes down from. We're looking for that level to provide reversal opportunities. By far, reversals are a way to get amazing targets. What I mean by that is you can get huge reward to risk ratios by trading reversals, but it's important to know how and when to trade those reversal opportunities. So that's what we're going to talk about right now. And the way we do this is right now on the New Zealand yen. Let me just give you an example to help explain it better. On the New Zealand yen, we are about to start making new highs, right? As in where price is right now. We're going to start making new highs if this market continues going up. What I would do in this case something people get confused about, I would not look at this level to be my resistance level. This is just the latest high in an uptrend. That's not going to be your counter trend level of resistance in this case. Again, it's just the latest swing high in the uptrend we're currently in on the New Zealand yen. So what we do look for though, is we place a line. I'm going to do a horizontal line that we can see throughout historic data, right? So let's do this on the high that we were just talking about, right? Whatever the highest high above the 50-period moving average, we can use the same rule. We place a horizontal line on that high. We look back in historic data and we find the next level of resistance that this market will inevitably hit if it continues higher. So let's do that. Let's scroll the chart out and look left. And right now we're actually at that level, right? But we've already had a move down. Let me explain what I mean by that. Here we have a level of resistance. This by far is going to be that level that you look for possible reversal opportunities. But in the case of the New Zealand yen, we've already had the opportunity. It's came and gone. What I mean by that is, as you can see, the market hit this level that we just pointed out and saw that there was resistance looking left. It also created a double top and ended up reversing for a moment. That means that right now, we're not going to continue to use that level. We're going to wait for the market to get into new highs. Remember, new highs above the 50-period moving average, meaning we got to break above this. And then we're going to look for the next level up that's a resistance level. So let's look left yet again so we can look for that next level. We have a level here that we just looked at, this level. If we look up and to the left, what's the next level of resistance? Right in this area, right? So what we're going to do is plot a zone a little bit above the candles, a little bit below the candles of this resistance level. This is how we draw in our counter trend resistance. The steps I just took you through is exactly what I do to find these reversal levels. We look at the high of price. We go above the highest high price has got to in a bullish case to look for possible resistance because we're looking for reversal levels, counter trend levels. We find that next high in price, and that is the level we use as a counter trend level of resistance in this case, and as a reversal level to possibly take trades from. Let's zoom the chart out and go back over to real price so we can imagine this, and I can give you a better example. Right now, what we're looking for, this being the case, is the New Zealand yen is probably going to continue trending higher, maybe pull back to our trend continuation level, and then continue higher to the point that it reaches between the price of 80.86 and 81.36. That area is our next counter trend level of resistance because we're in a bullish trend right now. We're looking for reversals. We're looking for the market to start heading lower. And this is how we find the reversal level, is the next level of resistance. Price will inevitably hit if it pushes higher. Let's now take a look at an example of a bearish version of this. The market's heading lower. We're looking for a reversal.
trading course. And let's begin here by super quickly taking a look at what you can expect to learn from this course. The very first thing we're going to take a look at is, of course, what is the MACD? Or in other words, what is the moving average convergence divergence? It's a pretty complicated name, but don't worry, by the end of this course, you will be able to master the MACD indicator. In chapter 2, we're gonna dive deeper into how the MACD indicator actually works. Because in order to use the MACD in an effective manner, we of course need to understand exactly what the MACD indicator is telling us about the price. And since this will be such a long video, I will be able to dive much deeper compared to, for example, other videos here on YouTube. In chapter 3, we're going to take a look at the worst MACD mistakes you have to avoid. And these are mistakes that are both super common and they can also lead to devastating losses. So I highly recommend you guys to pay extra attention to this chapter. In chapter 4, it's time to talk about something super important. And that is MACD divergence. And using MACD divergence is definitely one of the best MACD trading strategies for beginners. So this is something you have to know about before you start using the MACD. Last but definitely not least, we're gonna take a look at some advanced MACD settings. So how can we change the MACD settings to potentially improve the MACD indicator and as a result improve our trading? And we will also take a look at some more advanced MACD trading strategies. So this course is meant to take you all the way from being a MACD beginner to being an advanced MACD trader. All right, so now then, what is the MACD? The MACD is a moving average based indicator, and that we can actually hear on the name. MA right here stands for moving average. And what the MACD indicator does is that it combines 3 different moving averages to measure something called momentum. And in very simple terms, you can think about momentum as the speed and direction of price movements. So if you take a look at this chart right here, you can see that we have the MACD indicator here at the bottom and the price here at the top. And for now, I'm actually only showing you guys one part of the MACD indicator, and that is something we call histograms. You can see these sort of valleys and these sort of mountains right here is what we call MACD histograms. And as I said, this is just one part of the MACD indicator, and we will talk more about the whole MACD indicator very soon. But what I want to show you guys with this example right here is how momentum affects the price. So remember, momentum is both the speed and direction of the price. So when we take a look at this chart right here, we can, for example, see that we have a price movement with these 3 candles that shows a very sharp movement towards the upside. And when we see movements like this, you will also notice when we take a look at the MACD that we see sharp movements on the MACD indicator. And while we see lots of small candles, like for example right here and right here, you will notice that the MACD indicator will also show very sort of tiny and small movements. So now we have to dive a little bit deeper into how the MACD indicator and momentum is related. So once again, here on the top, we have the price. On the bottom, we have the MACD. And for now, we are still only looking at the MACD histograms. But in order to use and understand the MACD indicator, one very important concept we need to understand is something called a momentum candle. And what is a momentum candle? Well, a momentum candle is a candlestick whose real body is at least twice the size of the previous candles. So if we have a candlestick right here that looks something like this, it can be either green or red. The white part of the candle here is the real body. So from this point to this point is the real body of the candle. And if this body is at least twice the size of the previous candles, so let's say that the previous candles look something like this, then we can define this candle right here as a momentum candle. So now guys, as a first exercise, I want you all to look at this price chart right here and see if you can identify any momentum candles. So feel free to pause the video right now and do the exercise. Well, did you find any momentum candles? Let's take a look here together. So in my opinion, the most obvious momentum candle is this strong red candle right here. We can see that the real body of the candle, so from this point to this point, is more than twice the size of this candle right here. And also, if we look at all of these small candles, we can see that it's, 4 times or even 5 times as large. So this right here is definitely a momentum candle. But what about this candle right here? Well, we can once again see that the body of this candle is actually more than twice the size of the previous candles. So this right here is yet another momentum candle. But what about, for example, this candle right here? Is this a momentum candle? Well, not really, right? If you take a look at the real body of this candle, we can see that it's not twice as large as this candle and not twice as large as this one and this one. So this green candle, I would not consider a momentum candle. But now you guys might of course wonder, why are momentum candles important when it comes to the MACD indicator in the first place? Well, momentum candles are important because they will affect the MACD indicator the most. So for example, if we take a look at the two momentum candles we recently identified, you can see that it is when we see these sort of momentum candles coming in, it is at this point the MACD indicator really starts to drop down. While during the part right here, where we pretty much see no momentum candles and the price is pretty much just going sideways, we can see that the MACD indicator is also extremely tiny. Another important thing to notice here is that even though after these momentum candles, you can see that the price continues to push down, you can actually see that the MACD indicator goes in the opposite direction. It goes slightly in the opposite direction. And to understand why this is the case, we need to dive a little bit deeper into how the MACD indicator actually works. All right, so now let's take a look at how the MACD indicator works. And as you guys can see, now we have the full MACD indicator on the screen. And the MACD consists of three parts. First, we have the MACD line, which is this blue line right here. When you use the MACD in TradingView, the standard color for the MACD line will be blue. The next part of the indicator is the signal line. And the signal line is this orange line right here. And last but not least, we have the histograms. And as you guys already know, the histograms are the valleys and mountains here on the MACD indicator. But where does the MACD line, signal line, and histogram actually come from? Well, let's begin here by the MACD line. The MACD line is calculated by taking a short-term moving average minus a longer-term moving average. And the standard settings is to take an exponential moving average, or in other words, EMA, based on 12 periods, minus an exponential moving average based on 26 periods. And by the way, guys, if you want to learn more about moving averages in general, I actually have a full 1 hour long course about moving averages. So I highly recommend to watch that video when you are done with this MACD course. But what about the orange line, the signal line? Well, the signal line is calculated by taking a simple moving average, or in other words, an SMA of the MACD line itself. So SMA 9 basically means simple moving average based on 9 periods. And because the signal line is a moving average of the MACD line, we will actually get a very important property. And that is, as long as the MACD line is above the signal line will go up. And as long as the MACD line is below the signal line, you can see that the signal line will go down. So that means that when the MACD line crosses the signal line from below, this is the point where the signal line starts to rise. And when the MACD line crosses the signal line from above, this is the point where the signal line starts to fall. And using these kind of crossovers, like right here and right here, is actually a pretty common MACD trading strategy. And we will of course talk about that later on in the course. But now then, what are the histograms? Well, the histograms are basically the distance between the MACD line and the signal line. So if you take a look at this part of the MACD right here, you can see that when the MACD line is below the signal line, the distance in between these two lines will create the histogram valley right here. But when the MACD line is above the signal line, like this whole part right here, you will see that a mountain will be created based on this distance. Same thing is true right here. Once again, we have the MACD line below the signal line, and the distance creates this whole valley. But now, there's one thing we still haven't talked about, and this can be a bit more complicated. what does it mean when the blue line crosses the line here in the middle, or in other words, what we call the zero line. So now let's dive deeper here and take a look at the MACD zero line. And this can be a little bit more advanced, so make sure to really pay attention now. But the first thing is pretty simple. The zero line is basically the line here in the middle, which separates the valleys and the mountains of the MACD indicator. But in order to understand what it means when the MACD crosses above or below this line, we need to open up a chart here. All right, guys, so now we are in TradingView. This is the site I use to find all the different price charts, and it's in TradingView I do all my technical analysis. And I know that most of you guys are already familiar with TradingView, but if you guys for some reason haven't got started with TradingView yet, I actually have a special link that you can use to try out TradingView Premium for 30 days for free. And if you, after the 30-day trial, decide that you want to upgrade, you will get a $15 bonus. So if you want to try out TradingView and at the same time supporting the channel, don't hesitate to use the link. It will be both in the description and the top comment of this video. But all right, so right now as we're speaking, I'm looking at the Bitcoin on a daily time frame. So every candlestick on this chart represents 1 day. And the first thing I want to do here is that I want to open up the MACD indicator. So to do that, we go up here to the indicators tab in TradingView. And what we want to search for here is simply MACD. And you want to go down here and open up the indicator called moving average, convergence, divergence. And in order to show you guys how the zero line works, we actually need to change a few settings. So we go down to the settings tab of the MACD indicator. And for now, I actually want to uncheck the histograms. So I don't want to show you guys the histograms, and I want to uncheck the signal line as well. Then I want to go here to the MACD line and make it a bit thicker here so that you guys can see more clearly. And now we are ready to press OK here. So as you can see, now we have a MACD indicator with only the MACD line showing. And now actually to make the zero line a bit more clear here, I want to change the zero line to a straight line, and I want to make the opacity like this and make the zero line black so you can clearly see the zero line, and press OK. So now we have the MACD line and we have a clear zero line. And now let's remember here what the MACD line actually is. The MACD line is a 12-period EMA minus a 26-period EMA. So what we want to do now is that we want to open up 2 exponential moving averages. So we search for moving average exponential, we open up one, and we want to open up another one. And now we want to go up to the settings here. So we change the first EMA, we go to inputs here, and we change the length to 12. We can also change the style here to make it a bit more clear. Let's make it, for example, purple, and we can also make it a bit bigger. Okay, now we go to the second EMA, and remember the second EMA is 26. So we change it to 26 right here. We can also change the style to make it a bit more clear. Let's change it to orange and make it a bit bigger like this, and press OK. So now we have 2 EMAs on the chart, and we also have the MACD line here in the bottom. And remember, the MACD line is calculated based on these 2 moving averages. And when we have all this on the chart, we can finally understand what the zero line means. So what you will notice if you take a look at this point right here, you can see this is the point where the MACD line crosses the zero line. And what happens at this exact point? Well, you can see that it is on this point, the purple line actually crosses the orange line, or in other words, it is at this point, the EMA 12 crosses the EMA 26. So as long as the EMA 12 is above the EMA 26, you will see that the MACD line will be above the zero line, right? So when the shorter moving average is above the longer moving average, the MACD line is above the zero line. And the same thing is true for the opposite scenario. As you can see, when the EMA 12 crosses below the EMA 26, this is the exact point where the MACD line crosses below the signal line. And I think that by simply understanding this, you will probably have a better understanding than most traders how the MACD indicator actually works. All right, so now when you have a good understanding of how the MACD indicator works, now you are ready to learn about one of the worst MACD mistakes. And remember from earlier in the course when I talked about that some traders uses the points where the MACD line crosses the signal line, like for example right here, as a buy signal, and the point where the MACD line crosses below the signal line, like right here, as a sell signal. Or another way to think about this is that every time we see a valley, this is a sell signal, and every time we see a mountain, this is a buy signal. And let's actually analyze this chart right here and see if this is a good idea. Well, if you take a look at the first cross, I hope you can see right here, you can see that after this cross appeared, the price completely collapsed here. So this was actually a good sell signal, right? But if we take a look at the next cross, when the MACD crosses from below, it's a buy signal. Let's go up here to the price. The buy signal occurred right here. Was this a good buy signal? Well, not really, right? Because after this signal, you can see that yes, we saw a tiny movement to the downside, but just shortly after, the price dipped even lower. And if you traded that move right there, you would have probably gotten stopped out and lost the trade. So this next point was not really a good trade. If we take a look at the next cross, you can see here we have a sell signal, right? So the sell signal appeared right here. And once again, this was not a good signal because just after this signal appeared, and if you went short on that move, you would have probably lost money. Let me delete some stuff on the chart so you can see a bit more clearly. We can take a look at the next buy signal. We have a buy signal right here. We go up to the price and you can see that after this signal appeared, once again, just after this signal, the price pushed down. And we can continue to look at this. You can see we have another sell signal right here. And this sell signal was once again a bad idea because the price started to push up and so on and so on. So out of all of these signals, most of these signals was false signals. We had one good signal coming in right here, and we had another good signal coming in right here. But most of these signals was bad trades. And this right here is basically one of the worst MACD mistakes. If you trade the MACD by only using the crossovers, it's actually often a bad strategy and it can accumulate large losses over time. And there are much better ways to use the MACD. And in the next chapter, we're going to talk about one of the best ways to use the MACD indicator. All right, guys, so now we are very soon ready to take a look at an amazing MACD trading strategy, which is MACD divergence. But before we can look at all of these different divergence strategies, we first need to learn about the two different types of divergences. We need to learn about the difference between histogram divergence and MACD line divergence. So basically, as I said, there are two types of MACD divergence. First of all, we have the histogram divergence. And the histogram divergence typically provides faster signals, while the other type, the MACD line divergence, can generate more significant signals. So if you guys take a look at this chart right here, you can see that we have the price on the top and we have the divergence on the bottom. And we will talk more in depth about divergence very soon. But in very simple terms, a divergence is when we see the price going in one direction and the MACD going in the other direction. We have a total of 4 different types of divergences that we will talk about soon. But for now, what I want you guys to see here is that the MACD divergence starts here earlier compared to the line divergence. So when we talk about the MACD line divergence, we are looking at the difference between this high and this high compared to this high and this high. And when we talk about the MACD histogram divergence, we talk about the difference between this high and this high, this high and this high. And as I said, for now, all you need to notice here is that these divergences will not happen at the exactly same time. Many times the histogram divergence signal will appear sooner. It's actually possible here to use both divergence types at the same time, and this can actually provide even stronger signals. But all right then, so now let's take a look at the different types of divergences and how you can trade them. And let's begin here by taking a look at the bullish divergence. As you guys can see here on the top, we have the price. So the bottom line here is the price, and the lower line here is the oscillator, which in our case is the MACD. And the reason it says oscillator right here is because divergence principles can be applied to other indicators as well. For example, the RSI indicator. And guys, I actually have a full 1 hour long course on the RSI indicator. So if you guys have the time, I highly recommend to watch that video after you have seen this one. But now let's take a look at the bullish divergence here. What we are looking out for when we're looking out for a bullish divergence is, first of all, we want to see the price printing lower lows. So for example, here we have one low and then a lower low. And at the same time, we want to see the MACD printing higher lows. And one thing that is very important, especially for beginners here, is that when we are talking about bullish divergence in general, we are always looking at the lows. So for example, we look at the low right here, we look at the low right here, low and low. It's important to not confuse the lows with the highs. When you are looking for bullish divergence, both the bullish divergence and also the hidden bullish divergence down here, you're always focusing on the lows. So if this sounds a little bit confusing right now, don't worry, divergences can be a bit tricky in the beginning, but hopefully the bullish divergence will be much more clearer after we take a look at this example. All right, so let's take a look at the bullish divergence. Here you can see we have the price on the top here, we have the MACD on the bottom. And in this case, to make the example more clear, we are only looking at the histograms. But as I said earlier, what you learn here can be applied for the MACD line as well. The first thing we want to do when identifying divergences is that we need to identify the highs and lows here of the price. So for example, you can see right here, we have a low, we have a high, low, high, and low. And as you can see, in the first case here, we have one low, and then the price prints a lower low, right? But now, if you look down to the MACD, you can see that the MACD prints one low, and then also a lower low. So in this case, we can see that the MACD and the price goes in the same direction. This right here is what we call a MACD convergence. But what about the next low? Well, if we look from this point down to this point, we can see that once again, the price prints a lower low, right? But if you take a look at the MACD, we can see that the MACD actually clearly prints a higher low. So in this case, we have lower lows on the price, higher lows on the MACD. This right here is a bullish MACD divergence and indicates a reversal to the upside. Another interesting thing I can just point out right here, do you remember what the MACD means? Well, it means moving average, and as you know, the MACD line is calculated by moving averages. But then we also have convergence, and now you know what convergence is. Convergence is this part and this part when the lows of the price and the lows of MACD goes in the same direction. And now you also know what divergence means. So now at this point in the course, you basically knows the full name of the MACD. But all right, guys, so now let's switch the attention here and take a look at the bearish divergence. And what is very important when we talk about both the bearish divergence and also the hidden bearish divergence that we will talk about later on is that when we talk about bearish divergence, we are always looking at the highs. So for example, here you can see that the price prints a higher high while the indicator, which in this case is the MACD, prints a lower high. It's important to not confuse the highs here with the lows. But now guys, let's take a look at a real life example of the bearish divergence. And now guys, let's actually make this an exercise. So if you want to, I want you guys to look at this chart and try to identify the bearish MACD divergence. If you need some help, you can of course play back the video and look at the bearish MACD divergence. But now pause the video and try it out. Did you guys manage to find the divergence? Well, let's take a look here together. First of all, let's try to analyze the highs and the lows of the price. We can see that we have a sort of low all the way down here. The price went up, printed a high. This is a bit tricky, but one could argue that we have a low right here. You can see the MACD also printed a tiny low at this point. but then we printed a higher high once again. And if we take a look from this high to this high, we can see that the price prints a higher high, right? But if we look down to the MACD indicator, we can see that we have one high and then a lower high. So we have lower highs on the MACD histogram. When we have the price printing higher highs, while at the same time the MACD is printing lower highs, this is what we call a bearish MACD divergence, and this indicates a reversal to the downside. And if you guys look very closely at the price to the right here, we can actually also see something else, right? One could argue, you can see we have a low right here, and then we have a lower low, right? If we see this as an individual low, you can actually see that the MACD all the way down here prints a higher low. So here we have one type of divergence as well. However, preferably we want the mountains to be more separated, like we for example have right here and right here. And in this other case, you can see that this sort of mountain we have right here is almost like part of a bigger mountain. So that can be one thing to have in mind. This can still be considered as a divergence, but one could argue that when the mountains are clearly separated here, the signals are more clear. So now guys, we are ready to take a look at the hidden bullish divergence. And from my own experience and also of course hearing from other traders, the hidden divergences can often be sort of much more trickier to spot. So make sure to really pay attention now. But first of all, once again, when we talk about bullish divergence, it doesn't matter if it's the regular bullish divergence or the hidden type. When we talk about bullish divergence, we're always looking at the lows. But for the hidden bullish divergence, what we want to see here is now we want the price to print one low and then a higher low, while at the same time we want the MACD to print one low and then a lower low. So as you guys can see, this is pretty much the opposite of the regular bullish divergence. Let's take a look at an example. All right, so here we once again have a chart, and the very first thing we want to do is that we want to identify the highs and lows. So all the way down here, we have a low, the price came up, printed a high, we printed another low right here, high, low, another high, a low, and so on and so on. And since we're looking out for bullish divergence, we want to focus here on the lows. So if we take a look at the first two lows here, from this point to this point, we can see that the price clearly prints a higher low. And if you switch the attention down to the MACD, you can see that we have the MACD printing one low and then also a higher low. So here we have the lows of the MACD and the lows of the price going in the same direction. This is what we call a MACD convergence. But if you take a look at the next low, we can see that from this point to this point, the price clearly prints once again a higher low. But if you go down and focus on the MACD, we can clearly see that the MACD prints a much lower low. This right here is a hidden bullish divergence and indicates a continuation here to the upside. So one key difference between hidden and regular divergence is that the hidden divergence indicates a continuation of the trend. So it indicates that the trend will continue, while remember, the regular divergence indicates a reversal. And you may wonder, why is this even a bullish signal? Shouldn't it be a bearish signal that we see, a strong negative momentum on the MACD? Well, not really. The reason this is a bullish signal is that even though we see such strong bearish momentum, the price is still maintaining higher lows. So this is basically why it's considered a bullish signal. Last but definitely not least, we have to take a look at the hidden bearish divergence. And this divergence type is very important because it can signal that a bearish trend will continue to the downside. And once again, when we look at bearish divergences, remember we are focusing on the highs. But in this case, in order to identify the hidden bearish divergence, we want to see the price printing lower highs. So we want to see lower highs on the price, while at the same time, we want the oscillator, which in our case is the MACD, we want the oscillator to print higher highs. So as you guys can see, it's pretty much the mirror image of the regular bearish divergence. So here we have an example of a bearish divergence, and we actually also have another important divergence happening on the chart. So if you guys want to, you can actually try to identify on your own both the hidden bearish divergence, but also take a look at if you can find any other type of divergence here on the charts. So pause the video right now if you want to. But all right, so let's begin here by analyzing the trend. We see in this case, we have a pretty clear and nice downtrend. We have a high, clear low. We have another high, we have another low, high, low. And if we take a look from this point to this point, we can clearly see that the price prints a lower high, right? But if you look at the MACD, we can see that the MACD has a high right here, but a higher high right here. So the MACD clearly prints a higher high, while we at the same time see a lower high on the price. So this is a bearish divergence, which indicates, remember, it indicates continuation to the downside. And after this point, you can clearly see that the trend continued here and printed lower lows. But now if we instead focus here at the lows, we can see something very interesting. We have one low, then a lower low, then yet another lower low. But if you switch your attention to the MACD, you can see that we have a low, we have a higher low, and then we have yet another higher low. So in this case, we actually have a triple divergence. And what type of divergence is this? Well, this is a triple regular bullish divergence. And we can see that after this divergence appeared, we actually saw a strong move here towards the upside. And another important tool here you can use, a good idea is to always combine divergences with other tools, such as, support and resistance, price action, and market structure. And one very important thing you can see about this move is that the price after the divergence actually broke above the resistance of this whole downtrend. Alright guys, so now we are finally ready to take a look at some of the best MACD settings. If you didn't know, the MACD indicator actually have tons of different settings that you can change to potentially improve the indicator and as a result, improve your trading. And the very first setting we're gonna take a look at is a setting popularized by Linda Raschke. This setting is also used by other professional traders like Adam Grimes. And very soon we will take a look at exactly how you can change the settings to get this special type of MACD. Next, we are going to take a look at how you can get divergence signals, and specifically I'm talking about MACD line divergence automatically. So you can use this to sit back and relax and let the indicator do its job, or you can use this to confirm your own analysis. Next up, we're going to take a look at the histogram settings. So what are the settings you need if you want to trade the MACD histograms? And last, but definitely not least, we will take a look at something called the 5-35-5 MACD. But let's begin here by Linda Raschke's settings. Alright, so now we are back here in TradingView. I'm currently looking at a British pound US dollar 1 hour chart. But you don't really have to worry about the chart, because the settings we're gonna look at you can use on pretty much all time frames. So you can use it on 5-minute candles, you can use it on 1 hour, or even daily candles. But okay, so the very first thing we want to do here is that we want to navigate up here to the indicators tab in TradingView. And we of course want to open up our MACD. So we simply search for MACD and we go here and open up the standard moving average convergence divergence. Now, to change the settings of the MACD, we want to go down here to the bottom left corner and we want to press on the settings tab right here. And then you want to make sure that we are on the inputs tab here. And this right here is the standard settings for the MACD. Remember, we have been talking about that the fast moving average is 12, the slow moving average is 26, and down here you can see it says oscillator type. And this basically means that the indicator is using an EMA, or in other words, an exponential moving average for the calculations. And these are the settings we have been using throughout the whole course so far. But we can of course change these settings. And the first setting we're going to look at here, as I said, is Linda Raschke's settings. And what we want to do here is that we actually want to change the fast length all the way down to 3. And at the same time, we want to change the slow length all the way down to 10. What this basically means is that the indicator will use, to calculate the MACD line, we will use a fast length of 3 and a slow length of 10. So this is a sort of much shorter moving averages. So we will get faster signals. However, what we also want to do here is when it comes to the moving average type, we actually want to change this one to a simple moving average. So you want to change the oscillator type to a simple moving average, and you also want to change the signal line. So remember, the signal line is the sort of moving average of the MACD line itself, and this one we also want to change to a simple moving average. And now we are almost done here, but we want to change one more setting, and that is the signal smoothing. So the signal smoothing is just basically the length of the moving average of the signal line. And we want to change this one to 16. So this right here is the exact settings you want. If you want to, you can screenshot this image to go back to later if you decide to use this setting. And what I also like to do here, especially when I'm doing educational videos, is to make the MACD line a bit thicker so you can see it more clearly. Also make the signal line here a bit thicker as well. But so now we have all the settings we need, and we are ready to go down here and press OK. So now on the bottom of the chart, we have this special type of MACD. But in order to see how this MACD is different, it can be very hard if you only look at this MACD. So let's actually open up another MACD indicator with the standard settings. So we open up a normal MACD. Now the normal MACD is here on the bottom. And to make it a bit more clear, we can change the thickness of the lines here. So we change the signal line and the normal MACD line, and we press OK. So here, the first thing you can notice, I hope you can see, is that the MACD indicators clearly look different. They are not exactly the same. They look pretty similar, and that is because the how it's calculated is pretty similar, but we use slightly different parameters here. And one of the main difference between our new settings and the standard settings is that the new settings will react faster to price movements. So to see this, for example, focus on this price movement right here. You can see if we go down to the Linda Raschke settings, you can see that the MACD indicator actually printed a low from this price movement, while if we take a look at the standard settings, you can see that we did not see a low from the standard settings. And that is because the new MACD will react faster to price movements compared to the normal MACD. And you can also see this if you focus on this specific candle right here. You can see if we go down here to our new settings, we can see that at this point, the MACD has clearly already turned green. But if we go down here to the standard settings, you can see that at this point, the MACD indicator is still in the red. So our new settings is able to catch this move earlier compared to the normal MACD. And because of this, we will be able to identify signals faster. So for example, if you focus at the MACD line from this point to this point, you can see that we clearly have a divergence, right? Because the price is printing lower lows while the MACD is printing higher lows. And as you know from earlier in this video, this is a bullish divergence and indicates a reversal to the upside. But if you look down here to the normal MACD, you can see that we still see a divergence, right? But the divergence actually appears later compared to the new settings. So now you may of course wonder, is our new settings always better compared to the normal MACD settings? Well, it actually depends. Because while the new MACD indicator gives faster signals, it can also many times give more false signals. So when you're trading using the new MACD, it's always very important to use other technical variables to support your trade. But as you guys know, when you trade using indicators, it's always important to use other technical variables such as price action and market structure to improve your trades. And especially when you use this new type of MACD that might provide more false signals, it's even more important to use confirmation to take good trades. Another signal you can notice here is that from this point to this point, you can see that the new MACD clearly prints a higher high while we are seeing lower highs on the price. And remember that this is a hidden bearish divergence indicating continuation to the downside. But if you look down here to the normal MACD, you can see that we did not even see this hidden divergence on the normal MACD. Alright guys, so now we're ready to take a look at our automatic MACD divergence settings. And to do this, we actually need to open up a special version of the MACD. So once again, we head up here to the indicators tab, and now you want to search for MACD divergence like this. And as you guys can see here in TradingView, we have tons of different MACD divergence indicators. I have been trying multiple out here, and and we have some good ones. In my opinion, the most beginner-friendly is this one called MACD Divergences by David Tech here. You can definitely also feel free to try this one by Tories. As you guys can see, this is the most popular one, but I think the one by David Tech here is the most sort of beginner-friendly one. So let's open this one up. And now you can see here on the bottom, we have the MACD indicator. And what you also can see is that this indicator automatically finds both bullish and bearish divergence on the chart. But the first thing we have to notice here is that these type of divergences are not histogram divergences. We have been talking mostly about histogram divergence in this video, but what you can see here is that all of these divergences is on the MACD line. So it's calculated from the MACD line rather than from the histogram. So here for the first bearish divergence, you can see that the price prints one high and then a higher high, while the sort of MACD line prints one high and then a slightly lower high. That is a bearish divergence that indicates a reversal to the downside. We can also see we have yet another bearish divergence here because the price prints higher highs, the MACD prints lower highs, so that is yet another divergence. And we also have a sort of small bullish divergence here because we have one low and then a slightly lower low here on the price, while the MACD prints a slightly higher low, so that is a bullish divergence indicating a reversal to the upside. So this indicator can definitely be a good tool to use to identify divergences. However, there are a few important sort of complications with this indicator. And to see this, let's open up the settings tab for this indicator. The first thing I noticed is that these signals, these divergence signals, appears pretty late here. So it takes up to 5 candlesticks before the divergences confirms. And that can, for some people, that is a bad thing. You will often hear people in YouTube comments talking about, is this a lagging indicator or not? And to be honest, all indicators are lagging in some sense because all indicators use price data to make its calculations. So the calculations will always be sort of slightly delayed compared to reading pure price action. But what you can see here on the settings tab, if you go down here to the bottom, we have a min look back range. And changing this range here should make the signals appear more clearly. This you cannot see on the chart, but when you trade in live markets, you will be able to see that. So we can change this one all the way down to 1 if you want as fast signals as possible. But also here, if you look at the pivot look back right and pivot look back left, unfortunately on the description page for this indicator, it's not super clear what it is, but I'm pretty sure this is the order of the pivot points that the MACD uses to base its calculations. So for example, if we decrease this pivot look back right, let's decrease it all the way down to 1, and the pivot look back all the way down to 1 here, we should be able to see more signals. So as you can see here on the chart now, we have many sort of super tiny divergences. You can see we have a super tiny divergence there, super tiny divergence there. So we can get much more signals by changing that length. But I think that that is a bad idea because you will see, let me delete this, because when you change this all the way down to 1, you will see so many false signals. So let's actually change this one back to 5 and 5. So my thoughts about this indicator is that yes, it can be a good tool to use to find divergences automatically, but I personally definitely think that it is superior to be able to identify your divergences on your own. That way you can avoid many false signals and also focus on the significant signals. So now we are ready to take a look at the MACD histogram settings. And to do this, we once again, now we want to go up to the indicators tab and we want to open up the standard MACD. So we want to open the moving average, convergence, divergence. And to change the settings here, we go down to the settings tab for the MACD. And here, in order to get only the histograms on your MACD, you want to go here to the Styles tab, and you want to simply uncheck the MACD, and you want to simply uncheck the signal line. So right now, we only have the histograms here on the chart. But if you think that histograms are a bit more confusing compared to a line, one sort of tip or trick you can actually do here is that you can change all of these colors to black. So you change all of the colors to black here, and you can actually change so that the histograms becomes a line. So if you press the line right here, you can now see, and then we press OK, you can now see that we have a line that represents the MACD histograms. And this is a pretty, I think that this is a pretty clean way to use the MACD. So for example, if you look at this low compared to this low, we can see that the price is printing a lower low, right? While on the MACD, we have one low, and here on the next low, we can see that we have a much higher low. So this is a case where we see lower lows on the price, while we see higher lows on the indicators, right? A bullish divergence indicating a reversal to the upside. Once again, we can look out for more divergences. So for example, right here, we have a high and we have a lower high. Look down to the MACD histogram line. We have a high and we have a higher high. So we have lower highs on the price, higher highs on the MACD. This is, remember, a hidden bearish divergence indicating continuation to the downside. All right, so last but definitely not least, let's take a look at the 535.5 MACD. And once again, we want to go up here to the indicators tab in TradingView, and we want to open up the standard MACD. So we search MACD and we open up the moving average, convergence, divergence. Next, we want to go down here to the settings tab, and you want to make sure that we are on the inputs tab right here. So for the 535.5 MACD, you can probably hear on the name what settings we're going to use here. For the fast length, we want to use 5. For the slow length, we want to use 35, and for the signal smoothing, we want to use 5. So the first thing we can notice here is that the fast length is much faster than usual, and the signal smoothing is also much faster compared to the normal MACD. However, the slow length, so the slow moving average, is actually a bit longer. We can also go to the style here, change the MACD to a bit thicker, the signal line to a bit thicker, and let's press OK here. So you may wonder, how does this affect the MACD indicator? Well, the first thing we can notice is if you guys focus on the histograms right here, you can see that it looks like the histograms goes much more sort of up and down. It hovers around the 0 line much more compared to the normal MACD. And that is because the MACD line in this case, so the blue line, you can see the blue line moves up and down a lot. And that is because the fast length is so fast. It's only based on 5 periods compared to 12 periods for the normal MACD. And because the MACD histograms moves up and down a lot, I recommend that when you use this kind of setting, you should not focus on the histogram, but you should rather focus on the MACD line itself. To do this, we want to head to the settings tab once again. And for this specific type of MACD, I think it's much better to use the line instead of the histogram. So I'm going to simply, uncheck the histograms right here. If you want to, you can actually also uncheck the signal line here. So we only have the MACD line. So now we have a pure MACD line that is more sensitive to recent price movement, so it can react faster and in that way provide faster signals. And since we removed the histogram, we can avoid the sort of false signals that the histogram produce. So once again, this is the same chart as before, and you can see that this type of MACD identified the same type of divergences. We had the bullish divergence right there, and we, for example, had the hidden divergence right here and right here. So now we have been talking about, multiple different MACD settings, and we have been talking about divergences, how to use the MACD, and so on and so on. But in order to build an actual trading strategy, what we want to do is that we want to combine the MACD with other technical variables. So now let's use the same chart here and take a look at a sort of trading example. So how could we have approached this chart right here? Well, the first thing, and what I always like to do, is to look at the market structure. And in this case, we can see that we had a, perfect example of a downtrend. You can see that we printed very clear lower lows, very clear lower highs. And this is, about as perfect as a trend can be. So in this case, we can, for example, use our trend line tool here in TradingView to define this downtrend. You can see we can draw a sort of line like this. If you click on this line and click Control C and then Control V, we can get the exact same slope of the line, and we can define the lower range of this downtrend as well. And here we actually had an interesting opportunity. You can see that before this trend ended, we had one low, pretty much 2 and 3 lows here coming in at the same level. But if we look here at the MACD, and remember now we have the 535.5 MACD, you can see that the MACD printed higher lows. And this is actually also a type of divergence that we haven't talking about in this video. This video would have been, too long if we really covered, everything. But another type of divergence is when we have lows at the same level and higher lows on the indicator. So here we actually had a bullish divergence signal. What you also can see with this move right here is that we had two sort of bullish candlestick patterns. It's hard to see now, but we had a hammer and we had a bullish engulfing pattern. And also, and this is even more importantly, we can actually see that with this move right here, we actually broke the trend channel. The best entry right here could have been this candle right here. You can see this strong momentum candle that really confirmed the break of this trend. So as a trading example, we could have entered a long position at this break right here because we saw divergence, we saw bullish candlestick patterns, and we saw the break of the trend. And here, since we have 3 lows at the same level, we can get a pretty clear stop loss. So we can set the stop loss below the lows right there. As for your target, a very common risk to reward ratio is to target a 2 to 1. And this basically means that the reward you get from the trade is twice as much as what you lose if you lose the trade. So this right here could have been a trade. And another common target level is a 1.5 risk to reward. Then you would have locked in your profits a bit earlier here, but you would have missed out on some gains. But all right, guys, so this course is actually coming to an end very soon. But before we wrap up, I want to say a few things. First of all, I want to thank you all so much for watching. There are tons of different YouTube videos to choose between, so I'm honored that you chose to watch this course. And also, guys, if you made it all the way here and you feel like you found any kind of help or value from this course, it would really mean a lot if you can show that by dropping a like on the video. It helps out more than you think. And also, guys, of course, if you have any questions regarding this course or any kind of feedback, please don't hesitate to leave a comment down below. I'm trying my very, very best to answer every single comment. And also, guys, if you don't have anything specific to comment, feel free to just say something like "made it till the end." Dropping any kind of comment actually helps out a lot with the YouTube algorithm to push this video out to more people. And last but definitely not least, if you guys want to, continue to improve as a trader, I highly recommend that you check out this playlist right here. In this playlist, you can find all the educational trading courses I have made so far, and more videos are coming very soon. So yeah, I hope to see you guys in another video soon, but for now, take care. Ciao, ciao.
뵙기를 기대합니다.
In this free video course, you will learn everything you need to know about trading with Fibonacci. Whether you are trading stocks, crypto, forex, or any other market, this video is designed to take you from a Fibonacci beginner to a Fibonacci expert. Hello everyone and welcome to this Fibonacci trading course. Let's begin here by taking a look at what you can expect to learn in this video. The very first thing we're going to take a look at is, of course, what is Fibonacci? And we will, of course, take a look at what is Fibonacci in trading, but we will also very briefly take a look at Fibonacci in nature, because the Fibonacci pattern is not only something that appears in trading and on our price charts, it actually appears in many natural phenomena as well, and that is super fascinating. In the next chapter, we're gonna dive deep into how the Fibonacci tool works. So for example, what does all of these numbers actually mean? And where do the numbers even come from? We will also take a look at why these numbers are important and how they can improve our trading. In the next chapter, chapter 3, we will take a look at how to use Fibonacci retracement. The Fibonacci retracement is one of the most common methods to use the Fibonacci, and it can help us find great buy signals in the market. But we will also, of course, take a look at how to use Fibonacci extension. Fibonacci extension is more about finding price targets, while Fibonacci retracement is more about finding entries. And we will, of course, cover both of these step by step. In chapter 5, we will cover 3 specific Fibonacci concepts that you need to know about. We will take a look at the golden zone, the golden pocket, and also something called 0.382 to 0.5. To master Fibonacci, these are 3 things you need to know about, but don't worry, we will go over all of these 3 step by step. And last, but definitely not least, we will take a look at some advanced Fibonacci settings and some advanced Fibonacci trading strategies. So before you watch chapter 6, I highly recommend that you watch all of the previous chapters. I have built this course in a sort of step-by-step manner, so you will understand every chapter better by watching the previous chapters. But alright, so let's begin by asking the very important question, what is Fibonacci? Well, the Fibonacci pattern is a sequence of numbers that can be found everywhere. And the pattern was introduced to the Western world by Leonardo Fibonacci. And right here you can see an image of Fibonacci himself. But now, what is this sequence of numbers and why is it so important? Well, if you focus here on the image to the left, you will soon realize that the sequence is actually pretty simple. I hope you can see, but the first 2 numbers here are 1 and 1. And if we add these numbers together, we will get 2. And now, if we add 1 and 2 together, we will get 3. To get the next Fibonacci number, we add the 2 previous numbers, so we add 2 and 3 to get 5. What happens if we add 3 and 5? We get 8. And by now, you can hopefully see the pattern. To get the next number, we add 5 and 8, and we get 13. And this pattern goes on and on, so if we add 8 and 13, we will get 21, and so on and so on. And here's where it gets interesting. This pattern can be found everywhere. So for example, if you take a look at the first image right here, which is some kind of shell, you can see that it's super similar to the Fibonacci pattern. And it turns out that the structure of the shell is actually built upon the Fibonacci sequence. But this pattern can also be found in, galaxies. We find the pattern in hurricanes, in, this is some kind of plant. And this thing as well, which I, don't know the English name for. So the Fibonacci pattern is found in nature, but it's also found in the charts. So now let's dive a little bit deeper into Fibonacci in trading. So now then, what is Fibonacci in trading? Well, when it comes to trading, we are talking about something called Fibonacci ratios. And the Fibonacci ratios are found in all financial markets. So it doesn't matter if you trade crypto, forex, or whatever other financial market, you can find these Fibonacci ratios everywhere. But what do I mean when I talk about Fibonacci ratios? Well, if you are already a little bit familiar with Fibonacci, this number right here might sound familiar, 0.618, And this number right here might also sound familiar, 0.382. These are two very important Fibonacci ratios, and by the end of this video, you will know why they are so important. But for now, let's take a look at where does these numbers even come from. Well, to get 0.618, what you do is that you take any Fibonacci number and you also take the previous Fibonacci number. Then you divide the smaller number with the larger number and you will get this ratio right here. And to get the 0.382, you do the exact same thing, but you go 2 steps down and take this number divided by the larger Fibonacci number, and you will get 0.382. And these ratios will become more and more accurate the larger the Fibonacci number you choose. And now let's focus a little bit on the image here to the left. You can, for example, see that we have the 0.382 number right here, and we have the 0.618 number right here. And you can see that in this particular case, the price went up here, the price came down, and it actually reversed just in between the 0.382 to 0.618, and then the price continued here towards the upside. And this right here is very important and something we will talk about later on in this course. Okay, so now we're ready to take a look at how the Fibonacci tool works. And to show you guys the Fibonacci tool, I will be using TradingView, which in my opinion is the best charting program. It's great both for beginners and for more advanced traders. So if you guys for some reason haven't signed up to TradingView yet, I will make sure to leave a link to TradingView both in the pinned comment and the description. You can use the link to sign up for free. You can also try TradingView Premium for free for 30 days if you feel like it. And if you later on decide to buy a plan, you will actually get a small bonus. But now let's open up TradingView and take a look at how the Fibonacci tool works. All right, so now we are in TradingView and we are looking here at Bitcoin on a daily time frame. So here on the chart, every candlestick represents 1 day. And to open up the Fibonacci tool, what you want to do here is that you want to go up to the upper left corner. You want to press this button right here where it says Gann and Fibonacci tools. And you want to open up the tool right here, which is called Fib Retracement. This right here is the most common tool. Later on in this video, we will also take a look at the trend-based Fibonacci extension. This one is also very important, so let's start this one for now. We also actually have some other Fibonacci tools right here as well, but these two at the top are the most important ones, and especially the Fibonacci retracement. So now let's open up the Fibonacci retracement right here. And for now, let's actually just go to a blank spot here on the chart. And to use your Fibonacci tool, you want to make sure that you click on this button right here so that it's blue. Then you want to press on one spot on the chart and you want to drag the tool and press on another spot on the chart. And now, as you can see, multiple lines here, multiple levels and zones has appeared. And to make this tool a little bit more clear, I'm actually gonna change a few settings. So I'm gonna go up here to the settings tab and I'm just gonna increase the font size here by a bit so you guys can see the numbers more clearly here. Because the very first thing we need to understand is, of course, what does these numbers right here on the left, so we have a 0, 0.236, 0.382, 0.5, and so on, what does these numbers actually mean? Well, these numbers right here are basically percentages. So for example, 0.236 simply means 23.6%. And you may of course wonder, 23.6% of what? Well, remember we drag the tool from this point all the way up to this point. And 23.6% basically means that from this point down to this point, this length right here is 23.6% of this length right here. And the next number is 0.382. By the way, this number is more important than the 0.236, and I will talk about that soon. But 0.382 basically means 38.2%. And that means that this length right here is 38.2% of this whole length right here. And this number right here, 0.5, is actually special because this is not a Fibonacci number. but this one is still a standard number here on the Fibonacci tool. And the 0.5 number basically comes from simple geometry. 0.5 simply means 50%, and that is because this move right here down to this point is 50% of the whole move. And now you probably get the point. The 0.618 is also a very important number, very important Fibonacci number, and it means 61.8% because this move right here is 61.8% of this move right here. And now you probably get the point, so we don't have to do all the numbers. But yeah, guys, now you already know how the Fibonacci tool works. So now when we know how the Fibonacci tool works, we are ready to learn about Fibonacci retracement. And to learn Fibonacci retracement, we first of all, of course, need to know what a retracement is in the first place. And as you guys can see, right here, we have a candlestick chart. Right now, it looks a little bit confusing, but don't worry, it will be very clear soon. And now, to understand what a true retracement is, we first need to know about something called swing highs and swing lows. And learning how to identify trends and swing highs and swing lows is something called market structure. And I have actually already made a full 1.5 hour long video course here on YouTube where you will learn everything you need to know about market structure. And if you do have the time, I actually highly recommend that you watch that video after you have seen this one. But in super simple terms, the swing highs and swing lows are basically the most clear highs and lows in a trend. So for example, right here, you can hopefully clearly see that we are in an uptrend. And this right here is a swing high. This right here is a swing high. We also have a swing low right here. We have a swing low right here. And we have a swing low right here. But as I said, it takes some time and practice to be able to identify these points correctly. So that's why I really do recommend that you watch the market structure course after this video. But a retracement is basically the move here which goes in the opposite direction of the trend. So the retracements here are this move right here and this move right here. And we use the Fibonacci retracement to predict how low the price will go before the next swing move. And here you can see something super interesting. You see we had the first impulsive move up. The price actually came down to this area right here, the 0.382 to 0.5. And this is, by the way, one of my personal favorite retracement areas. And I will talk about why later on in this video. But you can see that the price came down to this area, and then we saw the next strong move towards the upside. Once again, the price came down, right? It came down to this area right here before we saw the next move here towards the upside. So the Fibonacci retracement is all about finding areas on the chart where the price is likely to reverse and continue the trend. We use the Fibonacci retracement to find entry levels in trends. So now we need to talk about something super important and something that I see, especially beginner traders struggle with. And that is, of course, how do we draw our Fibonacci retracements correctly? So now we're back here inside TradingView, and we are once again looking here at Bitcoin. And to draw your Fibonacci levels, remember, you want to go up here and make sure that you choose the Fibonacci retracement right here. And to draw your Fibonacci retracement in an uptrend, the first thing you need to identify is that you need to find a swing low and a swing high. So if we take a look at this chart right here, we can see that we have a swing low all the way down here, and we have a swing high all the way up here. And here you actually have two different methods you can use to draw your Fibonacci. And the most important here, it doesn't really matter which method you choose. The most important part here is that you are consistent. So the first way here is to start your Fibonacci from the lowest wick, the lowest candlestick wick of the swing low, and you drag your Fibonacci up here to the highest point of the swing high, the highest wick, and then you drag your Fibonacci here to the right. So this right here is the first method. The second method here is that you start your Fibonacci on the lowest candle close of the swing low, and you drag your Fibonacci up here to the highest candle close of the swing high, and then you drag your Fibonacci here to the right. And as you can see, in this case, the price went up, the price came down here to our Fibonacci area, and then we exploded higher. Once again, we can repeat this process. So right here, we have a swing low, we have a swing high, swing low, swing high, and so on and so on. And let's use the second method. So we drag from candle close to candle close. In this case, you can once again see that the price came up here. We came down to our 0.382 to 0.5, and then the price went higher. Once again, we use our Fibonacci from swing low to swing high. And as you guys can see, once again, the price came up here, the price came down. This time, we actually came down to the 0.618 to 0.5 level, and then the price saw a bounce here. So as I said, guys, you can either use wick to wick or close to close. It doesn't really matter too much, but make sure that you are consistent with your usage. So don't use wick to wick on one swing and then use close to close on another swing. Make sure that you are consistent with your own analysis. All right, so now what we know about Fibonacci retracements, we are ready to learn about Fibonacci extensions. And Fibonacci extensions is, at least for many people, often harder to understand than Fibonacci retracements. So make sure to really pay attention now. For Fibonacci extensions, what we are essentially looking out for here is target levels. So remember, the Fibonacci retracement were all about finding entry points, and we can use our Fibonacci extensions to find targets. And to identify Fibonacci extensions correctly, it's once again important to be able to identify swing highs and swing lows. So for example, if you guys take a look at this chart right here, we had a swing low down here, and right here we printed a swing high. And one interesting thing you can already notice here is that the price seem to, multiple times reverse at this key level. You can see here at the 0.786, the price pulled back. Then the price went up here to the 1 level. The 1 level is a very important level, and we will talk more about that later on in this video. But you can see the price went up here to the 1 level, and at this point, we got multiple strong reactions. Then once again, the price came down here, and then it pushed all the way up here to the 1.618. And this 618 number is probably by now very familiar. That number comes from the Fibonacci sequence we talked about earlier. And this was the point the price reversed. So now let's switch the attention and take a look at how do we draw up our Fibonacci extensions correctly? What does the numbers mean, and which levels here are the most important? So now we're back here in TradingView, and to open up the Fibonacci extension tool, now you want to head up here once again to where it says GAN and Fibonacci tools. You press on this button right here, and now we want to choose the trend-based Fib extension. So make sure that you choose this one right here. And just as for the Fibonacci retracement, the very first thing we need to do here is that we need to identify our swing highs and swing lows. Or in other words, we need to identify an impulsive move. So right here, you can see that we have a swing low. Once again, if you want to learn more about how to actually identify these points, I highly recommend that you check out the market structure course. I know I have been saying this multiple times, but I really do recommend that video. But here we have a swing low. The price pushes up here to our swing high. What we then need to do, make sure that you have the trend-based Fibonacci checked here. And now we want to drag. Once again, you can do this in two different methods. You can either use from the candlestick wick to candlestick wick, or we can use our points from the real body of the candle to the real body. And we have already been talking about this, so I will not go into detail. But in this case, we have to go from the swing low. We press on the swing low first time, then we press on the highest point of the swing high. But what we now need to do for the extensions here is that we now need to go down here to the swing low. We want this impulsive move, so the first swing low to swing high. If we copy this exact move and drag it from the low of the pullback, we want this move to go all the way up here to the 1 level. And the 1 level right here is a very common area for traders to take profits. When we measure the move, like we did, for example, right here and right here, this is something we call a measured move objective. And this is a very common method to take targets when you use, for example, chart patterns. And by the way, guys, if you want to learn more about chart patterns, I do have a full 1 hour long course about that. And I will make sure to leave a link to that course somewhere up in the corner in the eye. But okay, so now when we know how to draw our extensions, we can actually draw this one a little bit more to the right here. Now let's take a look at what these numbers actually mean. And so you guys can see more clearly here, I'm just quickly gonna change the settings, make the numbers a bit larger, and press OK. So now, just as for the retracement, these numbers right here are basically percentages. So for example, this number right here, where it says 0.786 means 78.6%. This number right here means 61.8%. This part right here is 50%, and so on and so on. But now these numbers actually tell us a slightly different thing compared to the retracement. So because of basic geometry, that this move is the same length as this move, these numbers will basically tell us how close are we to the one number, or in other words, how close are we to the 100% measured move objective. So for example, 0.786 means that the price have gone up 78.6% to the measured move objective. The one number here means that the price have gone up 100%, or in other words, we have reached the measured move objective. But what about the higher numbers, such as 1.618? Well, the same principle is true here. The 1.618 basically means that we have now surpassed the measured move objective by 61.8%. And this level right here is yet another common level for traders to take targets, and many times we will see the price reverse at this level. Later on in this video, we will talk about how you can change the settings here to choose the most significant Fibonacci extension numbers. But for now, understanding what the numbers actually mean is everything you need to know. All right, so now the time has finally come here to talk about the golden zone. And if you are a little bit familiar with Fibonacci, you might have heard about the golden zone. But what is the golden zone and why is it important? Well, the golden zone is simply the Fibonacci area between 0.5 and 0.618. Or at least this is the most common definition of the golden zone. And it's actually considered to be one of the best Fibonacci levels. Later on in this video, I will talk about another zone that, at least for me personally, is at least as good as the golden zone. But the golden zone is great and is important to know about. But now you guys may be wondering here, why is the golden zone between 0.5 and 0.618? What is the reason behind these numbers? Well, the 0.5 level is derived from basic geometry. So for example, if you imagine that this right here is our impulse move between the swing low and swing high, the 0.5 level is basically 50% of this move. And in many trends, the impulse moves and pullbacks will be about the same length. And the implication of this is that many times the price will reverse around this 0.5 level. But what about the 0.618 number? Well, earlier in this course, we have already been talking a bit about this, but the 0.618 basically comes from, this is just a fancy, mathematical expression. It's n minus 1 divided by n, where n is a Fibonacci number. The reason I wrote the mathematical expression here is just because I don't have a lot of space to write it with text. But basically, you can choose any Fibonacci number and you take the previous Fibonacci number of the number you chose here, and then you divide it by the Fibonacci number you chose. And this is where the 0.618 comes from. And as we have been talking about, this number is not only found in financial markets, you can also find it in many natural phenomena as well. So just to be clear here, right here is 0. Here in the middle, we have 0.5. And the lower line here is the 0.618. Right here, we have 1. And the golden zone is the area here in between 0.5 and 0.618. Later on in this video, I will show you guys exactly how you can change the settings of the Fibonacci tool to get this golden zone. But now let's switch attention once again here, because I want to talk about what, in my opinion, probably is the most underrated Fibonacci zone. and that zone is the 0.382 to 0.5. And yes, as I said, 0.382 to 0.5 is, in my opinion, an underrated Fibonacci zone. And the reason I really like this zone is because this is a great reversal zone, especially in strong trends. So when you have a strong trend, like you, for example, see right here, and with strong trends, I mean that we see strong impulsive moves here. You can see we had a strong impulsive move. We have yet another strong impulsive move. When we have strong trends like this, many times the price will actually not be able to pull back, you know, lower than the 0.5 level. Many times the pullback here will be a bit more shallow and reversed slightly above the 0.5 level, and most of the time slightly below the 0.382. So you can, for example, see in this image, the price saw an impulsive move, and where did the price reverse? Well, we saw a reversal here at in between 0.32 to 0.5. Once again, we saw a strong impulsive move, and the price pulled back and tested once again the 0.382 to 0.5 multiple times, and then this strong trend continued here towards the upside. And now you may, of course, once again wonder, where are these numbers from? Well, the 0.382 comes from the Fibonacci sequence. This time we take any Fibonacci number, and we take the number that is 2 steps previous to that number and divide it with the number we choose. That is basically n minus 2 divided by 9. That is basically n minus 2 divided by n. And as I said, where n is a Fibonacci number, and 0.5 once again comes from basic geometry. The last zone I want to talk about here before we dive into the best Fibonacci settings is something called the golden pocket. And for the two previous zones, I showed you guys a chart, but for this zone, I'm showing you guys the default Fibonacci settings. And you may, of course, wonder why. Well, that will be clear here very soon. But first of all, let's take a look at what the golden pocket is. The golden pocket is simply the Fibonacci zone here between 0.618 to 0.65. So this one is a little bit deeper compared to the golden zone, or actually it's quite a lot deeper than the golden zone, and it's also a smaller zone. So it's both deeper and smaller compared to the golden zone. And we know from earlier where 0.618 comes from, but what about 0.65? What is so special about 0.65? Is anything special about 0.65? For example, if we take a look here at the default Fibonacci settings, so the settings for Fibonacci tool, you can see that we have no level here that is 0.65. So in order to, you know, have the golden pocket, you need to change the settings on your own. But you might not want to do that because it seems like 0.65 is pretty much arbitrary. And what I mean here by arbitrary? Well, it seems like 0.65 is pretty much a random number. Or in other words, there's no mathematical or geometrical explanation behind the 0.65 number. And because this is the case, we have no real reason to use the 0.65. Perhaps it comes from some other traders finding it successful to trade these numbers, and that's definitely possible. But because we have no real reason why we use 0.65, my recommendation here, or what I'm doing, is that I'm actually using this zone with caution. I'm personally, to be honest, not even using this zone. So use the golden pocket with caution. If you want to, you can of course always experiment. Perhaps the golden pocket works good for you and for the specific asset types you are trading. But as always, when you try strategies out, you need to make sure that you have proper risk management, and the best thing to do is to always practice with paper trading or practice with fake money before you actually dive in to the real market. So now it's time to take a look at the best Fibonacci settings. If you guys didn't know, you can of course change the settings of the Fibonacci tool to potentially improve the effectiveness of the tool, and as a result, improve your win rate. And in this chapter, we will cover multiple different settings, and some settings are more useful in some situations. Many times when it comes to indicators in general, it's often that no size fits all. So depending on what you are trading, if you're trading long-term, short-term, and your trading strategies and so on, some settings are better in some situations, while other settings are better in other situations. So these are the settings we're going to cover in this chapter. So first of all, we will take a look at the golden zone setting. And we have already been talking about the golden zone. So if you haven't watched the chapter about golden zone yet, I highly recommend that you do watch that one before we take a look at the settings here so you understand the golden zone. The next setting I want to take a look at is a setting to get perfect entries in strong trends. So this setting is better when we are in a strong trend compared to if we are in a more weak trend, or if we are in no trend at all, you shouldn't even use that setting. But this one can be great in strong trends. The next setting I want to take a look at is the setting that I find is the best setting for beginners. So here I will take a look at the best Fibonacci levels for beginners. And last but not least, I will take a look at a setting to find exact target levels. All right, so the first setting we're going to cover is the golden zone. So to change the settings of your Fibonacci tool, first of all, we want to make sure that we have the tool checked. So you go to your Gann and Fibonacci tools, and you want to press here on Fib retracement. What you then want to do is that you want to drag out your Fibonacci tool. You can do this anywhere on the chart. And then we should see this window appearing right here. And you want to go to the settings tab and press on settings. Next, you want to go down here to where we have all of the Fib levels. And you want to make sure that you have the first one, 0 here, you want to have shaked. But you actually want to unshake the 0.236 level. You want to unshake the 0.382. You want to keep both the 0.5 and 0.618. You want to unshake the 0.786, and we also, since we're not going to use the Fib extensions, we will also unshake all of these levels right here. So your settings should look something like this. And now, because this is the golden zone, I do want to do a few more settings here. So the 0.5, I'm going to change here to gray, or actually this one right here. So we have it the same color as the rest of the indicator. And as for the 0.618, what I do want to do here is that I want to change this one to yellow or golden, something like this. So we clearly have a golden zone. Now, if you want to, you can also change the background here. Perhaps you prefer to have a little bit stronger background or a little bit weaker. And if you want to, you can, of course, customize the size and so on and so on. But now we are basically ready here to press OK. So what we now can do, we can delete our Fib extension. And now we will notice that the next time we use our Fibonacci tool, so for example, let's use it from this swing low right here. So here we have a swing low, and remember what we do, we drag it from the swing low up here to the swing high. In this case, I use it from the real body to the real body, and then we extend this level to the right here. So as we can see, in this case, the price went up here, the price came down to the golden zone, and then we reversed higher. All right, so the next setting I want to show you guys is actually one of my personal favorites. And this one is especially good when we are seeing strong trends, like for example, right here. So once again, to change the settings, we go up here to Gann and Fibonacci tools. We choose our Fibonacci retracement. We drag it out here, and then we go and click on the settings tab. So once again, you want to make sure that you have the 0 right here checked. For this one, we want to uncheck the 0.236, but we actually want to keep both the 0.382 and we want to keep the 0.5. For the rest of the bars here, you actually want to uncheck all of these ones. Or of course, you want to make sure that you keep the 1. So these right here are the settings you want. And what you also can do here is that you go up here to the 0.382 and you change this one to the same color as for 0 and 1. And that's pretty much it for this setting. Of course, as always, you can change the background if you want to. I like to keep it as it is. So now we are ready to go down here and press OK. So now you may of course wonder, why is this specific setting good when we are seeing strong trends? Well, when we are seeing strong trends, like we are seeing right here, you can see we have a swing low, swing high, another low, high, low, high. And when we are in these steep uptrends, you will realize that many times the pullbacks here, so the pullbacks are the moves against the direction of the trend, the pullbacks will have a very hard time to go below the 0.5 level. And remember, the golden zone is below 0.5. Most of the times the price will reverse actually slightly above 0.5, or many times more close to 0.382. And that is why I really like this setting, especially when we're seeing lots of demand like we are, for example, on this chart. So now let's use the Fibonacci tool with our new settings. So once again, we can either anchor from wick to wick or body to body. In this example, we can anchor from the wick of the swing low up here to the swing high. We can drag this one a little bit more to the right here. And as you can see, the price came down to this level. We saw a strong, this is actually something we call a bullish engulfing pattern, which is a pattern that indicates a reversal here towards the upside. So we saw a bullish engulfing pattern coming in here at our key Fibonacci zone. We can actually, once again, we drag from wick all the way up to the highest wick of the next swing high. We drag it a bit to the left here. And once again, we can see that the price pulled back here. We pulled back all the way to the 0.382 to 0.5. We saw a strong candle right here. And then the price once again shot up to the upside. Let's see if we get another pullback. You can see we anchor from wick to the highest wick, right? You can see the highest wick all the way up here. We drag the Fibonacci zone a bit here to the right, and you can see that once again the price came down right to this area with this green candle right here, and then the price continued to push higher. And now I just realized that I haven't shown you guys an example of a downtrend yet. So let's take a look at how we can use these settings in a downtrend. So the first thing we can notice here is that we are once again seeing a strong downtrend, a very steep and very clear downtrend. So what we do here, we once again have the same settings as before because we have a strong trend. And now we can use the other method. So we anchor from the candle, the highest point of the swing, down here to the low. You can see that we saw the impulsive move up, the pullback came up to our area, and then it continued down. We can once again use our Fibonacci from the next swing high to swing low. So we use it like this. And once again, you see we saw the move, the pullback came up to this area, and then we saw the next push towards the downside. So now the next settings I want to show you guys is actually the settings I recommend for beginners. So if you are more of a beginner trader, this is, in my opinion, the best settings. So to change the settings, we go up here to the Fib retracement and we drag the Fibonacci retracement out anywhere on the chart. Then we once again head up here to the settings tab. And now let me actually show you guys really quick how you can change back the settings to the default. To do this, we go down here to where it says template. You press on this one right here. By the way, you can also you can also save your settings by clicking save as. So if we want to save our current settings, we simply click save here, and you can call this one, for example, strong trends. And you can click save here. That is something you can do. But now let's actually apply defaults. So we take the settings back to how they were in the beginning. So now for the best settings for beginners, what I recommend to do here is once again, we keep the 0.236. We once again want to unshake. This level is, in my opinion, many times not really that useful. You can see that for pretty much all the settings, we don't have the 0.236. But for this setting, you want to keep the 0.382. We actually want to uncheck the 0.5. You can keep the 0.5 here, but you don't really need to have it, and why will be clear very soon. As for the 0.618, you want to keep this one. You want to uncheck 0.786, and the rest of the bars you want to uncheck here. And as you guys know, as for the colors, I like to keep this one the same color as the other one. And the last one, you can change to any color really. Let's do purple for this one. And now we are done here. So now with these settings, as you can see, we have an area here in between the 0.618 all the way down here to 0.382. And the reason why I really like this setting is for two reasons. The first reason is that with this setting, we pretty much get the best of two worlds. We include both this area right here, which remember, this right here is the golden zone, but we also at the same time include the setting for strong trends. So we pretty much get the best of two worlds here. You can also notice that this zone right here is much broader compared to the previous settings, and this can actually be both a good and a bad thing. The good thing about this setting is that the price will more often reverse in this area compared to the previous settings, but at the same time the zone is broader, so the signals will be a little bit less precise. But when you use this setting, you will realize that the price will so many times reverse in this area. You can see this example, the price pushed up, came back to this area, pushed up once again. We can drag up a new Fibonacci retracement, and once again you see the price coming down, reverses to the upside. We drag out our next Fibonacci zone, and you can see that even for this next move we saw the price coming down to this area. But here, and this is very important, if we take a look at the next move, we drag from swing low to swing high, you can see that the price actually broke below this zone. You can see the price broke below here, and you can actually use this as a potential warning sign that the trend might be coming to an end. Because when the price breaks below the 0.618, we are talking about a very deep retracement. And deep retracements, when the retracements gets too deep, especially when we break below the one line here, that's a warning sign that this previous uptrend might be coming to an end here. And when the price broke below the 0.618 and also we broke the one level here, which is the low, you can actually see that this was the beginning and the termination of the trend. So now last, but definitely not least, let's take a look at a settings to find exact targets. And for this setting, we are not going to use the fib retracement. For this setting, we're going to use the trend-based fib extension. So make sure that you choose this one right here, and then you want to drag it out here on the chart. You need to press at 3 random points, and you can do this anywhere on the chart. When you have done this, you once again, you head up here to the settings tab of the window that pops up. So we go here to settings, and for this setting, I'm actually going to keep it very simple because I have two main levels that are great for targets. So for this one, you want to keep the 0, but I'm going to uncheck all of these levels all the way to 1. So you want to uncheck all of these ones. You want to keep the 1 here. You want to keep the 1.618. You can also keep the 2.618. That one I sometimes use, especially when an asset breaks an all-time high. If we're talking about like a small cryptocurrency or something like that, the 2.618 can be useful. But for this example, I'm going to uncheck all of these. So this is a super simple setting, but it's very useful. So you want to have 0, 1, and 1.618, and then you want to press OK. And now if you look at this chart, you might actually remember that this was an example from earlier in the video. But let me show you guys how this looks like with the new settings. So once again, we want to anchor here at the swing low. We press the second time on the swing high, and we go down here all the way to the swing low. Then we drag the Fibonacci extension here to the right, and we get our target levels. The first and a very important target level is the 1 level. And this one simply comes from the 100% measured move. So if this move, this swing move right here, in order to reach our first target, we need to see a move of the same size. And as you can see in this example, the price came up to this area and sold off. So this would have been a great level to take some profit. The next key target level is the 1.618. This is yet another key target that a lot of traders are paying attention to. And as you can see, when the price reached this level, we actually sold off here. But now let's take a look at how these settings would have done for the next swing. So now we anchor at the low all the way down here. We go up to the swing high, and then we go down here to the swing low. We drag it a bit to the right here. And once again, you can notice that the 100% measured move, the one right here, acted as a key area. The price came up to this area and sold off. But even more importantly, if we look a bit to the left here, you can actually see, if we drag it even more to the right, you can actually see that the 1.618 level is the level here that the price struggled to get through, and we have now fallen all the way down here to the one level. So now in this final chapter of the course, we will put everything we have learned so far together and build a trading strategy. And in order to really understand this trading strategy, I highly recommend that you have watched the rest of the course. And the settings we will use here is what I called the best settings for beginners. And I will also use our fib extension settings. But all right, so step number one for this trading strategy is that we need to identify a swing low and a swing high. And as you can see right here, Tesla printed a clear low, and we pushed all the way up here and printed a high. And let me actually use the replay mode here so we can take a look at how this would have looked like in a real market. So when we have identified our swing low and swing high, this is the point when we use our fib retracement. So we use our fib retracement right here. We drag it from the swing low to swing high, and we use the settings I talked about earlier. We also drag this zone to the right here. And what we are waiting for here is for the price to come back to this zone and then push higher. So let's play this one out for a while here. As we can see, the price did come back down here to the zone, but we actually don't want to just blindly buy something when the price comes down to our fib zone. In order for us to build a real trading strategy, we need some type of confirmation, or in other words, we're looking out for confluences. We want to see multiple bullish signals happening at the same time. And right now, we don't really have enough information for a trade. So let's play this one out a bit more. But at this point, it starts to look very interesting because as we can see, Tesla in the short term have been printing one low and then a lower low, while at the same time, we're printing lower highs. So it looks like we have some sort of downward sloping channel right here. And this is actually something we can use as a confirmation. So if we continue to play the price here, we can see that at this point, we broke above the structure. So this right here is a bullish signal. And at the same time, we saw the reversal happening here at our Fibonacci zone. So now when we have two bullish signals happening after each other, we can actually enter our trade. For this example, you have multiple ways to set your stop loss. You could argue to set your stop loss below this little low right here. But if we're looking for a large trade, I would actually put the stop loss below. You can see the lowest point here of the structure. And what are we going to do for our target levels? Well, as you guys know, we have our trend-based fib extension. So how do we use this one? Remember, we anchor from the low, the same low and the same high we used for our Fibonacci retracement. And then the third anchor is down here at the very low. So what we now do, we zoom out a bit here and we set our target up here at the one level. This right here is the measured move objective and a very common area for the price to reverse. And if we play out this trade right here, we can see that the price came up here to the one level. We saw a small pullback. The price actually pushed a tiny bit higher, but then the price started to fall. But fortunately, we don't have to worry about that because we locked in our profits at the 100% measured move. All right, guys, so this course is coming to an end very soon. So I want to thank you all so much for watching. And if you guys did find any value in the course, The best thing you can do to show your support is simply by dropping a like on the video. It helps out more than you think with the YouTube algorithm and all that stuff. So thank you all to everyone who takes the time to smash up the likes. And also, of course, if you have any questions about this video, or if you have, any questions about any of my other videos, please don't hesitate to drop a comment down below. As you might have seen in the comment sections of my other videos, I try my very best to answer to every single comment. And yeah, last but definitely not least, when you are ready to continue your trading and learning journey, I highly recommend that you check out this playlist right here. In this playlist, you can find all my free courses I have made so far, and there are many more to come. But yeah, take care everyone, and I hope I will see you in the next video. Ciao, ciao. You need to know about chart patterns for trading stocks, cryptocurrencies, forex, or any other financial market. And my goal is ambitious, but I want to make this the best chart patterns course on YouTube. I will not only teach the basics, I will also talk about things that other YouTubers don't share or hide behind paywalls. Alright, so first of all, who is this course for? This course is for you if you are either a beginner or if you are a more experienced trader. I have built this course in such a manner that even if you are completely new to trading and chart patterns, you will be able to follow along step by step. But also, this course will be long and comprehensive, so even if you are a more experienced trader, I'm sure you will learn a lot, such as more advanced trading strategies and more advanced techniques. And as I mentioned in the intro, it doesn't matter if you trade stocks, forex, crypto, or any other market. Chart patterns are universal, meaning that they appear in all markets. And the chart patterns also appears on all time frames. So it doesn't matter if you are a day trader, if you are scalping, or if you are swing trading. This course is for all types of trading. However, some patterns work a little bit better in the short term, while some patterns are more suitable for the long term. But don't worry, we will talk all about that. And this course is for you that want to be consistently profitable. And in order to be consistently profitable, you need to be ready to dedicate time and effort. You need to dedicate time, like for example, watching this course, but you also need to dedicate effort. So it's not enough to just watch this video, you also need to practice what you learn in real markets. So now, what can you expect to learn from this course? Well, first of all, you will learn how to identify chart patterns. And you will also learn chart pattern classifications. Every single chart pattern has both a direction and a type. And we will talk all about that and why it's so important. But here, and this is very key, we will cover both the logic and psychology behind these chart patterns. Many videos out there will teach you how to identify chart patterns, but it is at least as important to understand the why. So for example, why does a certain chart pattern lead to the price going up, and why does a certain chart pattern lead to the price going down? If we can understand the why, we can use our chart patterns in a broader context. And this is how you really will become a better trader. And during this course, we will of course talk about the advantages of chart patterns. Chart patterns can be amazing, but what's very important, we also have to talk about the limitations of chart patterns. For example, during this video, I will share with you guys some chart patterns that many traders say work well, but they can actually be traps leading to losses, especially for beginner traders. So make sure to, pay extra attention to these patterns. So now I want to share some important sort of tips and tricks that you can use during the course to learn and improve much faster. And the first tip here is that if you are a beginner, I recommend to watch the chapters in order. As I already mentioned, I have built this course in a step-by-step manner. So if you are a beginner, I really recommend that you watch the chapters in order. And for more advanced traders, perhaps you have been trading for a while, you have a basic understanding of chart patterns and so on and so on, I would actually still recommend that you watch the chapters in order, just because the course is in a step-by-step manner. But what you can also do if you are a more advanced traders is to use the timestamps or the video chapters. So you can skip over certain parts or perhaps replay certain parts and so on and so on. My next tip here is to take notes, either if you have a pen and paper available, or you can do it digitally on your computer, phone, or whatever. But it has been proving that taking notes will enhance your understanding and improve the retention of what you learn. So this is something I definitely recommend. And one thing that I personally really like about, educational videos, for example, when I studied math, I pretty much learned everything by watching educational videos on YouTube. And one of the main benefits of educational videos is that you can replay parts that are uncertain or unclear until you really get it. And the next tip here is to do the exercises. So during this course, I will give you guys some exercises, because in order to become a better trader, you need to not only learn, you also of course need to practice. So if you want to take trading seriously, I recommend doing the exercises. It's of course nothing you have to do, but I do recommend it. And last but not least, guys, ask questions. If anything during this course is unclear, make sure to drop a comment down below. I will try my very best to answer every single question on this video. All right, so let's begin here by talking about how to classify the chart patterns. Every single chart pattern has both a direction and a type. So throughout this course, we will give every single chart pattern both a direction and a type. So let's take a look at both of these classifications individually. The direction specifies how the price will move after the chart pattern has appeared. And we have two different directions. A chart pattern can be either bullish, which indicates that the price will go up after the chart pattern. The other direction is bearish and indicates that the price will go down after the chart pattern has appeared. Not every single bullish chart pattern will lead to the price going up, and not every single bearish chart pattern will lead to the price going down. But if we can learn both how to identify and how to trade these patterns correctly, this will be true most of the time. The other classification is the type. And the type specifies the price direction after compared to the price direction before. And once again, here we have two main types. The first one is the reversal, and the second type is the continuation. And we have two different types of reversals. The first reversal is the bullish reversal. And for the bullish reversal, before the pattern appears, we have the price going down. Then the pattern appears. So this circle right here is the chart pattern. And then after the pattern, the price goes up. The other type of reversal is the bearish reversal. And this is the opposite of the bullish one. So before the chart pattern appears, we see the price going up. the pattern appears, and then after the pattern, the price is going down. But we also have two different types of continuation patterns. The first continuation pattern is the bullish continuation, and this means that before the pattern appears, the price is going up, then the chart pattern appears, but after the pattern, the price will continue to go up. That is why it's called continuation pattern. And of course, the opposite is true for the bearish continuation. For this one, the price goes down before the pattern appears, then the pattern appears, and after the pattern, the price continues to go down. But we also have one more type. This right here is the type that I call uncertain, and these patterns are very important to be able to identify because these patterns will not have a clear direction, and many times they will also not have a clear type. So these patterns can be super hard to trade, and most of the times these are patterns that I try to avoid. And now you may wonder, why do I even include uncertain patterns in this course? Well, when it comes to trading, it's of course important to be able to spot trading opportunities, but it's actually also important to be able to spot when not to trade. So I would highly recommend that you don't skip over the parts where we talk about uncertain patterns. So yeah, as I just said, these are chart patterns that I avoid at all costs. So let's put what we learned here together and take a look at some chart pattern classification examples here. So remember, every chart pattern has a direction and a type. So an example of a chart pattern could be, for example, a bullish reversal pattern. So this is where the price goes down, we have the pattern, and then the price goes up. Another example could be a bearish continuation pattern. This would be the price going down, the pattern appears, and then the price continues to go down. Yet another example could be a bearish reversal. In this case, we have the price going up before the pattern, then the pattern appears, and then the price goes down. So now guys, we are finally ready to start exploring the chart patterns. And for every single chart pattern, we will both take a look at how to identify the pattern and how the pattern would look like in a textbook. But what we will also do for every single pattern is to take a look at real-life examples and strategies. So we will both take a look at how to find the pattern, but even more importantly, we will also take a look at how to trade the pattern. All right, so I think a great pattern to start off with is the double bottom pattern. This right here is a bullish reversal pattern, which means that the price is going down before the pattern appears, and the goal with this pattern is to reverse the price to the upside. So to identify the double bottom, you first need to identify a downtrend. This is when we are printing both lower highs and also lower lows. After the move towards the downside, what you're looking out for here is two lows which are at around the same level. These two lows doesn't have to be on the exact same level, but they should be roughly at the same price. What we usually do here is that we drag a horizontal line between the two lows. And we also want to draw a horizontal line connecting the high here in between the two low points. This move right here, the first move down after the pattern has appeared, is also significant. So now let's take a look at how do we trade this pattern. Well, first of all, you can see that this is a double bottom because we had a move towards the downside. We saw one and two lows at the same level, and then a reversal towards the upside. The most common entry point is to enter on the candle that breaks above the line defined by the high in between these two low points. However, I actually have another entry point that I personally prefer many times, but first take a look at the strategy for entering the breakout. So your entry would be where this candlestick close, so at the high of the close right here. If you enter at that point, the most common place to set your stop loss is to set it just below the lowest point of the double bottom. And if you don't know, the stop loss is where you will automatically sell if the price goes down to this point. As for your target level, what I usually recommend here is to target a risk to reward ratio of 1 to 2 or more. And what I mean with this is that the distance from your entry point to your target should be more than twice as long as your distance down here to your stop loss, which would make your profit target around here. So that is one simple strategy. However, another strategy that I personally really like is to enter at the candle that just slightly dips below the low created by the first bounce. What you can then do is that you can enter on the candle close of that move. And one thing to notice is that you will not always see the price dip below the line created by this point. Many times the price will reverse just slightly above, and then this is not as good of a strategy. But when the price wicks below this line right here, I personally like this type of entry. For this type of entry, I would also place my stop loss just below the lowest point of that candle. And using a risk to reward ratio of 2, perhaps our profit target would be here. So this right here is a much quicker strategy. Our goal here is to get in and out quickly and make some quick profits. Another potential entry is that many times after the price breaks this point right here, the price will pull back. So another entry point is to enter on that pullback. However, in this example, the price broke this level and never looked back. But many times you will see a pullback, and that can also be a great entry point. I will talk about that entry very soon when we talk about the double top strategy. And you may wonder, what is the psychology behind the double bottom? Well, it's pretty simple, because before the pattern appeared, we had a downtrend. And when we see a low, another low, and then when we break this high right here, the downtrend is terminated, and that is where the buying opportunity comes from. So now guys, we are ready to take a look at the double top pattern. And later when we take a look at the double top strategy, we will look at the entry type I talked about earlier in the course. But first, let's take a look at how we identify the double top. So as always, the first thing we want to do is that we want to take a look at the direction and the type. So in this case, we have a bearish reversal. So before the pattern appears, we want to see the price going up. Then this red part right here is the actual pattern. And after the pattern, we want to see the price going down. And compared to the double bottom, I made this example a bit more messy. And that is because in real markets, you will seldom have, perfect looking patterns. Most of the times, the patterns will look more something like this, a little bit more messy. But the same principle here applies. So for the double top, the price is pushing higher, but then at one point, we find two tops here at the around same level, indicating that the price is struggling to push higher. What we usually do here is to drag a line here in between the two highs. And what I want to show you guys with this example is that sometimes the price will push quickly above the high before the reversal. And what you also can see here is that in real markets, we will sometimes have sort of multiple minor lows in between the highs. So it's important that you drag your other horizontal line at the lowest low in between the highs here. So now let's take a look at this pattern in action in a real market. So you can see in this example, we had the price pushing up. We got rejected one time, and then we got rejected one time again. This was actually almost like a triple top. So we almost had 3 small reactions here. And when we talked about the double bottom, we already mentioned this type of entry when you can enter at the resistance. We also talked about the entry where you can enter at the break below the line. So for this pattern, I want to focus on this type of entry right here. And this one can be a little bit tricky to understand, especially for beginners. But essentially what we're looking out for here is that, first of all, this strong bearish candle right here broke below the low. So this right here is a common point to enter. But an excellent entry point can actually be to wait for the price to pull back, or in other words, move against the direction of the breakout move and then enter at the pullback. So in this case, the entry would be right here. And to make this example more clear, let me actually show you guys how this would look like in a textbook. So in a textbook, let's say we have a clear, very super clear double top like this. And in a textbook, the pattern will usually look like this, right? You will see the price going up to the exact same point and test the previous support as resistance. But you can see that in real markets, many times, like it did right here, it actually pushed above this middle line. And this is super common, and this is why you should not be too focused on these sort of perfect patterns that you see in textbooks. It's fine to see the price pushing above this middle line, but what we want to see in order to confirm the entry is a small move here towards the downside. So entry right here. You may of course wonder, where do we place our stop loss? Well, for this type of entry point, I think the stop loss is very clear. Usually you will set the stop above the highest point of the pullback. So in other words, you want to set the stop loss above this point right here. And if you target a 2-to-1 risk to reward ratio, your target would be somewhere around here. And for the double top, you can also use the strategies we talked about earlier in the course when we talked about the double bottom. So now guys, the time has come for the bull flag pattern. The bull flag is one of my personal favorites. I really like this pattern, both because it happens so often in the market, it appears all the time, and it's also a relatively simple pattern. To identify a good bull flag, what you are looking out for is that you want to see a strong impulsive move. So the move that goes in the same direction as the trend are called impulsive moves. And then we want to identify a pullback. And a pullback is essentially a move that goes in the opposite direction of the trend. Many times the bull flag will print sort of minor lower highs and lower lows within the move. However, bull flags can also be more simple. So for example, this move right here could be a bull flag, and this move down here could also be a bull flag. The difference between a good and a bad bull flag is often more about how the price behaves, both during the move towards the upside, but also inside the actual flag. So let's now take a look at the bull flag strategy and how to trade a bull flag step by step. So first of all, you can see that the flag we have right here is the one most similar to the sort of textbook bull flag we just recently took a look at. Because as you can see, we had this impulsive move up, then the price started to move against the direction of the trend, and also inside the actual bull flag, we printed both lower highs and we also printed lower lows. So this is a very classic example of a bull flag. And in order to find a good bull flag, what you're looking out for is that you want the move that happens before the bull flag, so this move right here, you want this move to be pretty sharp. It's a good sign when we see strong candles like this one and this one happening before the flag. During the actual flag, what we preferably want to see is that we want to see lots of these candles that are pretty small, like these three right here, these three right here. In simple terms, we usually want the flag to be pretty tight here, and we don't want the price to move too much. The most common way to enter the bull flag is to enter on the candle that breaks the flag. So you can see that this right here is the candle that broke above the flag, and what we usually do is that we enter on that candle close. And preferably what you want to see with the candle that breaks above is that you want to see a strong candle. Just as the candles we talked about down here, it's a good sign when we see a long and strong candle. As for your stop loss, you usually place it below the lowest point of the flag. And in this case, you can actually see that the lowest point is all the way down here. In this case, we had pretty much one low and two lows at the same level. So we want to make sure to place the stop a tiny bit below. The reason why we do this is because if the price gets rejected at the resistance of the bull flag, we can actually allow the price to get one more bounce on this support without getting stopped out. To keep it simple, you can use a risk to reward ratio of 2, and we have been talking about what that is earlier, so your target would be somewhere up here. However, another method you can use is to measure the impulsive move up, and you can take this exact measurement from the lowest point of the bull flag and make this point right here your target. Another way to enter the bull flag is to try to enter at the support of the flag. But in order for this entry to work, so imagine that this right here is the flag. What I usually want to see is that I want to see a candle that looks something like this, that quickly dips below the support of the flag and then quickly pushes above. If we see a candle like this in the bull flag, then a good entry point is to actually enter at the candle close of that pattern. You might recognize this type of entry from the patterns we talked about earlier in the course, and I'm personally a big fan of this type of entry. And this type of entry is often called a false breakout or a failure test. What I also want to show you guys with this example is that not all bull flags will look like this. Not all bull flags will have highs and lows like we see in the textbooks, but many times they will be just simple pullbacks. So for example, if you take a look at the flag down here, you can see that it's pretty much a line. We have an impulsive move, we have a move against the direction of the trend, and here we saw the breakout. However, now I have a short exercise for you guys. I want you guys to think about which of these bull flags are the best. And I want you guys to specifically think about the move that happened before the flag appeared. So if you want to, pause the video right now, think a bit, and drop your answer down in the comments below. Hey, why aren't you pausing the video? Just kidding, you of course don't have to do the exercises here, but I do think it's really valuable to sometimes pause the video and think. So the answer here, at least for me, is that this right here is a better bull flag. And this is not because the bull flag looks more like it does in the textbook. The reason I think that this bull flag is better is simply because the move that happened before the flag appeared was much stronger. And this is what we want to see. If you compare it to the move that happened before this flag, you can see that during this upwards movement, we had lots of small candles and we had sort of low momentum. And preferably before the flag, we want to see strong momentum. So now guys, let's take a look at the bear flag pattern. As you can hear on the name, the bear flag is a bearish pattern and the type is continuation. So before the pattern, we have a downtrend, and the goal of the pattern is to continue the downtrend. For the bear flag, the price will be sloping upwards during the flag, and we usually define the flag using two lines like this. In textbooks, you will usually find the pattern printing higher highs, sort of minor higher highs, and higher lows within the pattern. But as I talked about with the bull flag, this part right here, in some situations, can also act as a flag. So a bear flag doesn't really have to print higher highs and higher lows within the flag. Sometimes it will be more like a straight line. So let's now take a look at the bearish flag in a real market and the bear flag strategy. So first of all, as you can see here, we have a very nice downtrend. We are printing lower highs and lower lows. And this right here is a great example of a bearish flag. But what you can notice about this flag is that in this case, we don't really have super clear highs and lows. You can see, yes, we do have some highs and lows within the flag, but it's not really the super clear flag you see in textbooks. The most clear entry point for the bear flag is to enter here at the breakout, or some traders, when we break down, will call it a breakdown. And when you enter the breakdown, you want to enter at the candle close. However, when we see the candle close happening near the support level of the flag, many traders will wait for one more candle to confirm the breakout. This right here is what we call a confirmation candle. So another entry point would be around here. The stop loss for the bearish flag is pretty straightforward. You want to place the stop loss just above the highest point of the flag. And in this case, it is this point right here. As for the target level, we have two main methods. One method is to measure the impulsive move that happened before the flag. You take the exact same length and measure from the highest point of the flag. So this will give us a target level all the way down here. But what you can also do is to use a risk to reward ratio. And in this case, if you use a risk to reward ratio of 2:1, your target would probably be, outside the image, pretty much all the way down here. And now I have another super short exercise for you guys. And that is simply, can you find another bearish flag on this chart? Pause the video and drop a comment below if you want to. Well, one could definitely argue that we have a sort of very small bear flag right here. And this was actually a pretty decent bear flag because during the impulsive move down, we saw a pretty strong move. We also saw a pretty nice breakout candle. So this bear flag was not too shabby at all. So now it's time for, I would say, one of the most iconic chart patterns, and that is the head and shoulders pattern. The head and shoulders pattern is a bearish reversal pattern. So before the pattern, we have an uptrend, and after the pattern, we have a downtrend. The pattern itself consists of 5 important points. First of all, we have the left shoulder, which is this point right here. We have the head, and we have the right shoulder. The other 2 important points are these 2 low points that happens between the 3 high points. Or we actually have a 6th important point as well, and that is this point right here. And later on, I will talk about why that point is so important. And the reason this is called a head and shoulders pattern is because, as you can see, the pattern kind of looks like the head, the highest point in the head, and then we have the left shoulder and the right shoulder. And the pattern doesn't have to be straight like this. It can sometimes slope a bit to the right, slope a bit to the left. But the important point here is that we have a high, then we have a higher high, and then we have a lower high. What you also want to do for the head and shoulders pattern is that you want to connect the 2 low points in between the highs. So we want to draw a line in between this point and this point. And another tip for you guys is that this pattern becomes stronger if this low point right here is actually lower than this low point right here. And this is from a market structure perspective. After watching this course, I highly recommend that you guys check out my course on market structure. I will make sure to leave the link to that video up in the corner of this video. And the reason for this is that if this point right here is lower compared to the previous low, then you can see that we have both lower lows, and at the same time, we have lower highs. So in this case, after this high right here, we actually have the beginning of a downtrend, because in order to have a downtrend, we need to have lower highs and lower lows. That is the beginning of a downtrend. So having this point a little bit lower than the previous point makes this pattern a little bit more likely to succeed. So now let's take a look at the head and shoulders strategy and take a look at a real market example. So the first thing we of course need to do is to identify the pattern. In this case, you can see that we have one high, then we have a higher high, and then we have a lower high. And what you also can see here is that the lows in between the highs are sloping downwards. And as I said, that makes the pattern stronger. As for the entry points, we have 2 main ways to enter. The first entry point is this point right here. You can see when the price breaks below the downward sloping line. By the way, this line right here is what we call the neckline. If you use this entry point, the most common place to set your stop loss is to set it just above the right shoulder of the pattern. So you set it just above this point right here. And if you're using a 2-to-1 risk reward, your profit target would be all the way down here. So it is important to notice here that compared to the previous patterns we have been talking about, the head and shoulders pattern is a very large pattern. So it will take a long time to play out, and you will need patience trading head and shoulders. Another way to take targets for this pattern is to measure from the head down to the neckline, and then you take this exact measurement and measure from the breakout. The benefit using this approach is that your target level can many times be a bit tighter, but depending on how the pattern look like, sometimes when we do this kind of measured move, the target level will actually be further away compared to a 2-to-1 risk to reward. So this will depend on a case-by-case basis. Another common entry is to wait for the neckline to flip to become resistance and then enter at a reaction from the resistance. This entry point is often more suitable for short-term traders because you will be able to have a much tighter stop loss, and because you have a tighter stop loss, you will be able to have a tighter target as well. So in this particular example, you could enter here at the reaction from the resistance. So you can see we're looking at this reaction right here. We have 2 candles strongly reacting from the resistance. Using this entry point, I would set my stop loss above the highest point of the reaction. So as you can see, I would set my stop loss above this candlestick wick right here. And because the head and shoulders is such a large pattern, What I like to do here is to leave a little bit of wiggle room. Sometimes you can actually, let me change color here. You can actually set the stop loss even higher here to allow for the price some more room to move here. But as you can notice, when we have a tighter stop loss, we will also be able to use a tighter target. So using this type of entry, your target level could have been somewhere around here if you're using a 2-to-1 risk to reward. And as you can see, this would make the pattern play out much faster. And now it's time for the opposite of the head and shoulder, and this is the inverse head and shoulder pattern. And this right here is a bullish reversal pattern. So if you're a trader that prefer trading patterns that lead to the price going up, this pattern is more suitable for you. And since this is a reversal pattern, before the pattern appeared, we need to have a downtrend, then the pattern, and then the price goes up. Once again, the inverse head and shoulders consist of 5 or even 6 important points depending on how you see it. First of all, we have this point. This is the left shoulder. We have the head and we have the right shoulder. These 3 points are important, but we also have the points in between these highs. So these 2 points right here, also important. And the 6th important point is this point right here. This is the first pullback that happens after the pattern appeared. And compared to the normal head and shoulders, I made this pattern more similar to how you will find the pattern if you look at textbooks or Google or whatever. You can see I made the highs here appearing at the same level, and I also made the pullback here going down to that exact level. But it is important to remember that this doesn't have to be the case. The pattern can look more something like this, or even, perhaps more something like this. This right here is more of a, perfect example. And when you have been trading for a while, you will realize that it's not very common that we see this, picture perfect patterns. So here is a very realistic example of the inverse head and shoulders. As you can see in this case, the left shoulder, the head here, and the right shoulder are at, a pretty similar level, but you can still clearly see that we have one low, a lower low, and then a higher low. And in this case, you can also notice that we have one high right here, and then a lower high. Just as with the normal head and shoulders, you can buy this pattern on the breakout, so when the price breaks above the neckline. But in this case, I actually want to focus more on the retest. So you can see here, we actually had a beautiful retest of the downward sloping neckline. And one reason that made this such a good retest was that we saw really strong momentum, bullish momentum, coming from the test of the supports. So one way to enter this pattern would be to enter at the candle close of that momentum candle. This is a pretty good entry point for multiple reasons. First of all, we will be able to find a pretty good stop loss level for this case. Because first of all, we have one low right here, the lowest point of the retest. But in this particular case, you can also see that we found a minor low here before the breakout. So because of these 2 lows, you may wonder, where should we set our stop loss? In this case, I would actually set my stop loss below both of these points. And the logic here is that if the price start to fall after this momentum candle right here, we still have 2 potential levels where the price can bounce before we reach our stop loss. And using a 2-to-1 risk to reward ratio, your target might have been up around here. But of course, guys, you can also trade the breakout, so you can trade this candle right here. But one thing you have to notice about this particular example is that yes, the price broke above and this candle started off pretty good. But during the candle, the bears took control and actually closed the candle all the way down here. And when you enter on breakouts, you don't want to see, the price go up and then quickly dip below, because this can many times lead to the price going down. And as you can see, after this breakout, we actually saw the price moving slightly down here. And that is why in this case, I actually think that the retest entry, so this entry right here, was the better choice. And this is a very important lesson. Not all chart patterns should be treated equal. Depending on how the price moves at important price points, so for example, how the price moves during the breakout, we as traders need to be able to adapt to how the price moves and not blindly trade all patterns. Alright, so next up we have the falling wedge pattern. And this is actually a special type of pattern. Why? Well, as you can see, this pattern can act both as a reversal but also as a continuation pattern. And the direction here is bullish. So the pattern can appear after a downtrend and reverse the price to the upside, but the pattern can also appear after an uptrend and continue the price towards the upside. To identify the falling wedge, what you're looking out for here is that you want to see both lower highs and you also want to see lower lows. But the slope here of the highs should be steeper compared to the slope here of the lows. So the pattern here will get tighter and tighter. And this is true for both the reversal, but also true for the continuation pattern. So now let's take a look at the falling wedge strategy. And later on in this video, I will also show you guys the reversal version. But for now, let's focus on the continuation version. So as you can see in this example, we had a nice movement towards the upside, and then the price started to print both lower highs, but also lower lows. But what you can see on this pattern is that the upper line is more steep compared to the lower line, and this is exactly what we're looking out for. The most common entry for this pattern is when the price breaks above the upper line. And what we want to see on this entry candle is that we want to see a strong momentum candle. And this right here is pretty much a perfect example. As you can see, the candle where the price broke out is much longer, especially the real body. So especially the sort of wide part of the candle is much larger compared to the candles here inside the wedge. And this is what we want to see. So the entry point here, the most common one, is to enter at the candle close of the breakout. So you enter right there. The stop loss is usually set below the lowest part of the wedge. Or in other words, you set it below this part right here. You can see the price wicked a bit below the lower line. And as for your target level, you have two main methods. One of the methods we have talked about before, and that is to use the measured move. So you measure the impulsive move like we did right here, and you take this measurement and you measure from the lowest part of the wedge. And using this method, your target would be up here. But as with most patterns, you can also use a risk to reward ratio. And our rule of thumb here is to use a risk to reward ratio of 2. So twice as large as the part between the stop loss and the entry. And this would make your target level somewhere up here, pretty much outside this example, outside the picture, but a bit higher compared to the measured move. However, guys, we do have another entry as well. And as you know from the previous patterns, one entry point that I like for most patterns is to enter here at the support. So you could also enter on this candle right here. But for the falling wedge pattern, for this pattern specifically, I personally actually prefer to enter here on the breakout, but some traders find success entering on the test of the support. And what you preferably want to see if you use this type of entry is once again that you want to see the price sort of just slightly dip below the support and then quickly push above. You can see in this example, we actually had a specific type of candle. This right here is a bullish hammer. And when you see a bullish hammer dipping just slightly below support and then pushing above, this can be a good entry. So for this entry point, you would enter right here at the candle close of the hammer. Your stop loss, once again, it will be the same as the other strategy. You set your stop loss below the hammer. But one good thing about this entry point is that you enter before the breakout, and this can allow you to take quick profits. So for example, using a risk to reward ratio of 2, your target level would be right here. And as you can see in this example, you would have gotten some really quick profits because the first candle after the candle you entered already hit your profit target. So now guys, let's take a look at the opposite pattern. This right here is the rising wedge. And for the rising wedge, I will also show you the reversal strategy. But first, let's take a quick look at this pattern. Once again, this is a special pattern because the rising wedge can also act both as a reversal and also act as a continuation. So the pattern can appear after an uptrend and reverse the price, but it can also appear after a downtrend and continue the price down. Once again, what we're looking out for here is consecutive higher highs, but we're also looking out for higher lows. So once again here, higher highs and higher lows. That said, for the rising wedge, we want the upper line to be less steep compared to the lower line. So we want the pattern to rise here, but when it's rising, it should get tighter and tighter. So when, once again, the lower line is more steep than the upper line, and this will make the pattern sort of get tighter and tighter and tighter. And when the pattern is very tight, that is often where we see the strong breakout. So now let's take a look at the rising wedge strategy. And here you can actually see that the example I talked about when we talked about the falling wedge is right here. So you can see we saw the falling wedge here, the price continued up, but then after a while we saw a sort of massive rising wedge. And what I want to show you guys with this example is that chart patterns, as you know, they are universal, so they can appear on all types of time frames, but chart patterns can also be very different sizes. So you can see that this massive rising wedge right here is much larger than the falling wedge. And one principle you can notice here, and that you can write down if you are, taking notes and so on, is that continuation patterns are often, you will notice that they will often be smaller compared to the reversal patterns. Reversal patterns can in general be, large patterns. If you remember the head and shoulders pattern and the inverse head and shoulders, these are very large patterns. But when it comes to continuation patterns, they will often be pretty small, like the falling wedge. And if you remember, the flag patterns are also often pretty small patterns. But for now, let's focus on the rising wedge here. So the first thing you can notice is that the price is printing both higher highs, and we are also printing higher lows, but the range here of the pattern is getting tighter and tighter. And for the rising wedge, the most common entry is also to enter at the breakout. So you can see that this strong red candle broke the pattern. So our entry point in this case would be to enter at the candle close of this candle, right? But for this case, the stop loss is a little bit more tricky. One way to place your stop loss is to place it just above the high here, pretty similar to the falling wedge we talked about recently. But as you can see, in this case, we also have a wick. You can see we have a wick all the way up here. So some traders, because we have a wick all the way up here, would actually aim to place the stop loss above this point right here. And in my opinion, none of these stop losses are bad. Both are actually pretty good. And the stop loss you decide to choose here is, pretty dependent on your own trading style. So if you are more of a short-term trader, you might prefer to choose the first stop loss, because if you choose a tighter stop loss, you will be able to also choose tighter targets. While if you use the larger stop loss, the positive thing about the larger stop loss is that it's less likely that you will get stopped out. But at the same time, if you use the wider stop loss, you will need to use a wider target as well. So as you can see here, if you use the first stop loss type, perhaps your target would be down here. But if you use the other stop loss, in order to get a 2-to-1 risk to reward ratio, your target would have to be lower. And when we see large rising wedges like right here, what some traders will also do is that they will measure the length of the wedge. So they take this measurement and then measure from the breakout, right? So these two lines should be the same length, and then they use this right here as their target. But now, guys, let's take a look at the symmetrical triangle pattern. And this right here is our first red pattern. And why do I call this a red pattern? Well, for the symmetrical triangle pattern, the direction for the pattern is actually pretty uncertain. And I also, as you can see, I wrote type, continuation, question mark. And that is because in most textbooks, you will find that the symmetrical triangle pattern will be classified as a continuation. So before the pattern appears, you will have an uptrend, and in most textbooks, they will say that this pattern should lead to an uptrend. And if you look at charts, you will be able to find many examples of this being true, but you will probably find even more examples when this pattern turns out to just lead to the price going sideways. And I will talk more about that very soon, but first we just have to know how to identify this pattern. So what we're simply looking out for the symmetrical triangle is that we're looking out for lower highs, and we're also looking out for higher lows. And the important part here about the symmetrical triangle is that the highs and the lows, the slope of these two lines, should be pretty much symmetrical. So now let's take a look at the symmetrical triangle in action. So for this example, I chose a symmetrical triangle that happened after an uptrend. So in textbooks, if the symmetrical triangle appears after an uptrend, it should act as a continuation pattern and continue the price up. But what you will find is that so many times these symmetrical triangles will simply lead to a trading range. A trading range is simply when the price is moving sideways here in a pretty random fashion. And when you look at symmetrical triangles after the fact, it can be easy to think that, you know, this pattern wasn't looking very strong, I would have not taken this trade, and so on and so on. But I want you guys to imagine that the price is right here. So the chart to the right here has not happened yet. And let's imagine that you were a trader that saw this pattern right here. So as you can see, we saw the price beautifully printing lower highs. We saw the price beautifully printing higher lows. And then after the symmetrical triangle, we saw a really nice breakout towards the upside. So when you are at this point in the market, it can be very tempting to buy. But I personally avoid these patterns because so many times this breakout right here will turn out to not be significant, and the breakout will actually be a normal move within a simple trading range. So as you can see, a trading range is simply when we have a resistance area and we have a support area, and the price here moves sideways within this range. And what you will notice is when you look at trading ranges, by the way, the price action inside the range tend to be pretty random. When you look at trading ranges, a very common mistake, especially for beginners, is that they try to find patterns, in everything. For example, some trader might notice this right here, right? So this part right here as some sort of triangle. They might find, just this part right here as some sort of triangle. And perhaps they might find, another symmetrical triangle right here, and so on and so on. So these sort of symmetrical triangles can very easily fool, especially beginner traders. And that is another reason why I actually think that it's best to avoid these type of patterns. And now, while we are at it, let's take a look at yet another red pattern. This one is the broadening range pattern. And as you can see for this pattern, I actually have both the direction uncertain and also the type uncertain. So one could actually argue that this one is even worse than the symmetrical triangle. Or in other words, this pattern is super hard to trade. But that is actually one big reason why this pattern is so important to identify. As a trader, it's important to identify the patterns you want to trade, but it's also important to be able to identify patterns you don't want to trade. So how do we find the broadening range? Well, what we're looking out for here is that we're looking out for higher highs. So we want the price to print higher highs, but we also want the price to print lower lows. So we want to see an upward sloping resistance line while at the same time seeing a downward sloping support line. And what this pattern basically tells us is that we are seeing increased volatility. In very simple terms, volatility is how much the price is moving around the average. So if we have, a price that moves something like this, moves very close to the average, this right here is low volatility. But if we have a price that moves, a lot around the average, this right here is high volatility. And what the broadening range basically tells us about the price is that the volatility is increasing. So here we have a real life example of the broadening range. As you can see, we have both. We have highs here, and we are printing consecutive higher highs, while at the same time we're printing consecutive lower lows. So what this basically means is that the volatility is increasing during this time period. But just as with the symmetrical triangle, these broadening ranges will often turn out to just lead to the price going sideways in pretty much a range fashion. So as you can see, this broadening range turned out to pretty much be, you know, a sort of trading range where we have a support and resistance and the price going sideways. So my general recommendation here is to avoid these patterns. But if you want a trading strategy, one thing you can try to do, but once again, I actually don't recommend doing this, is to try to find movements quickly above the resistance or quickly below the support, and then try to enter at the failed breakout. So for example, here is an example. The price tried to push above the resistance. We failed here. So one possible entry is to try to enter here at the reaction of the resistance, placing your stop loss above the resistance, and then using a risk to reward ratio such as 2. So your trade could have looked something like this. But these type of trades are super hard, especially when you are actually in the live markets. When you look at past examples, you will always be able to find many good trades, but when you are in the heat of the moment, it will be much harder. So now guys, let's take a look at the cup and handle pattern. This pattern is typically a bullish continuation pattern, but in some cases, it can also act as a reversal. And as you guys can see, this right here is a very large pattern. It's probably the largest continuation pattern out there. And this one is more for advanced traders because it can be quite hard to spot. But what we're essentially looking out for here is that before the pattern appears, we want to see a trend towards the upside. After this, the price starts to print both lower highs and lower lows. So we are sort of starting to see the beginning here of a downtrend. But after a while, we start to see higher lows. And within the cup and handle pattern, we often see another pattern, and this is actually a reversal pattern. If you want to, as an exercise, drop down in the comments below what type of pattern we have right here. Pause the video right now if you want to. Well, this pattern right here within the cup and handle is actually a head and shoulders, and this, as you know, is a reversal pattern. So within this large cup and handle pattern, we will often have a sort of small reversal pattern within the pattern itself. So this is a little bit complicated, but essentially what we're looking out for here is that we're looking out for, we see the beginning of a downtrend, but then the price start to reverse. And what we want to see here is a sort of U shape. So the price goes like this in a U shape, and then we see a pullback like this. After this pullback, the goal of the pattern is to continue the price towards the upside. And what we want to do here is that we want to connect the highest point of the first move up, and we want to drag a horizontal line like this. And the reason this is called a cup and handle pattern is because this right here, the U shape, pretty much looks like a cup, and then the pullback right here pretty much looks like a handle. So this is where the cup and handle name comes from. And as I said, after the handle, the price breaks higher. So now let's take a look at the cup and handle strategy. And when you look at this market right here, you can hopefully see that in the heat of the moment, these patterns can be very hard to spot. But what we see here, we see all the things we need for a cup and handle. Before the pattern appears, we saw a strong move towards the upside. We can even notice here that we saw a gap. You can see we saw a massive gap in between this point and this point. A gap is when the price is trading up when the market is closed. So this is something you can see, for example, in the stock market when you have trading hours and you have hours where the stock market is closed, such as weekends or overnight. So these kind of gaps, like we see right here, can be created, for example, during the weekend. But as you can see, we had this move up here, and then we saw a lower low, higher low, higher low, higher low. So you can see that we sort of have the U shape we talked about recently, And if you pay really close attention here, as we talked about, we can often sort of find minor head and shoulders looking patterns within this pattern. So this is far from perfect, and this is not a valid head and shoulders, because remember, an inverse head and shoulders should come after a downtrend. But what you can notice here is that we can pretty much see an inverse head and shoulders here, because we have a low, lower low, higher low. We can drag a sort of neckline like this, and hopefully you can see how this is similar to an inverse head and shoulders. In this example, the handle of the pattern is this move right here. So it was a smaller handle compared to most textbooks, but the price eventually broke above and continued towards the upside. So there are multiple ways to enter the cup and handle. The first entry point is to enter the break of the horizontal line. So to enter at this breakout candle right here. So in this case, your entry would be at the candle close of the breakout candle. As for your stop loss, you usually want to place it below the low of the handle. So this right here is the low of the handle, and using a risk to reward ratio of 2, your target would maybe be up here. Another possible entry point is to enter at the retest of the resistance. So here we have resistance, we tapped one time, we saw resistance once again, the price broke above, and then we tested previous resistance as support. And here you don't want to enter blindly at the support. What you want to see is that you want to see a reaction, and preferably a strong reaction. So the entry on the retest here would be after this strong candle right here. One good thing about this entry is that you can have a pretty tight stop loss, because you can place the stop loss below the lowest point of the retest. So you can set the stop loss right around there. And as you know, setting a tight stop loss can allow for a tighter reward. So you can set your reward around here using a risk to reward ratio of 2. Another potential entry is to enter at the handle itself. So enter at this pullback right here. And for this handle, we actually have 2 entries. So we have so many different entry strategies for the cup and handle. So you can either enter the breakout right here, or you can try to enter the support of the handle. So for example, enter right here. In this case, because the handle was so small and not very clear, this is an entry I would personally avoid. But if you have, let me show you guys, if we have a more clear handle, so if we have a handle that maybe looks something like this, it's possible to get more clear entry points from the handle. And a good thing about this type of entry is that we enter at lower prices, and we can also get some pretty clear stop loss levels and target levels from that entry. And as with many chart patterns, another way to take targets is to measure the pattern. So we measure from the low up to the point, then we take this measurement, measure from the breakout, and this is another thing you can use to determine your target level for the cup and handle. And now guys, let's also take a look at the reverse cup and handle here real quick. This one is the bearish version of the cup and handle. So the direction is bearish and the type is most often continuations. Sometimes it can also act as a reversal. And in my opinion, the reverse cup and handle can often be even harder to spot than the normal cup and handle. So this one needs a little bit of practice. But this pattern is basically the same but the opposite as the normal cup and handle. So what we're looking out for is this U shape. So we're looking out for a U shape right here. Then we're looking out for the handle here. And the goal of the pattern is to continue the price towards the downside. What we also do for the inverse cup and handle is that we drag a line here between the lowest point of the first move down and between the highest point of the U shape. So here is a real life example of the reverse cup and handle. And here I actually shows an example where we have a much larger handle. So remember, from the normal cup and handle, we had a very, very tiny handle. But in this case, you can see that the handle itself was a very large pattern. And if you look really closely at this pattern, you will notice that this is another chart pattern. If you guys want to, let me know down in the comments what type of pattern we are seeing as the handle right here. So pause the video right now and answer the question if you want to. But let's take a look here. So as you can see, in this case, we had a very nice U shape. So the cup part of the handle was very, very clean in this case. And then during the handle itself, we printed higher highs, but we also printed higher lows. But what we can notice here is that the range is getting tighter and tighter. So this right here is a rising wedge, which in itself is a bearish continuation pattern, meaning that the goal of the handle itself is to continue the price down. So in this case, we can enter the reverse cup and handle as a rising wedge. So we can enter here as the price is breaking the rising wedge. So the entry is at the candle close of the breakout candle. Since we do have a high just slightly above the previous high right here, you can see this black line, I would actually place, for this case, I would place the stop loss just above this point. And using a 2-to-1 target, our target level would be right around here. Another strategy is, of course, to enter the break below support. So we have support right here and right here. And our buy signal would be at the candle close of this breakdown. For this entry, you could set your stop loss just as we did with the other entry strategy, so all the way up here. However, the downside with this type of stop loss is that your target level has to be so far down. So what you can try to do here is to place your stop loss somewhere above the broken support, right? If you want a much tighter stop loss. However, since the price was moving down in a straight line here, we don't really have any clear highs where we can place our stop loss above. So for this breakout right here, the stop loss placement would actually be very tricky. You could try to place it somewhere around here, but this is far from a perfect stop in my opinion. However, the upside with this type of stop placement is that your target can also be relatively tight. So now it's time for the ascending triangle pattern. And in my opinion, this right here is one of the best chart patterns out there. This pattern is a bullish continuation pattern. So before the pattern appears, we need to see an uptrend. And after the pattern, we see the price continue towards the upside. The most important part about the ascending triangle is that during the pattern, we need to print consecutive higher lows. And this is very important. And what we also want to see here is that we want to see the highs of the pattern to be around the same level. These highs doesn't have to be exactly at the same level, but they should be around the same level. And what we do here is that we draw an upward sloping line connecting the lows, and we draw a horizontal line connecting the highs. The first pullback after the break of the resistance is also an important point, and I will talk about that very soon. So now let's take a look at the ascending triangle strategy. Here we have a great real-life example of an ascending triangle. You can see that before the triangle appears here, we have an uptrend. Then we saw the price clearly printing consecutive higher lows. And we also saw highs here coming in at pretty much the exact same level. The most common entry point here is to enter at the break above resistance. And as with pretty much all breakout entries, what we're looking out for is that the candle that breaks out, we want to be strong. We want the real body of the candle to be larger compared to the real bodies of the candle inside the triangle. So we buy at the candle close of the breakout candle. The stop loss here is pretty straightforward. We want to set the stop just below the most recent low inside the triangle. So we want to set the stop loss just below that line. Here we can once again use a risk to reward ratio of 1:2. So our target would be right around here. With that said, not all breakouts will be perfect like this example. You can see right here, the price broke above and it never looked back. But many times you will see that we will have a breakout and then after a while, the price will be pulling back. So another way to enter the ascending triangle is to enter at the pullback after the breakout. And here you can either enter at the break of the pullback, so you can enter at the breakout, or you can enter at the support of the pullback following the break of the triangle. Next up, we have the descending triangle. This right here is a bearish continuation. So before the pattern, we have a downtrend. The goal of the pattern is to continue the price towards the downside. And for the same reason that I love the ascending triangle, the descending triangle is, in my opinion, one of the best. But as you can see, for this example, what I want to show you guys is that the most important thing is that in order to identify this pattern, we need to see lower highs. But as you can see, in this case, I on purpose made the lows here not at the exact same level, but we want the lows to be at around the same level. So some lows can dip a little bit below support, some lows can be a little bit higher, but what should be really clear when you identify these patterns is that the triangle should clearly be sloping down. So here we have a real life example of a descending triangle. You can see the price goes down before the pattern appears, and then we can clearly identify lower highs, and we can also identify lows here happening at the around same level. And for the ascending triangle, we have already been talking about that you can enter here at the break of support, so you can enter right here. But for this example, I want to focus on the other type of entry, and that is the entry point that is already marked here. You can see this red point right here. Because as I talked about on the previous pattern, not all breakouts will be perfect and lead to the price just falling like a knife. Sometimes we will see a pullback after the breakout. So you can see in this example, we had a clear pullback here after the breakout. So the price broke, but then the price started to move up here. And this is another excellent entry point, and you can enter on different ways here on the pullback. The first entry is that you can enter on the reaction of previous support flipping to become resistance. So in this case, you can see we had the support here, 1 and 2, also a small touch here. So we had 3 pretty clear touches. The price broke below, but in this particular case, we tested that exact previous support as resistance. So here you can enter at that reaction, and I would not buy here until we see a strong reaction. So I would wait for this first strong bearish candle before I enter the trade. For this entry, we have a super clear stop loss. We place the stop loss above the resistance that came from the previous support, so we can place the stop loss just there. And this allows us for a pretty tight target level. So using a risk to reward of around 2 to 1, your target would be somewhere around here. And you can see that we reached the target level pretty quickly. You can also enter here at the break of the pullback structure, so you can enter around here. Once again, the most clear stop placement is to place it above the high. But as you can see in this case, because we have a wider stop, in order to get our 2 to 1 risk to reward, our target level would have to be placed pretty far down. But for the descending triangle, you can of course enter at the breakout. So this right here is probably the most common entry to enter at the break of the pattern. The entry and stop loss is very similar to the ascending triangle. We enter here at the breakout. Stop loss is placed above the most recent high. Target level either 2 to 1, or what you can also do here, and that you can do for the ascending triangle as well. Some traders will measure the pattern, take this measurement, measure from the breakout, and place their target level based on the measured move. But yeah, guys, this course is actually coming to an end now, and I want to thank you all so much for watching. If you guys made it through all the way to the end, you are a beast. If you want to, you can drop a comment down below and write something like "made it till the end." But yeah, guys, if you want to support the channel, as you guys might know, I don't have any sponsors or anything like that. So the best thing you can do to support is to smash up the likes on the video, and if you want to, share the video with someone you think would benefit. And also, guys, of course, don't be afraid to drop a comment if you have any questions about anything in this video. I will try my very, very best to answer every single comment. And also, guys, if you want to continue your learning journey, I highly recommend watching my playlist that you can see on the screen right here. This is basically a playlist with all trading courses I have made so far. I hope to see you in the next one. Take care. Ciao, ciao.